to welcome you to the 20th Annual Bank Research Conference. We have a great program for you the next couple of days, and we're glad you're here. We're also very pleased that our chairman, Yellen McWilliams, could join us today live, albeit virtual. So now I would like to introduce FDIC Chairman Yellen McWilliams to provide opening remarks.
Thank you so much, Diane, and good morning, everybody. Welcome to the 20th Annual Bank Research Conference. It is our distinct pleasure to once again co-sponsor this event with the Journal of Financial Services Research. Our partnership has been long and successful, and I'm pleased to say that this year's conference marks 20 years of our co-sponsorship. I want to thank Haluk Unal, FDIC Special Advisor and Managing Editor of the Journal, for his leadership and dedication over the years. Haluk has been a driving force of the Bank Research Conference since the beginning, when the idea of a co-sponsor research conference dedicated to banking was being conceived. I also want to thank Jonathan Pogash, Chief of Financial Modeling and Research, financial economist Troy Kravitz, and our FDIC economists for organizing this year's event. I like to say that our economists are the best, and so we're presenting you the best of the best. Conference coordinator Ebony Oliver and all of our administrative and technical staff, especially Glenn Kivlin, David Spamberg, and Donna Vogel, have once again risen to the occasion to produce a high-quality conference this year in the constantly evolving pandemic environment. This celebration of the 20th anniversary of the Bank Research Conference is not quite what we had originally envisioned when we first started planning in January of 2020. Well, a lot of things that happened after January of 2020 are not exactly what we envisioned back then. We would have loved to have hosted this event in person in Arlington, Virginia, though that was not meant to be. However, because we are now not constrained by physical space limitations, we have the opportunity to welcome a much larger audience, all of you, to help us celebrate 20 wonderful years of banking research at the FDIC JFSR Bank Research Conference. As in years past, this year, the Bank Research Conference attracted a stellar set of research paper submissions from around the globe, and acceptance to present is highly competitive. We received approximately 400 submissions to the Bank Research Conference, 27 of which appear on the conference program. The papers on the program reflect the cutting edge of banking research. In addition to the sessions on bank risk, bank competition, and bank regulation, I am particularly pleased to see the conference stay at the forefront of emerging banking topics. I am looking forward to learning more about the effects of the COVID-19 pandemic on the banking sector. As a special treat, the conference also has two panels, one looking back at the lessons learned in banking during the past 20 years, and another looking forward to banking in the next 20 years. The research presented at the conference informs the discussions and deliberations of FDIC policymakers. In 2003, former FDIC Chairman Don Powell supported the creation of the Center for Financial Research, home of the Bank Research Conference, with this principle in mind. Regulatory processes should be grounded in both empirical evidence and clarity about the potential trade-offs involved. No single paper can tell a regulatory agency what to do, but a collective body of research provides a lens through which to consider the implications of alternative approaches. It is not that regulatory policy follows the research. Instead, research helps inform regulatory policy. This has always been the goal of the Bank Research Conference and the Center for Financial Research. I'm delighted to say that this goal has been achieved. There are two major themes that emerge as we look back on 20 years of the conference. First, the fundamental ideas and risks involved in banking, liquidity, capital, lending standards persist across generations. Second, new ideas and emerging risks are constantly challenging our conventional wisdom on banking. The history of the Bank Research Conference and this year's program, in particular, reflect these two themes. Like the banking sector, the Bank Research Conference has evolved over time. In its early years, the conference focused on a specific theme of interest to policymakers, such as incorporating market information into financial supervision or US Basel II implementation. Since then, it has shifted to showcase a variety of banking topics each year. We see the variety and timelines of the topics on the program this year, with sessions organized in areas like fintech, climate change, and the effects of COVID on the banking sector. Expanding the range of topics discussed has enabled a broader engagement with the banking community. The conference's wide view of banking has also enabled it to adopt a forward-looking view of the risks and opportunities facing the banking sector. The traditional banking topics we're so accustomed to, lending, risk, liquidity, and capital, are still there. They remain central to both policymakers and the academic banking community, but they are joined by topics that have come to the forefront in recent years, such as systemic risk in 2010 or fintech in 2017. Panels on this year's program mimic the duality of the rest of the program, as we consider both the central issues of traditional banking and the emerging issues that could upend those traditional views. We're honored to have Mark Flannery moderating a panel today, looking back on the last 20 years of banking research and what we have learned. Professor Flannery was the first director of the Center for Financial Research way back when it was created in 2003. Looking forward, Christine Parlour will be moderating a panel tomorrow about what the future of banking might look like. I'm eager to hear from them and our esteemed groups of panelists. As part of our effort to look into the future of banking research, we also introduced for the first time this year a poster session for PhD students in economics, finance, and related fields. Our engagement with students at this stage of their career helps us at the FDIC understand what is of relevance to a new generation of bank researchers. The PhD students also provide us with a fresh set of perspectives on banking issues. We encourage you to go to the conference website, listen to the authors describe their research, and engage with the students in a virtual reception after tomorrow's session. In celebration of the 20th anniversary, FDIC staff assembled a retrospective article on the Bank Research Conference, published in JFSR and accessible through the conference website. The retrospective article highlights the influence of the conference on the policy and research communities, on financial regulation, and on the banking literature. The article discusses the evolution of the conference from its origins to the premier banking research conference it is today. We encourage you to read the retrospective articles to see how the conference has both responded to and led the changes in the bank research community at large. Troy Kravitz will summarize the main findings of the article in a session this afternoon. I would like to extend a special thanks to the discussants whose work helped set the Bank Research Conference apart from its peers. Unlike other conferences, the papers presented in the sessions are handpicked by the discussants from a curated list of 10 to 15 papers within a similar topic area. The discussants will help us bridge the gap between the results of a single paper and the complexities and nuances in which policy making happens. The FDIC and CFR are pleased to host you for the Bank Research Conference. Please enjoy the next 2 days of the conference, and we look forward to seeing you again in person soon. Thank you.
Thank you so much, Chairman McWilliams. Next on our schedule are 2 paper sessions, which will round out the morning of today's agenda. To start the afternoon, FDIC economist Troy Kravitz will discuss the 20-year respective article on the Bank Research Conference published in the JFSR, followed by a panel discussion entitled 20 Years of Banking, Lessons Learned, moderated by Mark Flannery. The day will finish with 2 additional paper sessions and a virtual reception where presenters can discuss their research informally with conference participants. The schedule tomorrow will be similar, with paper sessions in the morning, a panel discussion, 20 Years of Banking Going Forward, moderated by Christine Parlour, to start the afternoon, 2 more paper sessions following the panel, and a virtual reception in the later afternoon. We look forward to sharing the next 2 days of bank research with you and hope you enjoy your time with us. Thank you.
Good morning, everyone. My name is John Pogash. I'm one of the conference organizers. In the time that we have before we start the first paper session, I would like to encourage you to take a look at our conference agenda, where you can find the linked retrospective article that was discussed in the chairman's remarks. I also would like to point you to the poster sessions. The poster sessions can be found on the last page of the conference agenda. You can find our poster presenters discuss their research on YouTube videos. And you can also view their posters to help support the viewing of that material. We're very excited to start the day with a session that's going to be moderated by Anjanta Kaur. That's the first paper session that will start at 9:30. And there'll be a 10-minute break following that, which will give us a chance to get everyone together virtually to start paper session 2 on deposits, which will be chaired by Ned Prescott. We'll take a short break, and then Troy Halukunal will open up the afternoon session at 1:05 Eastern Standard Time to discuss a little bit of the background of the Bank Research Conference, and then introduce Troy Kravitz, who will discuss some of the findings from the retrospective article. Following that, we'll have our first panel discussion moderated by Mark Flannery with 3 esteemed panelists, Bob DeYoung from the University of Kansas, Linda Goldberg at the Federal Reserve Bank of New York, and Philip Strawn from Boston College. We'll then have a short transition period again to allow everyone to gather backstage. And then we'll continue with paper sessions in the afternoon. The first paper session in the afternoon will start at 2:25 on FinTech, moderated by Professor Bala. Again, a transition. And then at 3:35, we will have a paper session on the pandemic, moderated by Professor Hoberg. In the afternoon, starting at 4:45 p.m., we're going to have virtual receptions, and this is going to provide an opportunity for all of you attendees to interact in a more informal way with all of the morning paper presenters, the afternoon paper presenters, and our poster session presenters. We encourage you to attend these and to provide your comments and feedback to all of our presenters who, again, in a virtual environment, we don't have the same kinds of opportunities to engage, and this is, I think, the opportunity to do so. At the end of each session, time permitting, we're going to have Q&As. The way in which you engage with the Q&A is through the right-hand side of your screen. There is a Q&A button. The Q&A button will allow you to ask questions that are observable to all of the panelists. Whether or not we are able to get to your question, the panelists will be able to see your question and will be able to send them afterwards a list of all the questions posed. So please do share your remarks so that they can get the kinds of feedback that make these conferences so valuable. You can also use a raised hand feature in the right-hand panel, hand mark like this at the bottom of the participants list, and that will allow you to raise your hand, and we can also call on you in that way. We look very much forward to sharing the next 2 days of bank research with you, and we look forward to hearing from our presenters.
All right, ready to start?
Hi, Andrew. I'm ready. Let me know when I should start.
All right, okay. Well, good morning, everybody. Welcome to our session, Safety Nets, Transparency, and Bank Behavior. We have 3 exciting papers in this session. Just some logistics that I want to go over. Each paper presenter will have 20 minutes to present. I'll just move from one presentation to the next. And then at the end of the 3 presentations, I'll do a discussion, which will also be 20 minutes. And then that will leave us with about, if we stay on time, it'll leave us with about 10 minutes at the end for Q&A on all the 3 papers. So as you listen to the presentations, if you have any questions, just note those questions and know that at the end, we'll have 10 minutes to address as many questions as we can in the time that's given to us. So without further ado, let me introduce the first paper, Optimal Bailouts in the Doom Loop of a Financial Network, by Felix Carrel, Agostino Caponi, and Joe Stiglitz. And I believe that Felix is going to present. So take it away, you got 20 minutes.
All right. Thank you very much, Anjan. And good morning to everyone, or good afternoon, depending on where you are right now. My name is Felix, and first of all, I'd like to thank the organizers for not just including our paper in this truly excellent program, but also for having us open this second day or first day of the conference. It's really a great honor for us. And as you heard, us, that would be myself, Agostino Caponi, and Joe Stiglitz from Columbia. On that occasion, I would also like to mention that I'm on the job market this year. So if your institution is hiring, chances are that I applied and you're essentially getting something like a free job market talk here. With that out of the way, let's jump right into the paper. As you can see from the title, it's going to be a paper about bank bailouts. And fortunately, with this crowd, I don't really need to motivate why bank bailouts are an important and interesting topic to talk about, right? It's been hugely controversial, not least since the global financial crisis, because effectively it is taxpayer money being used to cover private losses. The rationale behind bank bailouts is usually to some form of, let's avoid a second Lehman Brothers moment. So let's avoid contagion of other institutions, of other sectors. And this idea of financial contagion, of systemic risk, is going to feature very prominently in our paper. Now, 10 years ago, during the European sovereign debt crisis, bank bailouts gained a new dimension. They were really, really expensive, those bailouts. So just to give you some numbers, in some countries, especially in Ireland and Greece, the cost of those bank bailouts amounted to roughly 40% of GDP back then. So these were really, really huge numbers. And one of the reasons why is the so-called doom loop. So the idea that governments and their banks are connected to each other, are trapped in a negative feedback loop. And here's exactly what we mean by that feedback loop. So what we saw was that large bank bailouts increased sovereign default risk, and it pushed down the price of those sovereign bonds and increased yields. The big problem in the euro area in particular is that banks tend to hold enormous amounts of their own government's bonds there. So that means, it's almost paradoxical, but it means that every euro that the government used to save its banks actually put additional pressure on at least some of the banks in its banking sector. And at the end of the day, it means that the total required bailout expenditure can become much more expensive than just the initial shortfall in the banking system. That's something that we call the doom loop multiplier, and it's greater than 1 in our paper. The question we ask in our paper is very, very straightforward. We ask, which banks should a government optimally bail out in a doom loop scenario, like the one I just sketched for you, and in particular, when banks are connected to each other in a network of liabilities. So there is potential for contagion. I'll give you a short preview of the answer that we give. And as you can imagine, for every one of you who's ever seen a network paper, there's going to be some kind of centrality measure that's going to be important. And the same is true for our paper. We identify a centrality measure for the interbank network, which is called node depth, such that banks in the center of the network can move up in the government's bailout ranking if they hold more domestic sovereign bonds. But for banks in the periphery, on the other hand, the opposite is true. So if they hold more sovereign debt, they would actually move down in the government's bailout ranking. And another way to put this result, it's really just, it's a subtle difference. It's just another side of the same mechanism. But the second result would be that from the point of view of an individual bank, higher domestic sovereign bond holdings increase the chance of a bailout in a more connected network, so with more links in a dense network. But in a less connected network, in a sparse network, again, the opposite would be true. So higher sovereign bond holdings would decrease the chance of a bailout. And an important implication of our technical results here is that, again, from banks' point of view, the incentive to hold your own government's bonds will depend a lot on your network position or on network structure overall. Now, obviously, in just 20 minutes, I can't go into every detail of the model. It's a purely theoretical model, by the way. There's no data part to show here. But I'll give you a quick overview, of course. And the first thing would be have a look at this timeline. It's a 3-period model, and the first period is very mechanic. The only thing that happens here is that there's an exogenous, unanticipated shock to banks' assets that renders some of the banks insolvent. That's needed to get the model started. And the problem is that in the middle period, bank liabilities to each other, so the liabilities that we capture in the network, are due. And if one bank doesn't repay, potentially its creditors could fail as well, and the creditors, and so on. So there can be cascading defaults. However, the government can stop contagion, nip it in the bud, by borrowing to finance a bailout. That's also going to happen in the middle period. That's where all the action happens. The problem of the government, however, is that in the final period, it's going to learn how much it can raise in taxes, and that's going to determine whether the government can repay its debt or not. So it's a really simple, it's a really stylized way to capture the idea of sovereign default. It's not strategic, it's just mechanic. Either the government can repay, then it does, or it can't, then it doesn't. Now let's first talk about the first building block of the model, which would be the banking sector. And what you can see here on this slide is a stylized balance sheet of a generic bank before the shock hits. And let's first start on the liability side. There are two different types of liabilities. First, we have deposits. By the way, all these balance sheet elements are exogenous again, so there's no choice on the bank side. Right? So there's deposits that are senior liabilities, and then there are junior liabilities, which are called interbank liabilities, LI. So it's for bank I. The difference between assets and liabilities is going to be the bank's equity position, or the value, the net worth. On the asset side, we first have some sort of generic outside asset C. You can think of it as cash, but it would also contain something like loans to the real sector. So everything that's not related to the network, to the interbank network. Second, very importantly, we have claims on other banks. And now that's where the network comes in. This variable here, pi ij, measures the share of bank I in bank J's total interbank liabilities. So all the network can essentially be collapsed to just this matrix pi. And then finally, the special sauce, in a sense, of the model, that would be the presence of sovereign debt on banks' balance sheets, BI, evaluated at an endogenous price Q. Here it's Q0, because that's period 0, and in the middle period, that's going to be an endogenous price Q1. As I already said, there's an exogenous shock in the beginning, and that shock renders some banks fundamentally defaulting, meaning that they have a positive shortfall. The difference between liabilities and assets, which we call chi, will be positive. Those are the initial sources of trouble in the banking sector. Now, in the middle period, liabilities have to be settled, and here we're following the famous clearing procedure, the clearing protocol introduced by Eisenberg and No in 2001. And it's a very intuitive, simple protocol. What happens here is that defaulting banks have to liquidate all their assets, and then they repay their creditors according to seniority. So first depositors, and then other banks. Those interbank repayments will be called P, and they can be at most L, so at most what you owe, but if you have to default, that will be strictly smaller than L. And those interbank repayments occur pro rata. Very importantly, we assume a deadweight cost of default. So what that means is that every time a bank defaults, before the bank can even repay its creditors, its assets are further reduced by an amount beta times the bank's shortfall. So it just goes up in flames. What this is supposed to capture is, legal costs that occur during bankruptcy procedures, or delays in repayment, or even, you could even think of fire sales in a sense, but we're not really marketing it as that. And what's important here is that the deadweight loss is increasing in the bank's shortfall. So if you just fail by an epsilon, you're not going to cause much trouble. But if you fail by a lot, you're going to cause lots of deadweight losses. That's going to matter for the government's decision. Speaking of the government, what does the government do? So the central player in our paper. The government chooses the optimal set S, script S, of surviving banks. And by doing so, it implies an aggregate bailout amount T. Now, I said it chooses the optimal set, and I didn't give you the objective function. So forgive me for waiting for another slide. That's going to be on the next slide. Let's first talk about the constraints that the government faces. So there is an initial exogenous sovereign debt level B0. And in the final period, the government will have to repay an amount B1, which is composed of the initial amount that it woke up with, plus however much the government had to promise at a prevailing price Q1 to repay the bailout amount. Okay. Now, in the final period, the government learns its tax capacity, which is stochastic. It's called tau, and it follows CDF-F. And the simple rule is that if tau is large enough, the government repays in full. If it's too small, the government doesn't raise any taxes and defaults fully. Okay? Now that's the supply side of sovereign bonds. What about the demand side? We're making our lives very easy here and follow the early sovereign debt literature, like Arellano, for example. We assume risk-neutral international investors with deep pockets. So those players are going to clear the market as long as the price is fair. And the fair risk-neutral price here is simply given by the expected repayment on a bond discounted by the risk-free rate. And because of our assumption on how the government defaults or not, this has a neat expression in terms of the CDF-F, right? This is the expression for the default probability. And that equation is going to determine the equilibrium sovereign bond price. Now, I promised you to next have a look at the government's objective. What is it that the government actually tries to maximize, or in that case, to minimize? The government picks the optimal subset of surviving banks, S star, to minimize deadweight losses from two sources. The first source is the one I already mentioned. It's bankruptcy deadweight losses. So here in the large parentheses, you see the chi, the shortfall of defaulting banks, and it's multiplied by the scaling parameter beta. The second source of welfare losses is going to come from the government's own possible default. And it's governed by this counterpart parameter here, gamma. So gamma is the deadweight loss per unit of defaulted sovereign debt. And you can already tell that the trade-off here is relatively simple. With each bailout that the government decides on, it can avoid some bank bankruptcies, but it will lead to an increase in sovereign debt and to an increase in the sovereign's default probability. The constraints here are just what I told you earlier. So the government has to respect the equilibrium. The equilibrium sovereign debt price here. So it just chooses from a menu of prices in a sense. It internalizes the effect of its choice on the price. And the second constraint here is just the definition of aggregate bailouts. And what this means is this is the amount of money that is needed to keep all the banks in S just solvent. Now you could probably already tell that the result of this discrete minimization over sets is relatively complex. And in fact, this problem as it's presented here can only be solved numerically. We do provide an algorithm for that, which I think is quite nice. And so in principle, the model can be used as a sort of reduced form stress test. But of course, we want to be able to say something analytical as well. And for that, from now on, we're going to simplify the problem. We're going to suppose that the government can only ever save one bank at a time. So we're thinking in terms of marginal improvements now. And the question is, can we rank the banks according to the net welfare effect of bailing them out? The answer is yes. And I'll talk to you about 2 out of the 3 main results of the paper, the 2 that I already mentioned earlier. So you can forget about point 1 here. Let's instead focus on point 2 and 3. Result 2 says, and now it's slightly more formal than what I previewed earlier. If a bank holds more sovereign bonds in the network A then in an otherwise identical network B, it will end up higher in the government's ranking if it is sufficiently central. So that's going to be a threshold centrality level. And if the bank is above that centrality level, then by holding more sovereign debt, it can move up in the government's bailout ranking. The third result here on that slide is capturing the same idea, but instead of looking at the same bank across two networks, we're now looking at two banks within the same network. And what the proposition says is that among two otherwise identical banks, the government will prefer the bank with less sovereign debt if those banks are rather peripheral, and it will prefer the bank with more sovereign debt if these banks are relatively central in the network. Right? So now I just dropped these results on you. Thank you. I just dropped these results on you, but I didn't talk about the intuition yet. That's now going to be the rest of the talk. The first important thing to notice here is that whenever you select a set of surviving banks, at the same time, you also select the set of failing banks, right? That's clear. Now, because of the doom loop that I explained earlier, each bailout you decide on imposes some additional losses on the failing banks with positive sovereign bonds, sovereign bond holdings. And now what we can show in our paper, and that's by the way, the content of this centrality measure that we identified, is that these losses you impose are further transmitted and amplified through the network in proportion to the bank's centrality. And what this means is that banks with high centrality and high sovereign bond holdings are the first ones you want to bail out, because if you don't, the doom loop will cause strong contagion around them. On the other hand, banks with low centrality, if they hold lots of sovereign bonds, all it does is it makes bailing them out less attractive because of the doom loop multiplier, right? This idea that every euro that you inject into the bank increases the effective shortfall of that bank by a few cents. So the more sovereign bonds the bank holds, the more expensive it gets. Now that's true for all banks, but for the very central ones, for the G-SIBs in our model, you have this compensating effect that you don't want them to fail if they hold lots of sovereign bonds, because your own action would cause lots of sort of collateral damage around them. That's the idea of the paper. Thank you. I'm doing well on time. I'm just going to wrap up. So the main contribution of our paper that I just explained to you is that we add an explicit interbank network structure to an otherwise relatively standard model of the doom loop. And that allows us to analyze the interaction between network position and network structure on the one hand, and domestic sovereign bond holdings on the other hand. We do also provide a smart numerical algorithm to compute, to solve this optimal problem, which you could call a stylized stress test, but that's not the main punchline of the paper. The punchline instead is that the doom loop amplifies the famous too interconnected to fail problem, right? So centrality is important in any network paper, but with the doom loop on top, it becomes even more important because of this additional contagion channel through sovereign debt. And secondly, that highly interconnected banks, the ones with high centrality, they could use domestic sovereign bonds as a strategic tool to manipulate their bailout option, right? To manipulate the chance of being bailed out. And this comes with an important policy implication, and with that I conclude. If you're, as a policymaker, as a regulator, if you think about regulating sovereign bond holdings of banks, and there are these considerations, right? Thinking about concentration rate, concentration limits, and so on. Then our research suggests that these upper bounds, these limits on sovereign bond holdings, should include a network component. Similarly, by the way, to the G-SIB surcharge from capital regulation, right? So the very important systemically relevant institutions, they need to be funded with more capital than the less significant institutions. And by the same token, with our paper in mind, you could argue that the G-SIBs should probably be regulated a bit more tightly than banks in the periphery of the network, just because they have a stronger incentive to load up on domestic government bonds and thereby essentially to pressure the government to bail them out if the chips are down. All right, That brings me to the end of the talk. Thanks a lot for listening, and I'm looking forward both to Anjan's discussion and to any questions that you might have later on.
Thank you, Felix, for the very interesting presentation and also for staying on time. I appreciate it. Our second paper is Disclosure Regulation in the Banking Industry, the case of exiting the SEC disclosure system by Aluna Wang from HEC Paris. So Luna, take it away, 20 minutes.
Thanks for the introduction, Anjan. So for me, it's a good afternoon in Paris, but I know it's good morning at FDIC. So it is really my great honor to present here and to share with you my work on the disclosure regulation in the banking industry. And as the name says, I focus on the case of exiting the SEC disclosure system. So as we all know that the Exchange Act of the 1934 establishes the SEC disclosure system to promote transparency through disclosure. And ever since then, it became the cornerstone of the US capital markets. And it became a very relevant topic because of the recent efforts to modernize disclosure for banking registrants. So here I want to draw our attention to the Section 12G of the 1964. So it has been this trigger for public reporting for in this SEC's disclosure system for such a long time. So according to this Section 12G of the Exchange Act, that accompanying, if it is held of a record, it's more than 500 or more person, and it has total assets exceeding $10 million, it has to enter into the SEC disclosure system and register its security with the SEC. So at the same time, the Section 12G also allows a company to deregister and thus exit the disclosure system when its shareholder of record dropped below 300. So there's a lot of literature trying to tell us about the causes and consequences of the exits of the SEC disclosure system. So for example, that there are a lot of significant research looking at a sample of SEC deregistration filed by the US firms. And they figured out that the compliance cost, especially the SOX, Sarbanes-Oxley Act compliance cost, can be a significant cost for many of the firms to decide to deregister with SEC and exit the system. And also those papers distinguish between the going private and going dark. So for going private, that means those firms not only deregister with SEC, but also they decide to form themselves as a private firm and then enter into a different set of regulation with SEC. And then going dark, it basically means that they just exit this public reporting system. And they don't have to file all those SEC required filings anymore, but still they can trade, with pink sheets and also other public markets. And also there's a stream of literature looking at major deregulations. It's not really directly related to the 12G, but it's a different set of firms. The foreign firms, they can deregister with SEC according to this 12H6. And they're looking at, the market reactions of the announcement of this deregulation. And then they figure out that firms with poor growth opportunities tend to deregister. And as you can see here, because of the limitation of this that's embedded in the setting, it's very hard for those firms to look for the consequences. And then they can only provide some suggestions, very limited causal inference. And almost all those research in this stream of literature looking at non-bank firms' exit from this very significant disclosure system. And here, I'm looking at the 2012 Jobs Act. There's one section, the Section 601, actually amended the Section 12G of the 1964. And then they're specifically targeting on making changes on banking institutions. So before, the shareholder of record dropped below 300 and all the firms can decide to deregister with SEC, exit the SEC disclosure system. And then after April 5th, 2012, the enactment of Jobs Act for banks. So here's only for banks and bank holding companies, this 300 threshold changed into 1200. So there is a significant change here. This basically provide us a regulatory shock to bank holding company with a shareholder of record above 300 but below 1200. It provided us a shock to their ability to exit the SEC disclosure system, and it will afford us a great setting to provide some causal evidence concerning the impact of this BHC's exits on banking outcomes. So here my research question is, how do bank holding companies' exits from the SEC disclosure system affect bank liquidity creation, and why? So I already saw that in Felix's presentation that you're presenting this bank's traditional balance sheet. As we can see here, if we see banks are using relatively liquid liabilities such as transaction deposits to fund relatively liquid illiquid assets such as business loans, this is basically the on-balance sheet liquidity creation, as pointed out and summarized by Bryant 1980 and Diamond Dibwig, the stream of literature. And then these Holmstrom and Tuhold, and then this follow-up research, they also pointed out that banks can also create liquidities off balance sheet using those loan commitments. So according to some of the very influential research by Bhattacharya and Thakur, for example, 1993, they pointed out that liquidity creation pertains to the existence of financial intermediation, and they're a key contribution of banks to the broader economy. And some of the more recent papers that trying to create measurement of liquidity creation are also saying that the liquidity creation is a comprehensive output of banking institutions. So here, I'm curious about what information is actually lost after BHC's exits from the SEC disclosure system. So if I try to answer this question, I have to see that what could be the potential economic mechanism there. Why do we expect that there is some impact? So our banking institutions are facing this very special regulation mandate. They have the dual reporting mandate system. They're facing the financial stability regulator because Federal Reserve are asking them to provide a set of public reporting, such as the core reports. And then when they have like a higher enough assets and more than 500 shareholder of record, they enter into this SEC disclosure system. So once they exit from the SEC disclosure system, basically they no longer have to file this SEC specific filings. For example, the 8K. So the 10K are very similar, right? The information content are very similar to core reports, but 8K provide more forward-looking loan loss informations. And they don't have to file those governance and insider trading disclosures, which could be useful to predict future stock returns. And they don't have to provide those SOX specific requirements, and which are related to the governance, risk management, and control over credit risk. So all those things are related to helping the outsiders to gain insights into the future performance of bank assets. So here, if we are seeing transparency as the ease with which outsiders can acquire information about the future performance of bank assets, and we're facing some theoretical debates in what could be the potential impact of BHC's exits on the liquidity creation of banks. So from the conventional, if we are following the conventional wisdom, which is a more asset-centric view, they see banks as this dedicated monitor of the firms, of the potential borrowers, and then the bank opacity intensifies the information asymmetry between a bank and capital providers in the public markets, leading to increase the cost of external funds. So there are like generations of research on this topic. And here, if we're following this line of logic, the SEC disclosure system basically strengthens the external discipline from the capital markets investors. And the outsiders, the capital providers would prefer a higher bank transparency. So the BHC exits is likely to lead to a reduced external fundings for those banks. And then they would have lower credit supply to some extent to the real economy, which lowers the liquidity creation. So if this is the case, it's very likely a BHC's exits from the SEC disclosure system can lead to a decrease in bank liquidity creation. But if we're looking at the emerging theory from the liability-centric view, so we would see that actually banks are facing various market imperfections. Those information asymmetry between capital providers and bank insiders are just one of those imperfections. Removing one market friction might distort the overall outcomes when multiple frictions are present. And as we all know that banks' ability to produce safe liquidity backed by this risky asset arise from keeping the information concerning the backing assets as a secret, which is illustrated in detail by those two, by the most recent paper, Dong et al. 2017 in American Economic Review, and is based on the Hirschleifer effect illustrated in 1971 paper. So if we're following this line of logic, a BHC exit is likely to lead to an increased ability to produce more money-like claims, those safe liquidities, and then make this uninsured deposits more attractive. So they would attract more fundings from the liability perspective. And then they can do more lending because now they acquired more uninsured deposits, and then that will lead to higher liquidity creation. So this would suggest the bank's exit from SEC disclosure system is likely to lead to higher bank liquidity creation. So as we illustrate at the beginning, we want to follow this regulatory shock to banks' ability to deregister with SEC and then implement a fuzzy regression discontinuity design, because according to the legal legislative history, that this 1200 threshold is arguably arbitrary, and those banks around this threshold are almost as good as randomly assigned. So I hand collected some of the data regarding their shareholder of record and going doc status. So the data resources you can see is from those following resources. The BHC exits is from the 12G filings, and these shareholder of records immediately preceding the enactment of the Jobs Act are from the 10K filings. And then BHC and bank subsidiary link are from our FDIC's bank data and statistics platform. And also gets those banks' financial information, from non-financial information from awards bank regulatory database. And also I thank Krista Baumann for sharing this information about bank liquidity creation data that she used in his review of financial study paper in 2006. So as we all know that those discontinuity can be showed in the graphical plots. So we first want to see it in a more visual way. That figure 1 here, as you can see, they plot the distribution of the SEC deregistrations and normalize the bank liquidity creation as measured with Krista Bowman and Alan Berger's paper in Review of Financial Study. I borrowed their the creation of the measurement on bank liquidity creation, and it's a normalized bank liquidity creation. It's scaled by the gross total assets of the bank on this 4 sample around the threshold, which is 1200. And this visual inspections of the figure 1 basically reviews there's a discontinuity in both variables around the threshold. One is the probability of exiting the SEC disclosure system. The other is just the normalized liquidity creation. So according to the fitted lines of the first degree polynomial of the number of shareholders estimated on the interval from 300 to 1800, there is about a 13 percentage point increase in the probability of exiting the SEC disclosure system, which is very significant. And then there's about a 2.6 percentage point increase in normalized liquidity creation for banks just below the 1,200 threshold, right? Which is the one that actually enjoy the benefits to be able to exit the SEC disclosure system with the new regulation. So those banks, they enjoy this increase in normalized liquidity creation relative
5 minutes.
Relative to banks just above the threshold. So when the identifying assumption is met, the discontinuity in bank liquidity creation can be attributed to the causal impact of BHC's exit from the SEC disclosure system. And when we do run the fuzzy regression discontinuity regressions in the two-stage, in those non-parametric estimation, I see that there is definitely a significant impact here, and it's about like 20, it's about 0.20, which is a magnitude. And if if we're looking at the economic magnitude, we can translate that to $362 million, which is very significant if we are comparing that to the average asset level or average liquidity creation level of all those banks in my sample. And the next question would be why? So since we're seeing this theoretical debate and we're trying to see that if it follows the conventional wisdom or following the emergent theory, and I found that the exits would lead to an increase in total deposits, and it's driven by the increase in uninsured deposits. And I also see an increase in illiquid assets, which are largely business loans. So this is consistent with the Dunn et al. 2017, predicting that bank opacity impeding the price discovery of bank assets makes deposits more attractive and then affords banks more flexibility to fund illiquid assets. So here we have to take a little caution. So my results does not really deny any monitoring benefits, of transparency. It's just suggesting that the reduced cost of liquidity transformation is more prominent in this case. And as we would know that this Jobs Act is trying to help those smaller banks to save. So it's possible that there's some alternative explanation. It could be that, those banks, they decide to exit from the SEC disclosure system, and then they enjoy this marginal cost saving, and then that could be passed on to the bank depositors. And we would observe that there would be a higher deposit rate and then more liquidity creation.
2 minutes.
Mm-hmm. So in order to see if this alternative mechanism work, and I also run the further regression discontinuity estimation, so the BHC exits does lead to, some passing of the marginal cost saving in the sense that we see an increase in core deposit rate and also large time deposit rates. But as you can see here, the core deposit rate, the impact is much higher there. And for large time deposit rate, which is more likely to be uninsured ones, the impact is not so significant and the magnitude is much smaller. So here I would like to see the robustness of the bank opacity mechanism by controlling, those confounding factors like the increase in the deposit rate. So I didn't see, any change qualitatively. And actually, if we look at the uninsured deposits, here, the magnitude stayed the same, and also the same for the changes in illiquid assets. So this tells us that even when we take into consideration about this cost-saving mechanism, we can still see that this bank opacity mechanism does exist in this case. So in conclusion, this paper analyzed the informational implication concerning BHC's exits from SEC disclosure system, and I exploit a threshold-based policy in the Jobs Act to investigate this impact. And I find that there is a strong positive impact and suggest that the impact is driven at least in part by bank opacity. So this paper is strive to make contributions to those four aspects. It talks about the economic consequences of SEC regulation and its interaction with financial stability regulations, saying they have overlap, but also the differences. And it tells us more about the financial regulations trade-off between investor protection and capital formation. It also sheds some light on the determinants of bank liquidity creation and informs us more about the real effects of disclosure regulation in the banking sector. Thank you very much.
Thank you, Luna. Thanks for that very interesting presentation. And again, thank you for staying on time. So the last paper in our session is Insurance Pricing, Distortions, and Moral Hazard, Quasi-Experimental Evidence from Deposit Insurance by George Shukri. And George, you are ready. Take it away, 20 minutes.
Hello, sorry, I got unmuted for a minute, sorry. Hi, everyone. My name is George Shukri. I'm with the FDIC Center for Financial Research. Please let me know if you can't hear my audio. But first, I have to say that the views and opinions in this presentation are mine, and not necessarily those of the FDIC or the United States. So this paper is about the pricing of insurance and moral hazard. And there are different kinds of moral hazard that are associated with insurance. In this paper, the type that I focus on is ex ante moral hazard, and that's the propensity of insured parties to take on more risk simply because they are insured against that risk. And this is present in a variety of contexts, including deposit insurance and banking. So one way to fix this kind of moral hazard is through risk-based pricing, where we can classify the banks, instead of offering flat rate pricing for deposit insurance, we can classify the banks into different risk buckets. And banks in the higher risk bucket would pay higher premiums. And the hope is that these premiums would incentivize them away from the high risk bucket and take on less risk. In theory, this should solve the ex ante moral hazard problem. But in practice, there could be distortions associated with it because high premium payers can re-optimize. If their premiums are higher, they might re-optimize and respond to those premiums in many other ways, other than through reducing their risk-taking. Any of these distortions dampen the effect on profitability that higher premiums would have on those risky banks, and they reduce the effectiveness of risk-based pricing. So in this paper, I addressed three broad questions. I'll give you an overview of the results. The first question is whether risk-based pricing is effective at reducing ex ante moral hazards. The answer is yes. I find that premium differentials lead to large differentials in profits that cannot be evaded through distortionary behavior. In addition to that, not only are the incentives there, but I find that banks actually respond to pricing incentives through the risk mitigation channel. So they don't just respond through distortions, they also respond by reducing the risk taking. The second question is in understanding what kinds of distortions could be associated with risk-based pricing. In this paper, I find three examples of distortions. One is a shift in funding sources. The second is regulatory arbitrage, where some banks shifted migrated deposits from a high premium fund to a low premium fund. I'll talk about that in a minute. And the third is a search for yield behavior that was accompanied by reduced liquidity. The third question, and this one is more broad, is just understanding how changes in deposit insurance premiums or funding costs more generally affect banks. There's some work on this, but there's really not that much. And one challenge is always identification. If we're comparing high premium payers with low premium payers, the premiums that they pay are endogenous because within the risk-based pricing scheme, banks are endogenously choosing which of those buckets to be in. So they are choosing their own premiums in a sense. We can also look over time at times when premiums have changed. A lot of the time, there are confounding factors and other related issues with doing this because at the time when premiums have changed historically, it just happened to be usually when there are other big changes happening in laws or regulation. Sometimes those changes were also using the same thresholds that would bucket those banks in the different buckets. Sometimes there are changes that we can use for identification that are too small, and they make it difficult to extrapolate and really understand the effect of pricing on deposit insurance. On risk taking. So in this paper, I use a quasi-experiment from the mid-1990s, where the premiums changed significantly for all the banks, but the application of the change didn't happen all at the same time. So the application of it was staggered. So I'll get into the details of the quasi-experiment in a minute, but first, I just want to fix ideas by showing you a couple of pictures. So this picture here shows a worst case scenario for moral hazards, where a bank's profitability on the y-axis is a monotonically increasing function of bank risk taking. So in this hypothetical scenario, the bank, to maximize its profitability, would take on the maximum level of risk. It's alpha bar in this picture, and the bank would end up at point A. Now, suppose a regulator or a lawmaker wishes to incentivize this bank to take on less risk, say move to a lower risk level, say alpha prime. One way the regulator can do this is by charging different premiums depending on whether the bank is to the right or to the left of alpha prime. And in that case, the picture would look something like this, where you can see that premiums are higher for banks with risk levels above alpha prime. So the bank that used to be a point A is not going to be a point A anymore. It's going to drop. It's either going to be a point D or point B. Now, how much it drops is really crucial for understanding whether moral hazard is still there or if it's mitigated. I hope you can see this from this picture. If the bank goes down to just point D, moral hazard is still there because it's still optimal for the bank to take on the maximum level of risk. But if it goes all the way down to point B, moral hazard is mitigated because now the bank's optimal risk choice is to move to alpha prime. Now, again, this is a crucial quantity, how premiums are affecting profitability. We have to be able to estimate this somehow to understand the incentives. Now, we can't just do a simple calculation on a static balance sheet and figure out how much the profitability would change if we change premiums, because again, banks will optimally respond to the changes in premiums, and they will dampen the effects that they will have on their profitability. So we might think that a bank is at point B, when in reality it's at point D, and it's dampened the effect of the higher premiums on its profitability. So to identify the effect of premiums on profitability, we have to compare two banks at the same risk level that are forced to pay different premiums. They have to be forced to pay the different premiums because that's the only way to ensure that they've fully optimized and any distortions are accounted for. Now, if we have that, then we can identify the effect of premiums on profitability. And that's one of the things that I get from this quasi-experiment. So the quasi-experiment was, again, in the mid-1990s. Back then, the FDIC oversaw two deposit insurance funds. The BIF insured mainly commercial banks, the SAFE insured mainly thrifts. And coming out of the S&L crisis of the late 80s, both funds were undercapitalized, and they had to collect premiums from their members until the fund reached the target capitalization level. Now, the experiment happened because the BIF recapitalized first. In the third quarter of 1995, the BIF recapitalized. The SAFE was not projected to recapitalize for at least another 5 years. But this, because the BIF recapitalized, its premiums had to drop for its members. And this caused a disparity in premiums. So SAFE members and BIF members were paying different premiums all of a sudden. And it caused problems. Congress decided to mandate a one-time special assessment in the third quarter of 1996 to recapitalize the SAFE. And then starting in 1997, the premiums again matched between the SAFE and the BIF. But there were 6 quarters where BIF and SAFE members face different premiums. And this is what it looks like in pictures. So these are the actual premiums that they paid. If you look in the left panel here, panel A, before the disparity, you can see 5 different buckets. There are 5 different levels of premiums that were charged to banks depending on their risk taking. On the x-axis is increasing bank risk taking. So as a bank becomes more risky, it pays more in premiums. Now, as we move to the middle panel, during the disparity, you can see that SAFE premiums remained the same. BIF premiums dropped. And the drop was not only a drop in levels, but it was also, there was a change in slope. So BIF premium slope became steeper, which means they faced higher penalties for becoming more risky. I will use both of these sources of variation, both the level change and the slope change as sources of variation in the identification. So I'll show you some pictures with some of the results. But first, the specification that I use, this is one of the main specifications in the paper. It's at the bank and quarter level. So bank is I and quarter is T. And the coefficient of interest is beta K. Beta K here is a time varying coefficient that shows the effect of being insured by the SAFE in a specific quarter. And it's always relative to being insured by the BIF. So I'll show you plots of this beta K over time. And we're interested in seeing whether that beta K happens to change right around the time of the disparity or if it doesn't. There are controls at the bank quarter level. There are bank fixed effects and quarter fixed effects, and standard errors are clustered at the bank level. So the first dependent variable I look at is other non-interest expense to total non-interest expense ratio. Now, in this ratio, the deposit insurance premiums, the assessments that banks paid are in the numerator. So here, I want to see whether that disparity actually filtered through to their costs. Did they actually pay more for deposit insurance, or maybe they were able to offset it somehow, maybe reclassify deposits or move them around somehow to avoid paying for them, but that's not what happened. You can see that this beta K coefficient is hovering right around 0. Right before the disparity, and then in the third quarter of 1995 you see a jump, and it's very significant. You can barely see the confidence intervals here. In the third quarter of 1996 you see another jump, a much larger one, and that shows the effect of the one-time special assessment that SAFE members had to pay, and then it goes back down to an elevated level in the fourth quarter of 1996, and then starting in 1997 again it goes down to 0. There is no disparity anymore starting in 1997. But you see those 6 quarters where the premiums were different, and SAFE members apparently actually did pay more for deposit insurance. So again, like I mentioned earlier, they may respond to this in many ways. I'll show you one example of a distortion that could happen from this kind of pricing. This dependent variable here is domestic deposits to liabilities ratio. Premiums in the mid-1990s were assessed on an assessment base of domestic deposits. So you can see the beta K coefficient here is, again, hovering around 0 early on 1993, 1994. But immediately before the disparity and during the disparity, you see 2 drops. And then after those 2 drops, you can see it kind of stabilize, maybe even increase a little bit. So they shifted away from domestic deposits. This was, they might have seen this source of funding as a disadvantageous source of funding that maybe put them at a competitive disadvantage with BIF members. Now, again, they could anticipate this disparity. It was known at least a year and a half before the disparity happened that it was going to happen. And no one knew how long it was going to last. If it wasn't for that one-time special assessment that Congress mandated in 1996, it might have lasted longer. It turns out that banks shifted away deposits in the SAFE. They shifted away from deposits and into Federal Home Loan Bank advances. That drop in deposits was essentially made up 1-for-1 by Federal Home Loan Bank advances. So again, this is just one example of distortions. I'll show you a couple more later if I have time. But the question now is, through whatever other distortions that banks could have done, could they have offset the effects of the premium differentials on their profitability? Like I said before, they're going to take actions to dampen the effects of premium differentials on their profitability. And now the question is, could they have offset it too much so that we would maybe think that risk-based pricing is not effective? And the answer is no. This plot here shows the return on assets. Again, it's the same beta K coefficient from the regression specification I showed you earlier. And you can see that SAFE members relative to BIF members had a very significant drop in their profitability right around the start of the disparity. It's significant both economically and statistically. Now, this is an average effect. We can break this down through a different specification that gives us an effect for every SAFE member separately. And we can plot those heterogeneous effects on the y-axis, and on the x-axis, we can do different variables to see which banks were more or less affected by this. Here on the x-axis, the plot is of log assets of 1995 Q1. And you can see that most of this effect is coming from the small and medium-sized banks. As you go out to the largest banks, the average effect,
4 minutes.
thank you, is close to zero. So there are more details in the paper that really hash this out a little more. But what this tells us is that the incentives are there. Premium differentials generate profit differentials that cannot be evaded. Again, both of these BIF and SAFE members were forced to pay those premiums. So any distortions are already accounted for. So the differentials created by premium differentials cannot be evaded through distortions. But the question now is whether we have any evidence that they actually respond to pricing incentives by reducing risk-taking. To answer that question, I have to use a different source of variation, and I use the change in the slopes between the two funds that happened during the disparity. The idea here is that if we look at the risky institutions, so any risky banks in those risky buckets, if they're facing a steeper slope, then we should expect that they're more likely to move between those buckets and move to a safer bucket. And that's exactly what we see. So if we look at BIF members, this is from a different specification. It's a logit specification that looks across time at the likelihoods that a bank moves between buckets and compares that likelihood between BIF and SAFE members. We can see that BIF members, again, immediately before the disparity and during the disparity, there is a significant increase in the likelihood that risky BIF members move to safer buckets. And in the paper, I do the flip side of that, where we can also look at the banks in the safe buckets. And again, the idea is similar. If they're facing a steeper slope, they should be less likely to move to risky buckets, and I find exactly that. So altogether, so far, the results point to the effectiveness of risk-based pricing. It creates incentives for banks to lower risk-taking, and banks do respond to pricing incentives through the risk mitigation channel. Now, I'll show you a couple more distortions. This one is on regulatory arbitrage. Some banks actually had deposits insured by both funds, and it turns out they could migrate some deposits from the high premium fund to the low premium fund by selling them. There was an asymmetry in the calculation that was done between the buyer and the seller, and they exploited that to migrate some deposits. The last distortion I want to show you is evidence for a search for yield behavior that was accompanied by reduced liquidity. On the left-hand side here is the growth rates of loan rates for BIF and SAFE. On the right-hand side is growth rate of securities for BIF and SAFE. And it looks like they sold securities and grew their loans. So they shifted away from liquid assets into less liquid, longer maturity, but presumably higher yielding assets. And we can see this reflected in their interest income. On the left-hand side here is interest income. Again, you can see an increase right around the disparity. On the right-hand side is interest expense growth rate. We don't see much of an effect there. That would, to me, tells me that to the extent that the disparity manifested in competition on deposit pricing, SAFE members continue to offer competitive deposit rates. So again, to conclude, putting everything together, there is evidence that risk-based pricing works. It provides incentives to lower risk-taking. Banks respond to those incentives through the risk mitigation channel. There are distortions and regulatory arbitrage that could occur. Their effects in the experiment that I studied do not countervail the incentives that are apparently created by differentials in premiums. However, their presence suggests that to make risk-based pricing the most effective it can be, it needs to be accompanied with appropriate controls and laws and regulations. So thank you, and I look forward to your feedback.
Thank you, George, for the very interesting presentation and also for staying on time. If you can stop sharing, there we go. Okay. Will I be able to advance this?
No, sir, you will be able to do that.
Okay. All right. Okay. So again, like I said, very interesting set of papers. So my plan is going to be okay, there we go. All right. So my plan is going to be to, is the advancing not working? I'm not seeing the arrow that advances here. Oh, next, is it this one? Okay, there we go. All right. So the all right. So the outline of my discussion is I want to describe to you what I see as the overall theme that connects the three papers. You know, on the face of it, they look very different, but they are connected. And I'll give you the broad research questions that I see when I read these papers. I'll summarize what we learned from the three papers taken as a group, and then I'll discuss each of the papers and then finally come back to the overall summary. All right, so the overall theme in all of these three papers is that an important economic function of banks is to make a contribution to the real economy by creating liquidity. And the act of creating liquidity, the process of creating liquidity, exposes banks to risk and the likelihood of failure. And as a result of this, we are going to observe banks failing despite the most effective prudential regulation. And so we then have to confront the possibility that banks will fail. We know that bank failures are socially costly because of bankruptcy costs, runs, loss of welfare for depositors, disruptions in the real economy, and so on. So these are all well understood costs, and that creates a rationale for deposit insurance as an ex-ante measure, but also bailouts ex post in case we do have failures and runs. And also information disclosure regulation, both by bank regulators and the SEC. And all of these attempts to deal with the possibility of bank failures then end up creating safety net induced moral hazard. And so it creates its own set of challenges in terms of how we cope with this. So I'm not going to discuss the papers in exactly the order in which they were presented in the session. It actually logically made more sense for me to rearrange them a little bit. So I'll identify what I saw as the main research question that each paper posed, and then give you their key findings. So research question one, which was in the paper that Felix presented, is if despite prudential regulation to limit bank failure, the probability of bank failure, if banks still fail, then what is the government's optimal bailout policy? And what are the costs of this bailout policy? Okay. Question two, which is in the paper that George just presented, is to minimize the probability of costly bailouts ex post, and costly meaning costly to the government and taxpayers. How can the government price deposit insurance ex ante to cope with moral hazard, both due to safety nets and the anticipation of future bailouts? And then how do banks respond to this risk-sensitive pricing? Yeah. Research question three, which is the question that Aruna addressed in her paper, is how do disclosure requirements affect banks' liquidity creation, which is the source of risk that leads to bank failures? And then what are the general policy implications of this? Okay, so those are sort of the three questions. They're all connected, but address very different dimensions of the problem. All right, so what are the main lessons that we learned? Number one, bailouts, and so the lessons correspond to the research questions. So I'll present them in the same order. So these are answers to the questions. So number one, bailouts for some countries can be really challenging due to the fact that they force more borrowing by the government. This is not a huge issue in the US, but in many countries it is. And this increases sovereign debt, and it lowers the prices and values of the sovereign debt holdings of domestic banks. And so this creates what the authors call a doom loop. And under this doom loop, the government's optimal bailout policy focuses on bailing out banks that are most central. Okay. The second overall lesson that we learn is that more risk-sensitive deposit insurance pricing and higher premia partially resolve the moral hazard that's associated with safety nets and bailouts. But then this also leads to its own distortions in bank behavior, and it causes banks to switch away from deposits and experience lower profits. So yes, risk-sensitive deposit insurance pricing works, but it does create distortions. And number three, and the third main lesson is that higher bank information disclosure requirements increase bank transparency, but they also reduce liquidity creation in a causal sense. And so this implies a trade-off for regulators, right? Do you want more transparent banks with all of the attendant benefits of greater transparency, or would you like banks to be more opaque and create more liquidity? Now, one sort of note is that in the framework of this paper, banks can reduce liquidity creation by holding more of their country's sovereign bonds, given the liquidity creation weights in the Berger-Bowman paper, right? So to connect the paper that Felix presented with this paper, and this obviously would further complicate the doom loop bailout problem that the first paper studies, right? Because more transparent banks may end up holding more sovereign debt. All right, so the overall message of these papers, if I were to summarize all of it in sort of one neat package, would be that all ex-ante regulations to limit bank risk-taking have sometimes surprisingly second-order effects. And these effects require careful consideration. And they may condition both the bailout policy of the government as well as post-bailout regulation. Okay? So those are sort of the very high-level messages that these three papers give us. Okay, so let me now discuss each of the individual papers. So the first paper, Optimal Bailouts in the Doom Loop of the Financial Network. The setting is, it's a theory paper. The setting is that banks hold lots of domestic debt, and these are government bonds. So they're exposed to their own sovereign debt risk. And again, the same banks are bailed out by their governments. So you can see the loop that this creates. And so the question is, what's the optimal bailout policy under such a doom loop? And the result is that rescuing banks with high domestic sovereign debt will be optimal for the government if these banks are sufficiently central, right, in an interconnected network sense. Even though bailing out these banks would require larger outlays or larger expenditures by the government. So that's the main result. Okay? Now the details are, in the model, banks fail due to exogenous losses, right? And this leads to welfare losses due to bankruptcy costs. You can alternatively think about welfare losses for depositors, as in the Merton Thacker J5 paper, where they argue that that the depositors of a bank really want to be completely insulated from the idiosyncratic risk of the bank. But that's sort of the optimal deposit contract. And so anything you can do to remove that risk is actually optimal in a welfare sense. So this justifies government bailouts. Okay. But of course, this requires additional borrowing in sovereign debt markets by the governments that need to fund the bailouts. This reduces the sovereign debt bond prices. So it further increases pressure on the balance sheets of banks because they have to mark these things to market. So the trade-off for the government really is, balancing the welfare losses from bank failures against the higher sovereign debt default probability. And then you trade these off in deciding the optimal bailout policy. So the main results are as follows. Number one, complete bailouts are socially more costly when banks hold more domestic sovereign debt. Now, if you allow partial bailouts, which means you bail out only a subset of the banking sector, these are actually optimal when they're allowed in the model. And then they show that it's optimal to bail out banks that are centrally located in this connected network sense, even though this is more costly. So what is my assessment? So it's a very nice paper. I really enjoyed reading it. The interesting central insight of the paper is very highly policy relevant. It contributes to this very rich literature on bailout policy, and it's a significant contribution. Now, so there's some things that are less than desirable. One is that the asset side shock in this paper is purely exogenous. It's pretty mechanical. So there's no endogenous, and there's no endogenous equity capital choice for the bank. So they just have this balance sheet that they start with, and the residual is equity. And so this way of modeling the bank limits the analysis in a number of ways. So, if you allow the capital choice of the bank to be endogenous, and if you allow things like common asset holdings, you get some very interesting effects, as Viral and I found in our paper in the JFI on sort of what are the implications for the lender of last resort when you have banks in a system where the banks all hold highly correlated assets, right? So if one bank fails, it actually conveys adverse information about the quality of another bank's assets. And so that bank could then fail even though its creditors haven't really observed anything adverse about it. So what we show is that if you allow some banks to fail, it can cause what we call a liquidation contagion of even healthy banks, when uninsured creditors make possibly erroneous adverse inferences about the quality of common assets. And so that raises a host of very complicated issues for the lender of last resort of the government. The other is that this way of modeling doesn't enable an examination of ex-ante policies that may influence the ex post optimal bailout policy. Because if you consider bank equity capital as endogenous, and if you endogenize capital requirements, then a possible implication of the analysis is that banks that hold more sovereign debt should be actually required to hold more capital. This is not what we see in practice. So it's kind of an interesting implication of the model that recognizes the doom loop effect, right? And so this would then lead to a lower failure and lower ex post bailout probability. Okay. My third point is, why always a bailout, right? Why not recapitalize banks as the US Treasury did with the CPP during the 07-09 crisis? This was the capital purchase program where the government bought preferred stock in these banks as a way to recapitalize them. So in general, I think it would be interesting in this paper to see what introducing ex-ante capital requirements would do and what ex post recapitalization as a policy tool would do to potentially change the implications. But I highly recommend the paper. It's very nice. My specific comments on George's paper, Insurance Pricing, Distortions, and Moral Hazard. Going back, I think the first paper that I read that formalized the idea that deposit insurance creates moral hazard was Merton's JBF paper in 1977, where he said that deposit insurance is isomorphic to a common stock put option, and concluded from that it created incentives for banks to make risky loans. So the research question in this paper is, what are the effects of insurance pricing on firm behavior, right? In this case, banks. And the idea is to use deposit insurance pricing to answer the question. The experiment that he looks at is beautiful. It was created by this timing discrepancy in the mid-1990s between the bank insurance fund and the Savings Association's insurance fund. And by this time, they were both being managed by the FDIC. Earlier, of course, it was the FSLIC. But BIF was recapitalized by the second quarter of '95. And as a result of that, by the time banks got to the third quarter, the premium had been reduced, as George mentioned. The SAIF was recapitalized only 6 quarters later. And so both the level of the SAIF premium and the steepness changed later than they did under BIF. And so otherwise similar banks face different insurance premium, which provides a very nice setting to look at the impact of deposit insurance premium on the behavior of banks. All right, so what are the main results? Well, risk-sensitive deposit insurance pricing reduces moral hazard, but it introduces other distortions. So banks that face higher premium have lower profits. They switch away from deposits. They reduce their cash and increase lending. They become less liquid. And some ended up actually playing games. They reclassified deposits to get lower premium. But they couldn't completely circumvent the effect of the regulation, so of the deposit insurance premium. So there's a cost to have banks, and then the cost to have banks reduce profits outweighs the potential gains to banks from higher risk taking in response to higher premium. So my overall comments are very nice paper. I really enjoyed the use of this experiment. I think it's really very nice. It's the first paper I know that provides convincing causal evidence on how risk-sensitive deposit insurance pricing, both the level and the slope with respect to risk, affects bank behavior. And it's something that in the theory we've talked about forever, right? So it's kind of the positive empirical evidence, I think, was a big hole in the literature that I think this paper helps to fill. The results are striking and policy relevant. I would, of course, like to know, it would be interesting maybe in future iterations. I don't know if it's possible to do this, but I think it would be interesting to know how the level of capital influences how banks respond to changes in deposit insurance premiums. So what I'm thinking is, one can have a set of reactions when leverage ratios are, say, at 3%. Then you may get very different reactions given potential nonlinearities, even with propensity score matched banks, as this paper has, at say a 5% leverage ratio, right? And this is, I believe, outside the scope of this paper, so I'm not recommending that George try to do it in this paper, but I think this is an interesting question for future research to look at, data permitting. All right, in the few minutes that I have, to wrap up, from a policy standpoint, this paper suggests that future theoretical analyses should use capital requirements and risk-sensitive deposit insurance premium as part of the same optimal regulation design. This is what we tried to do in our JF paper, is fairly priced deposit insurance possible, is sort of think about, don't just focus on capital requirements or risk-sensitive premium in isolation, but view them both as parts of the same regulatory mechanism design. Okay, and there's a more recent paper by Annard, Chapman, and Wilkins in the JFI, which also sort of addresses this issue in a similar way. To get to my last paper in the few minutes that I have, that Aluna presented. So there's a big debate in banking about whether or not there should be transparency or opacity in banking. How much should regulators reveal what they know about a bank, including stress tests and examinations by bank examiners and so on. And the usual theoretical tension is that if you have more transparency, it improves corporate governance and it possibly lowers the cost of capital. So that's a benefit of transparency. But then there are also costs, right, that the theory has pointed to. It may make banks more fragile. It may worsen intertemporal risk sharing, and so that's a cost. Now, previous papers like this Ferreira et al. Paper recently in the JFI have looked at some additional benefits of transparency, such as, when you have opaque banks, it insulates management against governance oversight. And that's a cost, not only for the shareholders, but also for regulators, because it blunts the effect of market discipline. The Dang et al. Paper that Aluna mentioned obviously points to the risk-sharing costs of higher disclosure when you have two generations of depositors and you're worried about intertemporal risk sharing. So the research question in this paper is, how do information disclosure requirements affect bank liquidity creation? So I think it's a very nice research question, and I think the paper does a really nice job of identification. So the approach is to look at the Jobs Act deregulation, which made it easier for bank holding companies to exit the SEC's disclosure system, and then to see how this affected liquidity creation by the subsidiaries of these bank holding companies. The main result is that less disclosure leads to more liquidity creation using the Berger-Bowman liquidity creation measure. So I think it's a very nice experiment. It's a well-executed paper, policy relevant, highly recommend you read it. I would like, though, to emphasize that it would be nice to view disclosure regulation in conjunction with capital regulation. There's an interesting working paper by Biswas and Kalfopoulos, which looks at this theoretically, where they look at bank capital structure and regulation as part of the same mechanism designed for the regulator. Capital also affects liquidity creation in the Berger-Bowman paper. So large banks, in their study in the US, which create more than 80% of the total liquidity in the system, create more liquidity when they have more capital. So I think I would like to know a little bit more about the capital positions of exiting banks and also their payout policy, right, after they exit, because that affects capital accumulation. There's also, I have a theory paper which shows that the best banks optimally disclose less. So, how do you control for this? Disclosure requirements are more onerous for actually the higher quality banks. And so they have a stronger incentive to exit the SEC disclosure. But these banks are also likely to create more liquidity. So you've got this additional channel through which you could explain the results. And I think it'd be interesting to show that that's not what's going on, or maybe that is what's going on. I don't know. So my overall summary of all the three papers is that bailout policy, deposit insurance pricing, and disclosure requirements should all account for the mediating influence of bank capital and look for interactions with bank capital ratios. So with that, I will stop sharing. And can we stop sharing? How do I stop? Okay, there we go. And we're open for Q&A.
Thank you for the comments. I'll begin by letting the presenters respond in order to the discussion. So Felix, and then Aluna, and then George. For attendees, you can pose questions in the Q&A in the right panel, or also use the raise hand feature. And for questions we don't get to, we're very welcome to address them in the session later today, on the virtual reception later today.
Okay, thank you, John, and of course, mostly thank you, Anjan, for the great discussion and the really sharp points you made about our paper. I'd like to respond to three of those really briefly, so there's enough time for the other speakers as well. First of all, of course, you're absolutely right that our paper is exclusively about exposed optimal bailouts. So there's not really a perspective that we can offer on what kind of regulation would be optimal ex ante, mainly because banks' balance sheets are fixed. And there's an obvious follow-up project that we already have in mind that we would use to drive home our point about the interaction of sovereign bond holdings and network position. And that would be to add another stage at the beginning of the model where banks actually choose their sovereign exposures. Right? So essentially banks would wake up, they would look at the network position, they anticipate the government's bailout choice at the end, and then they would choose their sovereign bond holdings accordingly. And a model like that would, of course, open up the possibility of thinking about capital regulation, and especially capital regulation in proportion and in relation to sovereign bond exposures. right? So maybe there's an efficiency in an inefficiency in that model that we could correct by using appropriate capital regulation. Then the second point would be, you mentioned that we only talk about flat out bailouts and we don't consider other ways to resolve the banking crisis. That's correct. For a bit broader and very smart discussion of alternative ways to resolve banking crisis, still in a network setting, I can highly recommend the paper that my two co-authors, Agostino and Joe, have with a third co-author, with Benjamin Bernard. In their model, they don't consider bailouts, but they consider optimal bail-ins that the government proposes. So the government would propose healthy banks to take some losses in order to avoid the big crisis that would hit everyone, right? And the paper is all about credible resolutions for that. That's a very smart paper as well. Yes, and then the third point, you mentioned this additional type of contagion that could be that could happen, liquidity contagion, and it's true we don't have that in our paper. Still, I think our paper nicely combines two different versions of contagion, namely not just the direct contagion from liability exposures that you have, right, the typical default contagion, but also there's this new channel of contagion through sovereign bond holdings, where banks are actually, not even responsible for the drop, but it's the government with its bailout that governs that type of contagion. So thanks again. I'll stop here and let Aluna and George talk.
George, do you want to respond first, or?
Sure. Thank you so much, Anjan, for the great comments. The interaction with the capital ratio is definitely something that I think is very interesting. I haven't looked into it, but I think it is very interesting in how banks at very different capital ratios can maybe change and be different in how they respond to the pricing. Thank you.
Well, thank you very much, for Anjan, for those, a summarization, and also the connection between all our papers, and also giving me some guidance on the theoretical debates, as well as some of the additional results, because that's exactly what I'm looking for when I submit the paper to FDIC. So actually when I was preparing for the presentation, I start to have this more clear view about, this asset-centric versus liability-centric tension. I do want to see that, how this BHC exits would affect their capital position and also their payout policies, to see if we do see two mechanisms working, the benefits of the monitoring benefits of the bank transparency, and the benefits of making the banks more capable of producing safe liquidity. If I do see a reduced capital and some changes in payout policies, probably that means that two mechanisms both exist. It's just like in this setting, and the liability-centric view, this mechanism is more prominent than not at all. So if I could show that, then my conjecture would be more clear. And also, I really appreciate that you draw my attention to this strategic disclosure mechanism. I'm looking forward to reading this paper to see if I can also do some work to accommodate and trying to explain if this alternative explanation also show up in this setting. Thank you very much.
Thanks. It looks like we have time for one question from the audience also. Leo, would you mind, you'll be unmuted and you can take us to the last question before break.
Yeah, thanks, John. First of all, thank you to all three presenters and the discussant for excellent, thought-provoking, stimulating stuff here. My question is actually for George. First of all, thank you for introducing me to this really interesting experiment. I wasn't aware of it. I'm wondering if the experimental setting you have allows you to do something even more, or maybe not. I'm wondering if you can speak anything about the level of the pricing, right? So what I think you've established is that risk-based deposit insurance pricing works at getting banks to reduce risk, but is there any way of telling whether, you know, it's just at the level where it reduces risk to an optimal amount, or whether maybe a little less costly pricing would reduce risk less to a more optimal amount, or whether more costly pricing would reduce risk more to an optimal amount, something like that? Does that make sense?
Yes, thank you. Thank you for the question. That's a tough question because understanding almost everything that I show in the paper is relative. Now we do have some effects looking at the absolute magnitudes in terms of profitability. It could be difficult to really, you know, say this is what the level should be. It's hard to get that from the experiment, especially because in different settings, different countries, different institutions, like I said in the presentation, there are always second order effects. So to the extent that some of those effects can counteract some of the premium effects on profitability, it's difficult to know what the right level again should be. We can have some ideas, but it's difficult to really say, you know, it should be, you know, like 23 basis points or something like that.
All right. Thank you, George. Thank you, presenters. We are going to take a short break now, and we'll return at 11:10.
All right, everybody. I'd like to welcome everybody to the second paper session of the day. The title is Deposits. We have three loosely connected papers that all have deposits in common. And with that, I'm going to turn it over to our first speaker, who's Haoxin Jing from Peking University, to talk about dynamic banking and non-maturing deposits. It's all yours.
Thanks. Can you hear me well?
Yes, sir.
Yeah. Okay, I would like to first thank the organizers to put the paper in the program. So in this paper, we really try to reflect on a key assumption that people usually have in a typical macro banking or microfinance model, is that in a typical microfinance model, the bank deposits are modeled as one period debt. But as we look at the data, it's like, this is the statistics we have at the end of 2019, more than 80% of US bank deposits actually are non-maturing. So to be specific, what we mean by non-maturing is that there's no explicit maturity date on this instrument, and bank deposits are usually not withdrawn for extended periods. So in this paper, we're trying to study this simple modeling assumption, how this is going to mean for some major policy questions. And we're going to try to convince you that modeling deposit maturity in a reasonable way is going to deliver novel insights on the transmission of monetary policy shocks to banks, as well as our understanding of the optimal capital regulation. So basically, what we do in this paper is that we provide a dynamic model of defaultable debt with endogenous maturity. So how we generate endogenous maturity is to model depositors' withdrawal decisions optimally. So depositors in our model, in a very brief description, that they are going to receive liquidity shocks every period. So they are going to decide whether to withdraw their piece of deposits at the period end by balancing between the current period liquidity as well as against the present value of future liquidity value, which will adjust the default risk of the banks. So what this means is that when some depositors do not withdraw their deposits at the end of the period, the deposit effectively becomes long-term debt. So they are no longer one-period debt where all the depositors rush to the bank at the period end, they take all their money out, and then they reprice everything. So when some depositors do not take their money out from the banks, then we have this classic dilution problem. So what do we mean exactly is that there's a way to increase equity value by keep issuing more deposits. Because by keep issuing more deposits, the banks basically get more liquidity values. They can extract the liquidity value from depositors, but they do not fully bear the negative consequence of this because there are some existing deposit holders these legacy depositors on the bank's balance sheet, they are going to be the one who bear part of the default losses. So this is the dilution problem. That's the key mechanism in our paper, where we start to model the long-term nature of deposits. And another important feature when we start to model the endogenous withdrawal is that the deposit maturity actually start to become time varying. So when there are some some shocks to the market conditions, then this is going to endogenously shape depositors' withdrawal decisions. And that basically effectively lengthens or shortens the deposit maturities along the business cycles. So to give you some preview of the results, so in the first part of the paper, we study the transmission of monetary policy shocks to banks, where we find if the regulator cut the interest rates, that's actually going to produce a delayed increase in bank risk. So what happened is that when the interest rates start to be cut, then the depositors are not going to withdraw that aggressively. So there's going to be more and more depositors who put their money in the bank. And what this is going to mean is that the bank equity holders, they now have a larger amount of legacy deposits sitting on the bank's balance sheet. And this is going to exacerbate their dilution problems. So they are really going to keep issuing the new deposits. So that means going to tomorrow, when the interest rate goes back to normal, the banks are left with a large amount of deposits on the balance sheet. And this is really going to increase the bank risk going forward. So effectively, what we have is a boom-bust dynamics in default probabilities. When the government cut the interest rate, everything's fantastic on the spot. So the default probability of the bank is going to go down right upon the interest rate cut. But moving to tomorrow or in the future, there's actually going to be an increase in the bank's risk, exactly because now their dilution problem becomes so severe. And because I don't have too much time to talk about this today, I will also show that the boom-bust dynamics has some kind of state dependency. So in an environment where the government has brought down the interest rate to a low level, the banks accumulate a large amount of deposits on the balance sheet. And that means the sensitivity of bank default risk with respect to the interest rate adjustments is actually going to be more severe. So this really calls for regulators' attention that when they start to lower down the interest rate in a low rate environment like today, or like in the situation in 2007. So we really show there's a state dependency that the government needs to be careful when they start to bring down the interest rate. So in the second part of the paper, we study the optimal capital regulation. Because we have this bank's dilution incentive, this naturally gives room to capital regulation. So we don't need deposit insurance. We don't need all these sort of exogenous frictions, because the banks, if they can, they will keep issuing deposits, because this basically screw up the legacy depositors. So the government can create value by stepping and tell the banks, okay, now you can no longer issue more deposits, and I'm just going to stop your dilution. So this is where we start to kind of rationalize why there's capital regulation in our model. But an important result we want to highlight is that the optimal capital regulation is actually time inconsistent. So there's a Ramsey regulator who can commit to a state contingent path of capital requirements, will use future promises to affect today. Where macro perfect regulators, they cannot promise to banks today what he is going to choose for the capital requirements tomorrow. So we compare the macro perfect regulator without any commitment in capital requirements against a Ramsey regulator with full commitment to capital requirements. We find actually interestingly that the Ramsey regulator with commitment is actually going to allow a higher leverage and actually to allow more defaults. Because by allowing more defaults, the total banking sector is generating a really large amount of liquidity value, which basically increases the total welfare of the economy. And when we think about the deleveraging of an indebted economy, we actually find that the Ramsey regulator does not delever an indebted economy more slowly compared to a Ramsey regulator, even though people generally think that commitment solution means more persistent. We find this is not the case when we experiment with a regulator who are, for example, in 2010, the economy has a very high leverage, what the regulator would do. But we do find there's more persistence in terms of cyclicality property of capital requirements when the regulator have commitment. So the Ramsey regulator is going to lose in capital requirements for a longer time after a bad productive shock, where the macro perfect regulator do not. Basically, what happens in the model is that today there's a crisis. What the Ramsey regulator will tell the banks is to say that, okay, moving to tomorrow, I'm going to allow you to issue a large amount of deposits. I'm going to allow you to dilute the uninsured depositors, because that's the time where the government is really trying to persuade the banks to not default, which is extremely helpful in the crisis where there's a large productivity shock. If the regulator do not have commitment, he cannot do this, because moving to tomorrow, it's no longer beneficial for the regulators to say, okay, banks, you can dilute. So this is where the commitment really matters. So we have some results in the paper. I'm not going to talk about them being very specific today, given the time. Is that we also experiment with regulators with partial commitment, and we are showing that a regulator with partial commitment, a regulator between the Markov Parfait and the Ramsey, actually can achieve a pretty good results, which kind of similar to the Ramsey solution. So that's there in the paper. So given the time, I'm not going to talk about the literature. Let me just get right into the model. So the key feature we have in the model is that there's a withdrawal decision of the depositors. So the model is fairly simple. It's infinite horizon. Everyone's risk neutral. The banks provide liquidity services to depositors, which will have two parts. The first part is that there's a constant proportional utility value where depositors get, which you can think about this as a transaction value, like Gordon and Bernanke style, like liquidity specification. In each period, there's going to be a liquidity shock where the depositors is going to get a liquidity value new by withdrawing, which follows some kind of distribution, but the depositors has to pay a withdrawal cost kappa if they choose to withdraw. So the depositor I is going to withdraw his deposits when he get the face value times the net liquidity value is larger than the market value of deposits, where the market value of deposits is basically the market value of future liquidity values as well as the principals the depositors can get if he do not withdraw the money today from the bank. So this is the optimal withdrawal decision. What this means is that there's going to be an endogenous liquidity value, which consists of a fixed amount of transaction liquidity as well as the liquidity they get if they get a large liquidity shock new above the optimal withdrawal cutoff when we integrate over the region. And the deposit maturity, that's where this time varying maturity comes, is that only those people where the new is above this Q plus kappa minus 1 cutoff are going to withdraw. So what this means is that if there's some kind of macroeconomic shocks, like the interest rate shock we're going to talk about, that moves Q, that's really going to change the maturity structures, which basically, if you think about the Q increase, then this whole thing drops, then basically means that this lambda is going to be time varying. So the other part of the model is actually pretty standard to the other papers where we model the debt dilution. So the banks, they have the asset productivity, which has a persistent component as well as the IID component. So there's going to be a time varying interest rate in the first part of the paper, where the bank's problem, they just maximize the total equity value by choosing the amount of deposits they would like to issue every period. Where this is subject to the depositors' pricing problem, in the sense that the depositors, you have to make them break even, because otherwise they are not going to put their money in the bank in the first place. So there's a standard zero profit condition for the depositors, where the market value they get from the deposits equals the future value, where in some region they get the liquidity value plus the principal if they withdraw, and in some region where the bank basically defaults and there's a default cost. So that's like the setup of the model. So again, besides the endogenous withdrawal decisions I mentioned in the beginning, the other things are pretty standard. So to give you a sense of what's happening here, so this is basically the first order condition of the bankers under a fixed maturity lambda. So suppose we shut down the time varying maturity structure. On the left hand side is the marginal increase in the liquidity value. By issuing one piece of deposits more, the banks is able to extract an extra units of liquidity value. Where on the right-hand side is the price impact, because when I start to issue more deposits, this push up the default risk of the bank. So I need to bear the default cost. But the problem is that if the debt is long-term, then he's not going to fully bear the negative consequence. He will only internalize the negative consequence on the new amounts of debt that's issued. So when there are more legacy deposits that are not withdrawn, then there's a huge gap between fully internalizing the price impact and what the laissez-faire banks are going to do. So this first order condition, what's interesting here is that if the maturity is fixed, if lambda hat is fixed, even if it's greater than 1, even if it's fixed long-term debt model, when the government starts to shock the interest rate R, nothing is going to change because the interest rate shows up on both sides of the first order condition. So basically, we scale up the liquidity value and the expected default cost at the same time. So nothing is going to happen. But when we start to model the endogenous withdrawal decisions, when the government starts to shock the interest rate, that's going to change how many depositors are going to withdraw. Then this first order condition changes. So what happens is that when the government says, okay, I'm going to cut the interest rate, then the present value of liquidity that the depositor is going to receive is actually going to increase. Then more of them are going to choose not to withdraw. This means in the first order condition, the banks are making decisions with a larger amount of legacy deposits, and that's the reason why they have a larger problem in terms of debt dilution. So we have this IID shock case where we show that when the government have a one-time shock to the interest rate, then the number of depositors who withdraw drops, and that means tomorrow the banks actually going to have a larger amount of deposits, exactly because now I have more uninsured legacy deposits on my balance sheet. So this is the boom-bust feature of boom-bust dynamics of the default risk. So right on the spot, cutting interest rate is a good news for the bank. But going to tomorrow, this debt dilution mechanism start to kick in, and then there's going to be a spike up in the default probability of the bank. So we also have in the paper the precision shock case. So I will not show you given the time constraint. So this is a state dependence. I've already described the results. That basically we find that the boom-bust dynamics is actually severe in a low rate environment where the government brings interest on time, and now I'm going to cut the interest rate by 1%. That's going to up the probability more in the environment, compared to environments where the interest rate is at a very high level. The paper is about optimal capital regulation. And as I said, that because of the dilution incentive, it's very natural for the government to step in and say, okay, now you want to dilute by issuing more uninsured deposits. I'm going to stop you. So the capital regulation controls the leverage accounting for the legacy deposits. But they are going to take the bank's default decision as given. So banks are going to optimally default ex post. The depositors are going to withdraw optimally every period. And the government's capital regulation need to satisfy the deposit pricing problem where we need to make the depositors break even. Otherwise, they are not going to give the money to the bank. So this is the Ramsey regulator. Yes. So this is the Ramsey regulator's problem. So the Ramsey regulator basically chooses a state contingent path for the amount of deposits in the economy to maximize the total resources, which consists of 3 parts. The first part is the asset returns that the bank get from the lendings, and the liquidity value the banks produce to the economy, which is the liquidity times the amount of bank liabilities, deposits in our case, minus the default cost, which is proportional to basically we incur a loss for the massive banks who choose to default, subject to all these set of constraints, where we can basically split the Ramsey problem into 2 parts, where the Ramsey selects this V, which is the value to bank equity holders, and Q, which is the deposit price, to maximize this H star, where H star is basically what's going forward. So why we want to split them these 2? Because the first part of the problem we can actually solve in a recursive way. So this is basically what we do. We follow this Keaton and Prescott promise utility approach, where each period the Ramsey regulator, given the asset productivity, the amount of deposits, and the pre-committed equity value, the bank's equity market valuation, as well as a pre-committed default price. And now the Ramsey regulators start to make the decision. They choose the amount of deposits, they choose a state contingent promised equity value to banks, and a state contingent promised deposit price to depositors to maximize the total resources. So this is basically the Ramsey regulators problem we solve in the paper, where we can easily show what the Markov-Perfit regulators look like. Is that we just take out the promised utilities, because the Markov-Perfit regulator cannot commit. And that's the reason why they cannot use the state contingent promised values to affect the equilibrium choices going forward. Each period, the Markov-Perfit regulator can only pick the amount of deposits going forward, rather than he can use this VE and Q as a function of tomorrow's states. So if you compare this Markov-Perfit regulators and the Ramsey regulators problem I showed you in the previous slide, as I said, it's just that the Ramsey regulator can use promises. that what I will do tomorrow, the day after tomorrow about capital requirements, where the market perfect regulator cannot do this. And if we compare the market perfect regulator and the laissez-faire case, then by doing some simple manipulation of the equations, then you can see that the difference between the market perfect regulator is exactly that the market perfect regulator is going to care about the uninsured legacy depositors. And that's where the dilution comes in. So the market perfect regulator can really create value by killing the dilution, but he cannot do as well as a Ramsey regulator because he cannot use future promises. So we also consider this partial commit case, which I don't have the time to talk about. So this table basically shows that steady state are quite different if we compare a market perfect regulator MP and the Ramsey regulator. The Ramsey regulator is going to have a much larger amount of deposits B, and the default probability is actually higher in a regulator with commitment compared to a regulator without commitment. And the benefit of allowing more deposits and more defaults is that the liquidity value is going to be larger, and that basically increases the total amount of liquidity values. So the second exercise I mentioned, we just do the deleveraging exercise. Suppose today the market perfect, all the regulators start with a large amount of uninsured deposits. What the regulator will do to reduce the total leverage of the economy. We basically find that these two lines with colors, that they're not going to be that different. Both Ramsey as well as a market perfect regulator are going to delever the economy very quickly. But they are going to be different when we think about the cyclicality property of capital requirements. So here we start to give the economy an IID shock. Then both regulators are going to increase the amount of deposits because that's the way to persuade banks not to default. I'm going to allow you to dilute, but Ramsey regulator can allow dilution even tomorrow. After the economy goes through the crisis, the Ramsey regulator is going to allow dilution because that's very effective in the time of a crisis where to persuade banks not to default, because if you don't default today, you can just wait and just enjoy a good benefit tomorrow. So I will just conclude by giving you a brief extension that in the paper we have an extension with insured deposits. And we show that if the banks can actually issue insured deposits, that's not going to weaken our dilution incentive. We actually in the paper show that if they can issue insured deposits, use insured deposits to dilute, the boom bust feature in default probability is actually going to be larger in our laissez-faire case, because it's not the case that the dilution is only there with uninsured deposits. They can actually increase the dilution problem with the insured deposits. So I will end here. Thanks.
All right, well, let's move on to the next paper. David Bauthier is going to talk about bank leverage and bank disclosures. So, David, it's all yours.
Thank you, Ned. And let me just start by thanking you and the organizers for including this paper in the conference. It's really a great pleasure to be here. Of course, it would have been nice to be all together in Washington, but considering the circumstances, unfortunately, it was not possible. And I have to say that for a virtual conference, this is really, the organization is excellent. So I know it's very difficult to do. So thank you to all of you for organizing this. So I'll be presenting today a paper, The Leverage Effect of Bank Disclosures, which is co-authored with Philipp Koenig and Christian Laux, who's at WU Vienna. And since Philipp is at the Bundesbank in Frankfurt, I have to, the usual disclaimer applies, so none of these views and results that I'll be presenting today represent the views of the Bundesbank. So that being said, let me just get started, since I don't have that much time. It's going the wrong way. Here we go. So this paper is based on trying to understand the consequences of disclosure requirements for banks. So disclosure requirements now for several years have been a cornerstone of bank regulation. A good example of this was the introduction of Pillar 3 into the Basel II Accords in 2004, which made mandatory disclosure requirements obligatory for banks. And at the time of its launching, actually a few years before Pillar 3 was introduced, the Basel Committee was already talking about the importance of disclosure requirements, and their underlying logic that pushed them to actually include this into the Accord was that by forcing banks to disclose information, the market was going to require a higher rate of return from funds, or was going to require a higher return for funds that are invested in riskier banks. And this is going to actually force banks through a corporate governance channel to make better risk-taking decisions. In short, the idea underlying Pillar 3, I think it's safe to say, is that disclosure requirements promote market discipline and thereby tend to reduce banks' risk-taking incentives. So what we do in this paper is try to think about the consequences of disclosure requirements for banks' capital structure. So generally, the market discipline story I was just mentioning to you on the previous slide takes banks' capital structure as given. And what we do in this paper is that we consider jointly how disclosure requirements affect, on the one side, banks' risk-taking incentives, and as well as their leverage decisions or how they finance themselves. And what we find is that the direct market disciplining channel, which underlies most of the policy debate until today with regards to the importance of disclosure requirements, is offset by a leverage effect of bank disclosures. And because of this higher leverage, disclosures can actually lead banks to take on more rather than less risk, so undoing some of the presumable positive aspects of bank disclosures. So just to link this very quickly to Luna's presentation in the previous session, the cost of disclosure, the cost of transparency, which we highlight in our paper, is very different from the general cost that's already been discussed in the literature, which looks more at kind of the consequences of Hirschleifer effects and risk sharing, or the effects of disclosure on risk sharing. So this is going to be completely absent from what I'm going to tell you today. To give you just a quick preview of the results, basically what we find is that bank disclosures have two effects on risk-taking and on leverage. So the first direct market discipline effect of bank disclosures goes very much in line with this logic of the quote from the BCBS that I highlighted on the first slide, which is for given leverage, banks' external funding costs are going to become more responsive to banks' risk when information about their investments is disclosed. In other words, disclosure is going to lower the agency cost of uninsured debt, and this is going to promote better risk-taking incentives. This channel is going to be offset by a leverage effect, which is coming precisely because by disclosing information and lowering the agency cost of debt, this is going to push banks endogenously to increase their leverage. And what's interesting about this result, well, let me just highlight two features. So one is to understand a bit better as to why leverage increases when information is disclosed. In the context of our paper, this is going to come about because disclosure is going to allow short-term debt withdrawals in bad states of the world, so uninsured short-term debt withdrawals, which is going to circumvent the seniority of insured deposits. So this is a bit the opposite channel of what was being mentioned in the previous paper. And what this is going to do is that it's going to create a cost advantage of short-term debt over equity financing. So it's going to incentivize banks to increase their leverage. And importantly, this increase in leverage is also going to have an effect on banks' risk-taking incentives. In particular, you can kind of think of this dilution of insured deposits as a way to ratchet up the deposit insurance subsidy that's inherent to the existence of insured deposits on banks' balance sheets. And this, much akin to an increase in the supply of insured deposits, is going to lead banks to take on more risk. So that's for the key results. Let me just give you briefly an outline of what I'm going to talk about today. I'll give you a very brief sketch of the model because of the time constraints, I don't have time to go too much in detail. And then we're going to look at basically two different environments. One, the effect of bank disclosures when leverage is fixed, and the other one where banks can actually endogenously choose their capital structure. And then I'll just briefly conclude with one slide. So for the model environment, it's a very stylized model, so kind of a standard 3-period banking model with risk-neutral agents, zero risk-free rate, et cetera, et cetera. And basically, there's going to be a bank that's going to provide loans to borrowers in t=0, and in exchange, obtain a promised repayment from these loans, which are going to mature in period t=2. So these loan portfolios are going to differ in terms of their quality. In particular, we consider two different qualities of loan portfolios, a high quality and a low quality, where the high quality first order stochastic dominant dominates the low quality portfolio. To simplify things for the sake of this presentation, you can consider the low quality portfolio as being one that always generates the lowest possible return. So this is just going to make the exposition easier. Importantly, the probability that the bank's loan portfolio is high quality is going to be an endogenous object. It can be one of two values, a high probability or low probability. So you can think of this as being a good bank or a bad bank. And the bank's type is going to depend on, for instance, the monitoring effort that the bank exerts at the beginning when it actually originates its loan portfolio. So the probability that the loan portfolio is a good quality is going to be monotonically increasing in the bank's monitoring effort. Now, for the liability side, on one side, or one part of the bank's liabilities is going to constitute of insured deposits. Importantly, we're going to imagine that these are actually in limited supply. So you can think of there being an inelastic supply of insured deposits and thereby a limit to how many insured deposits the bank can issue. And hence, in order to actually finance this portfolio, whose size is going to be normalized to 1, the bank is going to have to raise additional financing. And we consider the case where they can either issue wholesale debt, so uninsured debt, or equity. We're going to make the following parametric assumption, which basically implies that given low return on the portfolio, the bank is always going to default, so that the return from these investments is going to be less than the face value of the deposits. But importantly, is going to be greater than the residual financing need that the bank needs in order to originate the portfolio. And this is going to be extremely important because it's going to allow for this dilution channel of insured deposits. So what we have in mind here is basically that wholesale debt, short-term wholesale debt, by being withdrawn in bad states of the world, can actually circumvent the de jure seniority of insured deposits. In other words, wholesale creditors can front-run, let's say, resolution authorities in their ability to extract resources from banks in troubled times. So in case wholesale debt is not rolled over, the bank is going to sell some shares of its loan portfolio and use these proceeds to pay back the creditors. And only afterwards is the resolution authority going to be able to intervene and close down the bank. So in effect, this is going to create a cost advantage of wholesale debt for equity, because wholesale debt will be an instrument through which the bank can actually dilute a part of the insured deposits that it has on its balance sheet. As far as the information structure, we consider basically the following environment where market participants are going to receive 2 different types of information. One is going to be a perfectly revealing signal about the future loan repayments of the loan portfolios that the bank is investing in. And the other one, depending on the disclosure regime, will be about the bank's type, so basically the quality of the loan portfolio. So with regards to the first signal, you can think about this as representing general market information, macroeconomic indicators like GDP growth and unemployment, which gives creditors and investors some idea of what the profitability of the investment projects that are available in the economy. The second one, so the information about the bank's type, we really think this as being tied to regulatory disclosures. And we're basically going to consider 2 environments. One in which the bank's type is not going to be disclosed. So we consider this the case of opacity or the absence of bank disclosures. And another one in which the bank's type, this Q parameter, will be made available to the public and be used in the pricing of debt. And we're going to call this the transparency case. To just give you a brief overview of the timing of the model, what we have here is that in period 0, there's going to be this disclosure regime which will be in place. The bank is going to choose its risk or its monitoring effort and its capital structure, so this choice between wholesale debt and equity. In the interim period, depending on the information regime, there's going to be signals that will be disclosed to market participants. Wholesale creditors are going to decide whether or not to roll over or to withdraw. And in case the bank is, or the creditors decide to withdraw, the bank is going to be closed and the depositors are going to be made whole by a deposit insurance fund. And in the last period, in case the debt is rolled over, the loans are going to be maturing and everybody's going to be paid out based on their de jure seniority, so insured depositors first. So let me start with this case with fixed leverage, which is kind of the baseline case. You can think about this as an environment where banks are facing a binding capital requirement and can't adjust their leverage in response to changes in disclosure policy. So here we get this very intuitive result that for any given fixed leverage, increasing disclosure is going to lead banks to exert more effort, or in other words, take on less risk in our model. So what's going on here? Well, basically, debt financing, as in kind of the standard Jensen and Mecklin approach, is going to create a debt overhang problem, which is going to lower the bank's monitoring effort. Bank disclosure is going to help this by eliminating the agency cost of wholesale debt. And effectively what's going on here is that the funding costs of banks are going to be higher if the bad signal is disclosed compared to the good signal. And because of this, a bank that's ends up being good, so ends up having a high quality loan portfolio, is going to have higher profits than one which is a bad type. And precisely this wedge in profits is what's going to incentivize the bank to increase its monitoring effort. Graphically, it's relatively easy to represent this. We can plot the effort functions or the monitoring effort of the bank with respect to its leverage D. And for a given leverage, basically disclosing information is going to lead to this jump from the lightly gray colored curve to the darkly gray colored curve, representing this increase in market discipline, which is leading the bank to increase its monitoring effort. Now, the next step is actually allowing the bank to optimize over its capital structure and not only its effort decision. So the first result is looking at the case without bank disclosures. So it's a passive case. So in the absence of bank disclosures, the optimal capital structure is going to be the following. That the bank is, of course, going to issue as much insured deposits as possible. Them being insured means that they're going to be a relatively cheap source of financing because they don't have to be compensated for risk. And it's going to issue a positive amount of wholesale debt and may also issue a positive amount of equity. So the amount of wholesale debt is going to be bounded between 0 and its maximal residual funding need. So what's the intuition behind this result, as I was mentioning before, is that information about macroeconomic or general economic conditions is going to allow wholesale creditors to index their rollover decision based on the future loan repayments of the bank. And in low payoff states, the wholesale creditors are going to have an incentive to withdraw, because by doing so, they can be repaid using the liquidation proceeds of the bank's portfolio. This is going to circumvent the seniority of insured deposits, and this dilution of depositors is going to make wholesale debt cheaper compared to the equity for the bank. In effect, the wholesale debt market in our model is competitive, so the ultimate beneficiary of the dilution of insured deposits through these withdrawals is going to be bank shareholders. And so because of this, in the absence of disclosure, what we find is that the optimal leverage decision is going to balance, on one side, the agency cost of wholesale debt, which is coming from the fact that the market is opaque, and these dilution benefits that are stemming from the short-term debt withdrawals in bad states of the world. Once we disclose, things are going to be slightly different. In this case, the disclosure, just like in the case with fixed leverage, is going to eliminate the agency cost of wholesale debt. And as a result of this, the bank is going to finance itself entirely with insured deposits, again, which are the cheapest source of financing, and all of the residual financing is going to come from wholesale debt. In effect, the absence of agency cost is removing the endogenous constraint that was incentivizing the bank to actually limit its leverage in the absence of disclosure. So that's the first result with regards to the capital structure. This also has important implications for risk-taking. So this is, if you wish, the key contribution of our paper is that we can show that the increase in leverage that is coming from the disclosure of information is actually going to lead banks to take on more risk, or at least increase its risk relative to the case where it can't adjust its leverage. So again, what are the two channels going on? The first one is linked to the market discipline effect that I was mentioning to you a few slides ago, which is for given leverage, the elimination of the agency cost of wholesale debt is going to ameliorate the bank's risk-taking incentives and lead it to increase its effort or monitoring effort at origination. This is going to be offset by the fact that given a transparent market, the bank is going to increase its leverage, and this increase in leverage is actually going to reduce the bank's effort at origination. So why does short-term debt financing reduce monitoring effort despite the fact that transparency or the disclosure information provides market discipline? So this is really coming from the fact that the dilution of insured deposits coming from the withdrawals in low payoff states is going to create an externality that's going to distort the bank's risk-taking incentives. You can think of this as basically the dilution of depositors as being a wealth transfer from the deposit insurance fund to bank shareholders. Again, the short-term debt in our model is fairly priced and the market is competitive, which means that the ultimate beneficiary of this dilution is going to be shareholders. This is going to have, as a consequence, a ratcheting up of the implicit subsidy that's provided by deposit insurance, much like as if the bank could actually increase the supply of insured deposits to start out with. And because a bad bank is going to be less likely to roll over its short-term debt in the interim period compared to a good bank, the bad bank is going to benefit more from this dilution subsidy. And precisely because of that, it's going to reduce the wedge that exists between a good bank and a bad bank's profits, and hence reduce its monitoring incentives. Probably the best way Thank you. Probably the best way of looking at this is through some type of graphical illustration. So this is just representing the same graph I showed you before, but where I'm also going to take into consideration the endogenous leverage response. So again, if we start with a bank that has a fixed amount of wholesale debt and we disclose information, the market discipline that's provided from this is going to increase its monitoring effort. But the absence of agency cost is going to lead the bank to want to increase its leverage. So it's going to induce a movement along the gray curve, the lightly gray curve here. So in this particular example, I show you one where the direct market discipline effect dominates the leverage effect. So in this case, disclosures will ultimately lead to improved risk-taking incentives by the bank. Whereas in the second example that I have on the next slide, the opposite result takes place. So in this case, where the actual leverage before disclosures is relatively low, the leverage effect is going to dominate the direct effect. And we show in the paper basically which of these two effects dominates fundamentally depends on how much leverage the bank issues or how much short-term debt the bank issues in the absence of disclosures. Let me, since I only have 2 minutes left, briefly conclude. So what we do in this paper is that we provide a model of capital structure and risk-taking incentives to study the effect of disclosure and market discipline. And we show basically that the optimal capital structure of the bank trades off dilution benefits of short-term debt with their agency costs. The key insight is that disclosures increase leverage and have potentially an ambiguous effect on risk, because while for given leverage, lower agency cost leads to less risk-taking, lower leverage allows banks to increase, more disclosure allows banks to increase their leverage, and the dilution of insured deposits that is induced by this leads to more risk-taking. And in the paper, we also talk a bit about policy implications. So one ties back to a comment that Anjan gave in his previous discussion. So in our view, it's important to kind of think about disclosure requirements and capital requirements jointly, because it seems that the effect of disclosures fundamentally depends on banks' ability to adjust their leverage. And the second one ties a bit back to George's presentation for the first presentation, is that this negative externality that I was mentioning coming from the dilution can be addressed through an appropriate pricing of deposit insurance premia. And actually our results go in line with recent reforms that were launched under the Dodd-Frank Act, for instance, the United States, which forced, for instance, the FDIC to review the way it constructs its assessments and to take into account total leverage rather than just the deposit base in calculating these premium. So on that note, I thank you very much for your attention, and I look forward to the comments.
All right, we're going to move to the last paper of the session. Thank you, David. The next paper is by Shohini Kundu from UCLA, who's going to talk about economic effects from the deposit channel. So Shohini, it's all yours.
Okay, great. If you could give me permission to share my slides, that would be helpful. Okay, great. I hope everyone can see. So thank you everyone for joining me. My name is Shohini Kundu, and today I'm presenting the deposits channel of aggregate fluctuations. This paper is joint work with Songjin Park and Nishant Vats, who are 2 PhD students at the University of Chicago. So the motivation for this paper comes from the simplified diagram of a bank's balance sheet. In this simplified diagram, a bank's assets consist of various types of loans, securities, and other assets, and these long-term illiquid assets are financed by the bank with liquid liabilities, primarily in the form of demand deposits. Now, this liquidity transformation is critical for financing long-term illiquid assets, but it's also a key source of vulnerability for banks in the economy. In this paper, we introduce a new source of financial fragility, which is the geography of bank deposits. We posit that the geography of banking assets and liabilities can make the economy on aggregate more susceptible to idiosyncratic shocks. Banks collect deposits across geographies and then allocate it towards lending activity. So concretely, loans in LA might be financed by deposits in DC. And so local shocks to bank deposits in DC can transmit to distant areas. This problem is aggravated if bank deposits exhibit geographic concentration. And so this paper empirically tests this proposition and documents that local exogenous shocks in areas where bank deposits are concentrated can explain aggregate fluctuations. And that's what we refer to as the deposits channel. So the research question that we ask in this paper is, can local deposit shocks account for aggregate fluctuations? Now, the classical economics answer is no. Idiosyncratic shocks cannot account for aggregate fluctuations, as implied by the central limit theorem. But two recently developed lines of inquiry in macroeconomics challenge this view. So the first is the granular hypothesis of Gebek's 2011, in which he argues that when economic activity exhibits fat tails in finite samples, the central limit theorem breaks down. And the second hypothesis comes from Asimoglu, Carvalho, Ozdaglar, and Tabassalehi, in which they argue that idiosyncratic shocks are amplified in the presence of network structures. Now, this paper combines both of these theories, and we argue that bank deposits are geographically concentrated, exhibiting fat tails, and bank internal capital markets provide a mechanism for the transmission of idiosyncratic shocks into aggregate fluctuations. And this occurs primarily through the network structure. So the end objective of this paper is to study the mechanism through which the geography of bank deposits and idiosyncratic shocks can explain aggregate fluctuations. And so we have four key findings. The first is that we introduce a new fact, which is that bank deposits are geographically concentrated. Specifically, we find that 30% of bank deposits come from a single county. Second, we construct novel bank-specific idiosyncratic shocks by combining this geographic concentration of bank deposits with local natural disaster-induced property damages. Third is our key finding that these idiosyncratic deposit shocks can explain aggregate fluctuations. And the transmission of local disaster shocks to aggregate fluctuations occurs through the deposits channel, which negatively affects bank lending. And then fourth, we show that financial frictions, such as bank capital constraints, informational advantages, borrower constraints, and the stickiness of relationships are critical for the transmission of idiosyncratic shocks into aggregate fluctuations. Okay, so the first fact is that bank deposits are geographically concentrated. Note that this is the within bank concentration of deposits and not the within county concentration of deposits. So using summary of deposits data from the FDIC, we identify the share of deposits coming from each county for each bank. So let me be clear about how this figure is constructed. We take a bank like PNC Bank, and we look at the counties where PNC raises deposits from, and we rank those counties. So the x-axis refers to the county number. County number 1 refers to the county in which the bank raised the greatest amount of deposits. County number 2 refers to the county in which the bank raised the second greatest amount of deposits, and so on. And on the y-axis, we're plotting the share of deposits. So here we have three lines. The blue line shows the simple average of the share of deposits in each county across all banks. The red line shows the weighted average, in which we weight by total assets of each bank. And the green line reports the regression margins associated with each county number after controlling for bank cross-year and county cross-year fixed effects. And regardless of the methodology, we find that the largest deposit county accounts for almost 30% of bank deposits. And then we do a battery of robustness tests, which show that the geographic concentration of bank deposits is not a new phenomenon. The deposit concentration is neither driven by the smallest of banks, nor the largest of banks, nor are they driven by online banks. The concentration doesn't vary across percentiles of bank characteristics, including percentile of deposits, liabilities, equities, and loans. And the largest deposit county is scattered across the United States, which shows that certain counties are the largest deposit counties for several banks. So next, we switch gears and we look at how disasters affect aggregate deposit growth by studying the immediate and long-run effects. We show that local natural disasters negatively affect bank deposits both in the short run and in the long run. And we identify these county-level shocks using local natural disaster-induced property damages for each county. So just to give you a sense of the scale and the scope of the disasters, here we've tabulated some statistics related to damages that occur from different types of natural disasters. And you can see that there's a wide range of disasters that destroy property. Some events are very frequent, like wind and severe storms, Others are far less frequent, like volcanoes and earthquakes. So the main finding here is that a 1 standard deviation shock is associated with a 0.1 to 0.3 percentage points decline in deposit growth. And this is comparable to the 25th percentile of deposit growth. And then in the long run, we find that there is a permanent decline in deposits in response to the disaster shock. So even 10 years after the initial shock occurs, we find that there is a decline in the level of deposit. So next, what we do is we construct bank-specific deposit shocks by weighting the county level disaster shocks, denoted by epsilon CT, by the deposit share of the bank in that county. And we establish two key properties of these shocks. The first property is that these shocks are idiosyncratic. And the second property is that these bank-specific shocks affect bank-level deposits and liquidity creation. So first, we show that bank characteristics can't predict the shocks in any robust way. We regress the shock on a multitude of bank-specific variables, including total assets, loans, equity, cash, deposits, hedging assets, dividends, and income, and we don't find any robust predictable patterns. In the univariate regressions, you can also see that the R-square is around 0, and so together we take this to mean that bank characteristics can't predict the shocks in any statistical or quantitative sense. Next, what we do is we plot the AR1 coefficient for the bank shocks and the kernel density for the pairwise R-square between banks. And we find that both of these kernel densities are centered around 0. So these shocks exhibit low persistence and low cross-bank correlation. And from this, we interpret the shocks as lacking spatial and temporal dynamics, which are two properties you might associate with idiosyncratic shocks. Then we show that these shocks are important because they can predict the aggregate bank level declines in deposits and liquidity creation. We run Jordan projections and find that a 1 standard deviation bank deposit shock results in an immediate decline of 0.97 percentage points in bank deposit growth. And this figure is 1.27 percentage points in liquidity creation. And you can see that these effects diminish starting 5 years after the initial shock. And so then we extract aggregate and granular shocks from these bank-specific shocks using the GIV methodology of Gebex and Koyen. We construct aggregate shocks by weighting the bank level shocks with their share of lending activity, and we then construct granular shocks by subtracting equal weighted disaster shocks from aggregate shocks to remove the effect of all common factors. And so intuitively, the granular shocks capture the idiosyncratic deposit growth of large banks after natural disasters. So next, we produce a time series plot of our aggregate deposit shocks. And we conduct a narrative analysis to ensure that the shocks don't just reflect noise, but rather reflect fundamental changes in the microeconomy of different regions. So you can see that our aggregate shocks coincide with major natural disasters. The largest is Hurricane Katrina, but there are also major floods and wildfires. And in doing our narrative analysis of the crests, we find that the disasters are geographically dispersed across states, and sometimes they coincide with other natural disasters that occurred in the same year. The aggregate shocks are also nicely correlated with the insurance payout associated with each event. So it shows that the shocks do reflect some fundamental changes that have occurred in the economy. So next, we investigate, can granular deposit shocks explain aggregate fluctuations? Specifically, we regress economic growth at time t on the granular shock at time t minus 1. And the estimate is negative and statistically significant. We find that a 1 standard deviation granular shock reduces economic growth by 0.06 percentage points. And that's the main result of the paper, that granular shocks can explain aggregate fluctuations. Next, we regress economic growth on several lags of the granular shocks, and we show that the granular shocks can explain 3.3% of their total variation in economic growth. Okay, but is this large? Is this small? How does this compare to other macroeconomic variables in explaining aggregate fluctuations? To answer this, we run a kitchen sink analysis by running a horse race between our shock and other popular macroeconomic variables, including oil shocks, monetary policy shocks, uncertainty shocks, the term spread, government expenditure shocks, and the Gebex granular residual. And we find that the granular shocks can explain as much variation as other macroeconomic variables that are used in the literature. We also find that the effect of the granular shocks is robust to controlling for other macroeconomic variables. So next, to tease out the mechanism, we conduct two Jorda projections to analyze the temporal dynamics of the effect. On the figure to the left, we conduct a Jorda projection of GDP growth on our granular shock. And on the figure to the right, we are conducting a Jorda projection of GDP growth directly on the disaster shock. And the reason why we do this is that a concern with our analysis so far is that our estimation may capture the direct effect of disasters on economic growth rather than the effect of idiosyncratic shocks. And so we address this by examining the long-run response of GDP growth on the aggregate disaster shocks, which we measure using total property damage. And we find that there's no statistically nor economically relevant direct effect of disasters on economic growth, which you can see on the figure to the right. So this lends credence to our main finding that the results are driven by idiosyncratic shocks to deposit growth. So next, to understand the magnitude of this effect, we convert our baseline estimate to units of deposit and lending growth. So we estimate a 2SLS specification in which we regress deposit growth on the granular deposit shocks in the first stage, and then we use the predicted values of deposit growth from the first stage to identify the deposit elasticity of economic growth in the second stage. And we repeat this exercise with lending growth to identify the loan supply elasticity of economic growth. Our estimate for the deposit elasticity of economic growth is 0.87. And so the results indicate that a 1% decrease in deposit growth results in a decline of economic growth by 0.87 percentage points. The deposit elasticity of economic growth is substantial, and which corroborates the idea that the deposits channel can significantly affect aggregate fluctuations. The deposit elasticity of economic growth is almost 6 times the lending supply elasticity of economic growth, and it's consistent with the observation in the last column that a 1% increase in deposit growth corresponds to a 6% increase in lending growth. Okay, so thus far, we've demonstrated that deposit shocks can affect aggregate economic growth. But how does this happen? So we argue that the key mechanism through which shocks to banks affect economic growth is lending activity. And we show this by using microdata on small business lending and mortgage lending. So first, what we do is we estimate the effect of lending growth on our local deposit shock. In particular, we estimate beta as a within county estimator. So our identifying assumption is that banks face identical investment opportunities within a county. A weaker version of our identifying assumption is that any friction which creates a wedge between available investment opportunities to different banks within a county is unrelated to the idiosyncratic shock that occurred elsewhere. And in our baseline specification, we include county cross-bank fixed effects to control for the time invariant importance of a bank within a county. And we find specifically that a 1 standard deviation deposit shock is associated with a decline of 1.09 to 1.85 percentage points in lending growth.
5 minutes.
Now, you might be concerned that perhaps this is capturing the effect of the actual affected counties. To address this concern, we verify that the lending cut is concentrated in unaffected counties by conducting a subsample analysis between non-affected and affected counties. And so we find that a 1 standard deviation deposit shock is associated with a 4.47 percentage points decline in non-affected counties and 1.57 in affected counties. Okay, so next we study the relation between deposit shocks and mortgage lending, which is another big market. And similarly, we find that deposit shocks negatively affect bank lending. The pecking order of effects on different mortgage types is consistent with the argument that contracting frictions are less pronounced for home refinancing and improvement loans relative to home purchases. And this is because borrowers have an established payment history for home refinancing and improvement loans relative to new home purchases. So this implies that lending contraction is dominant in loan types where banks face more contracting frictions. And so next what we do is we exploit a unique feature of the mortgage market, which is securitization. Banks often securitize mortgages replacing deposits with bonds as a source of financing. This is the result of secondary market activities of the government-sponsored enterprises Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac cannot purchase jumbo mortgages, so jumbo mortgages are more likely to be funded by deposits. So in this analysis, we include bank cross-county, cross-year fixed effects, which compares jumbo and non-jumbo originations by the same bank in the same county in the same year. And we also include jumbo cross-bank, cross-county fixed effects to control for the time invariant importance of jumbo mortgages extended by a particular bank in a particular county. This innovation in fixed effects allows us to relax our weak identification assumption. And so in comparing the heterogeneous effects of jumbo and non-jumbo mortgages, we find that deposit shocks negatively affect the origination of jumbo mortgages more than non-jumbo mortgages. Specifically, a 1 standard deviation deposit shock is associated with a 3.58 percentage points additional decline for jumbo mortgages relative to non-jumbo mortgages. And so this result suggests that the contraction in lending is more pronounced for loans that are more likely to be funded by deposits. So next, we argue that frictions are crucial in the aggregation of idiosyncratic shocks. On the bank side, we find that the transmission mechanism is magnified for banks that face tighter capital constraints. We also find that banks tend to cut lending in areas where they lack informational advantages. And we use 2 alternative definitions of core and non-core markets to show that banks tend to cut lending in areas which are their non-core markets relative to their core markets. And that is to say that banks cut lending in areas where they're probably less likely to extract rents. On the borrower side, we hypothesize that firms which are more dependent on banks as a source of external financing drive the aggregate response in lending growth to deposit shocks because they're more reliant on banks and relationship frictions. So the stickiness in borrower-bank relationships can impede borrowers from finding new banks swiftly, which can cause the lending cuts to affect bank-dependent borrowers more. And we find that indeed borrower financial constraints exacerbate the lending cut, which materializes as lower debt, lower size, lower employment, and lower capital expenditure. And I didn't go through all these results in the interest of time, but they're available in the paper. So these tests highlight the role of frictions in the amplification of idiosyncratic shocks to aggregate fluctuations. So to conclude, this paper documents a new source of bank fragility, which is the geography of bank deposits. We show that bank deposits are geographically concentrated, exhibiting fat tails. And bank internal capital markets provide a mechanism for the transmission of idiosyncratic shocks through their network structure. We provide evidence in support of the deposits channel of aggregate fluctuations. Specifically, we find that our shocks can explain 3.3% variation in economic growth, which is as much as other macroeconomic variables. The local disaster shocks result in aggregate fluctuations through their effect on deposits, which negatively affects bank lending. And lastly, we emphasize how financial frictions can magnify the deposits channel. These include bank constraints, informational advantages, and the stickiness of bank-borrower relationships. Thank you.
All right, thank you, Shahini. Okay, so these are 3 interesting papers that are sort of only loosely linked through the term of deposit. So I'll talk maybe very much at the end, just at the very end, about what connects them. So let me just jump into the first paper by Hashim and Urban Yerman. There we go. All right, so this paper is a dynamic model of deposits. It's a situation where they generate deposits that stay in a bank for sort of different periods of times. And so the fraction withdrawal depends on liquidity shocks, interest rates, default risk. And when there are withdrawals, the bank then issues more deposits, right? Because this is an infant horizon bank as long as it stays solvent. Default probability depends on total deposits, and what they get is that the price of old and new deposits differ, and that creates incentive to dilute. I want to point out one thing about the bank. The bank's a bit unusual compared to the banks you usually see in the literature. I don't think this matters, but I'm not, not 100% sure, so I'm just going to sort of lay lay that basics out. This bank's more like really like a Lucas tree, right? Where the bank produces some cash flow R plus some random component Z each period. When a bank takes deposits, it's not sort of using them to lend them out. Instead, it doesn't scale the size of the bank. The tree stays the same size. Instead, all the deposits do is provide some convenience and liquidity service to depositors, for which the bank can be paid for, which is what the next line says. The banks only limit deposits in this environment because if it has too many, it could fail if there's a draw below Z, because the deposits have to be paid back. And so the equity becomes basically the present value of profits plus, the benefits from selling these liquidity convenience services to depositors. And what you get is a market measure of the value of the firm. And I'm going to come back to that because that can sometimes be an issue when thinking about banking data. All right, so here's try to illustrate the dilution incentives in a super highly stylized, simple example. So think of B1 as period 1 deposits and B2 as period 2 deposits. Not quite the same notation that Zhang used, but similar. Let F of B1 plus B2 just sort of be some disutility to the bank from total deposits, and that'd be the stand-in for the failure probability. So here's a case where there's not any dilution problems. We'll take B1 as given and assume that the price of B1 was 1. And then if the decision problem faced by the bank is maximize second period deposits minus this sort of disutility, you're going to get as a solution that the total deposits that the bank has in the second period, B1 plus B2, is not a function of how much deposits come in. So that's a situation where there's no incentive for the bank to dilute. The price of deposits are the same. What they do through this framework where deposits are priced and they take into account failure probabilities, which depends on total deposits, is essentially add another term. You get a pricing term in front of the B2. That's the G of B1 plus B2. And if you look at the first order condition and take sort of any reasonable functional form, you're going to be able to show that the total deposits, the sum of deposits, is going to be a function, the optimal sum of deposits will be a function of how many deposits came into the period. And this is kind of why these sort of liquidity withdrawals will generate situations where the bank would want to hold different amount of deposits. And in their setup, it's too much deposits and too much risk, the dilution incentives. And it kind of creates an interesting sort of unusual feature in that the bank would love capital regulations because it would give it ability to commit, but it doesn't have that power, at least in the basic setup. All right, so as the presenter discussed, they're looking at 3 equilibrium concepts. This laissez-faire, which is the bank making the decisions of deposits each period. A Markov equilibrium, where basically the regulator sets the deposit period by period. And then the Ramsey equilibrium, which is sort of the standard macro equilibrium concept about, where the regulator has more powers and commits and which gets represented through discounted promise utility constraints and things like that. 2 and 3 use kind of capital requirements. The presenter talked, the Markov said it didn't, but it does in a sense that the regulator's choosing B. So I'm calling it a capital requirement. But that's something that the laissez-faire bank can't commit to. And the numerical results, and Zhang had this table, was very interesting, and it's sort of clearly laid out that the laissez-faire equilibrium is there's actually a low level deposits. The bank would love to overissue deposits, but everybody knows that, so deposits get really expensive. It's so expensive that the bank doesn't issue as many. And then when you go Markov equilibrium, at least at the steady state, you can support more capital and you can do even more, more deposits, and you can support even more once you go with the Ramsey equilibrium, having to do with its promises. It's a very rich and interesting model. The presenter showed some of the experiments you can do with it, such as interest rate shock and how that affects the dynamics. There's a lot that can be done with this, and so this is sort of very good. So what I'm going to do is just quickly give some comments on the commitment aspect of it. just some things out that are sort of connected to the paper. So on the bank decision problem, this problem is very reminiscent of sort of dynamic debt models, right? And those, you can get overissue there, debt overhang problems, all those kind of issues. And one of the solutions in those environments is debt covenants. So there is actually a private market solution. Now, I'm not aware if covenants get issued with private deposits for banks. Maybe they do, maybe I don't know. Maybe it has to do with payment flows, make it hard to sort of put some of those kind of covenants in on like sort of issuing debt. But that's sort of an interesting aspect, and there may be some private market solutions, at least to the bank commitment problem. And then on the regulatory front, commitment's playing a big role in sort of implementing the allocations that they look at. And empirically, regulatory commitment is something that seems pretty important. So, and this has been a problem in the past, in particular. So the classic example in U.S. banking history is the S&L crisis during the 80s, where the banks got in this S&Ls, the thrifts, were insolvent due to a combination of high inflation and a balance sheet that consisted of lots of fixed rate long-term mortgages that were issued before inflation went up. A lot of them became technically insolvent, but there was the regulator couldn't shut, I forget the name of the thrift regulator at the time, but maybe FISLIC, I think, I'm not sure. But they had trouble, they couldn't shut the banks down, the thrifts down, because of political pressures. What that caused was a lengthening and deepening of the S&L crisis, and actually made it even more expensive to clean up later when it was finally resolved with the Resolution Trust Corporation. And there were similar problems with commercial banks, but not quite as severe, but they were there as well. And the Congress made a serious attempt at putting in more commitment, and that was through FDICIA. And FDICIA had a clause called prompt corrective action that forced supervisors to shut a bank down if the bank capital got too low. And here's a graph from a sample of community banks that actually failed during the late 80s, early 90s crisis. So these are community banks, not S&Ls, and compares that with community banks that failed in the recent financial crisis of about 10, 11 years ago. This is the average capital ratio of these banks that failed in the period leading up to their failure, the 4 years leading up to the failure. So if you look at the far right, at the dash line, you'll see what capital was of banks that right before they failed in, if the ones that failed in like the 86 to 92 banking crisis. And there you see it's negative 2% book capital, right? So these banks were insolvent for some time before and weren't shut down till later. In the recent financial crisis, and again, remember, these are community banks, so they're small, there's no too big to fail issues with them. You see that when these banks got shut down, the average capital level for them was close to 2%. Okay, so book capital is positive, and the PCA allowed regulators to shut banks down when capital got below 2%. And it looks like they did it, right? But FDIC losses on these failed banks were still very high. In fact, there were over about 25% of failed bank assets on this sample of banks. And here the problem is what seems to be, or at least one of the factors, was that, bank assets are liquid. You don't have market prices for loans. PCA is based on book equity, partially out of necessity, but book equity can differ from market equity. So, and the model, solves for market equity. So if you get to the point of taking these kind of models to the data, you're going to have to do some thinking about book equity and how that sort of connects in. And what's very interesting about that PCA experiment is that book equity was the tool that they used to try to impose some commitment, and it didn't quite have all the benefits that they had hoped when they passed FDICIA. All right, so let me jump to the next paper. This is basically, I'll go through the model very quickly. They're taking like a classic static bank moral hazard problem. The insured deposits, you got the deposit insurance put option that creates a moral hazard in loan monitoring. They add the wholesale deposits, which are not insured. And that brings in the sort of Jensen-Meckling, where if you price the uninsured debt, that can sort of have some beneficial effects on loan monitoring. So this is kind of a classic classic model. And then what they do is they add some new features, an interim period and these signals where with thetas, the size of what the good return is, and a signal Q about the probability of a good return, and then the short-term uninsured debt reprices. And they're asking is what's the effect of disclosure of Q on leverage of the probability, or let's just say the interim quality of the bank on leverage and bank risk, and they interpreting disclosure as increasing market discipline. And they show it doesn't work, but and I'll get back to that sort of language question very quickly at the end. So again, here's the details on the model. I think we can sort of skip this. The presenter covered that nicely. And there's like some conflicting forces going on in this model, right? So, if we start with the no disclosure benchmark, a higher level wholesale debt reduces monitoring effort. But, the market, the issuer, the people who lend the bank the money know this, and that's will get reflected in the price of deposit. So that gives banks an incentive to hold some equity, and that kind of mitigates some of the moral hazard. So this is kind of Jensen-Meckling stuff going on there. What does disclosure do? For a given level of deposits, debt, it would raise effort, okay, because of the better information. But when the quality of the bank is low, when the aggregate return, the theta is going to be very low, basically the bank liquidates, pays off the debt, and then that puts all the losses on the deposit insurer. All right, so this basically, and that return reduces the T equals 0 price of D, and then so you'll lose these kind of Jensen-Meckling benefits of the priced wholesale debt. Okay, so and in their model, you go all the way to all debt, no equity, and there's no mitigation of moral hazard, and that was shown in that nice graph that David presented. So the basic idea here is the disclosure reprices short-term debt, which gives debt holders time to escape a weak bank. And there's actually something empirically to this. So typically, historically, when a bank gets in trouble, it gets handled by finding an acquisition partner, but that sometimes can take time. And there's a lot of episodes, particularly in the 80s and 70s, but other times as well, where Fed discount window lending to a troubled bank while they're looking for a merger partner would give uninsured depositors and wholesale lenders time to get out. So Bob Hetzel, a former colleague of mine when I used to be at the Richmond Fed, wrote about this way back in the early 90s. And that raises the resolution cost of the FDIC, which is, in this model, corresponds to the deposit insurance put option. Furthermore, empirically, uninsured depositors rarely take losses in a failed bank. So, I mentioned, the discount window, but or other reasons, uninsured people have time to get out. But often with an FDIC-assisted acquisition, the uninsured depositors go with it as well. And Stern and Fellman in their Too Big to Fail book talk about this as well, and have some, pretty striking numbers. So, yeah, so this is like, this model has things that we kind of see in the real world, which I like. So it's a good model. I will say, it's kind of a language issue, which actually didn't come up in the presentation, so this may not be a fair comment. But, this idea that market discipline is defined as disclosure, to me, market discipline means creditors take losses if there's a failure. So what they really showed is that disclosure, and in this particular type of disclosure where it gave time for short-term debt to get out, reduces market discipline because it reduces the losses that creditors take. So that's a nice finding and a very interesting result. So now there are ways to solve the problem or reduce it. And I'll point out one, you can make the debt long-term. That's the bottom bullet point there. And Dodd-Frank put this thing called TLAC, which was long-term debt that banks could issue to meet, one form of their capital requirements. And that's sort of not subject to these, this sort of get the money out quick thing. And then the other thing is that, if the FDIC can shut down the bank at a low theta bank at T=1, solves the problems. Of course, you got PCA issues, discussion earlier about commitment problems. But so anyways, overall, a nice paper. All right, so the last paper is not about dynamics of deposits, but instead it's about, almost like this is like a cross location, right? So the effect of shocks of deposits on economic activity locally and in other places. So the strategy is to look at shocks to bank deposit base and then measure economic effects. Okay, so this is this is kind of a growing literature. There's some papers that use like the shale oil finds, people like North Dakota and parts of Texas and other parts of the U.S. So Matt Plosser's dissertation, 2012. A former colleague of mine, Crystal Cortez and Phil Scron, have a nice paper about multi-market banks and the implications of shale oil, where that increased deposits in some community. There's actually an older literature that kind of is related that looks at bank failures and looks at the effects. So Adam Ashcraft looked at failed Texas banks in the 1980s. Has AER paper from that, and that's a nice paper that's kind of in the same kind of spirit. I think actually is a very interesting and productive literature, and I like it. So let me get to this paper, what this paper does. So they observed the deposits are geographically concentrated, and as Shuni pointed out, it's by geographically concentrated, it's like banks have 30% on average of their deposits in one particular county. And then that argued that this makes banks deposits susceptible to geographically concentrated sort of weather, nature shocks, hurricanes, that kind of stuff. And then wants to estimate the effect of these weather shocks and deposit growth. And then, there's some stuff about granular deposit shocks deal with endogeneity, which there's obviously an issue in this kind of exercise. And then they want to sort of tie that to GDP growth. And the goal is to link these shocks to aggregate fluctuations. And then there's some other analysis of how through the regressions on small business lending and mortgage lending. What I want to highlight with this, so conceptually, I like the approach, but what I do have, I do have a data concern about the summary deposit data, and that has to do with the geographic concentration of deposits that's measured at the very largest banks. So I'm not I've worked with summary deposits, but I'm not, I'm not an expert on it. But there is one feature that I'm aware of that's kind of an issue, particularly with larger banks. So, where banks book deposits can depend a lot on internal reporting systems, can vary across banks, and different banks can do different things. So like retail accounts are probably tend to be booked at the local branch. But corporate accounts, I think, is another question, right? So if you have some bank that's information systems like running corporate deposits through their headquarters, those deposits are probably going to get booked at at the headquarters. So take the paper mentions that the 4 largest banks are very concentrated as well. So Citibank, the county that 55% of Citibank deposits are booked in is Lincoln County, South Dakota. These are not the deposits of residents of South Dakota. Okay, I don't know why Citibank books their so many deposits in South Dakota. It probably has to do with origins of their credit card operations, which were based in South Dakota to get around, the old usury laws. That's kind of why South Dakota had some banking stuff chartered there. So there may be some historical reason, I don't really know, but you look Bank of America. Bank of America has 10% of their deposits in Mecklenburg County. Mecklenburg County is where Charlotte, North Carolina is, and that's their headquarters. My guess, and I don't know this for sure, but my guess is that a lot of sort of corporate and sort of non-retail deposits are getting booked there. And if you look at their county with the second most deposits, San Francisco, which is probably another sort of corporate office for them, because you got to remember Bank of America resulted in a merger from Nations Bank, which was based in Charlotte, North Carolina, with the old Bank of America, which was based in San Francisco. So my guess is these are kind of like headquarter type locations. And for some reason, a bunch of the, high deposit accounts are sort of run out of those places, and that's how they report them. So in terms of this exercise, calculating the effects of a weather shock on this sort of granular deposit shock, what I worry about is like a weather shock to Lincoln County is not going to have any effect on Citibank. I mean, let's ignore maybe operational issues. I don't know where Citibank's computers are or any of that kind of stuff, but ignoring that kind of stuff, if there's bad weather in Lincoln County, South Dakota, I can't imagine that many people live in Lincoln County, and it's not going to have any effect on Citibank's lending decisions, you know, throughout the rest of its footprint market. So I think the exercise study needs to make some kind of adjustments for larger banks. I don't know how far down you need to go in the size distribution where this no longer becomes an issue. I mean, I do know like people who do merger analysis will make adjustments to take into account these kind of sort of concentration deposit effects. I don't know how they do it in practice, but that's sort of something I think you need to think about it. I do find this geographic story much more believable for smaller banks. So so that's sort of my main concern with sort of the data approach. Now there's a part of the paper I really liked a lot that I don't always see in this literature, is that there's a very nice, they have this sort of conceptual model to sort of motivate, you know, the effect of shocks on lending activities in other locations. So they have a very simple multi-branch bank problem, which is, think of a bank, each branch having its own productivity alpha I, so I represents a branch, and F of L of I is some production function of lending, so this is like kind of your sort of revenue minus whatever you pay deposits in that branch. And that's subject to a constraint where all your lending has to sum up to your sum of deposits across your branches. First order conditions, which they have, is that basically the marginal product of an additional unit of lending is going to be constant across locations, right? That's what that Lagrange, that's the equal common Lagrange multiplier. So what this implies is a deposit shock at branch I reduces lending everywhere, and that motivates a lot of their analysis. So what I want to point out with this is that make a little link to the financial stability world. You know, everybody's always looking these days for spillovers and propagation and worried about interconnectedness. And there's a case where you get a shock in one location, you're going to have effects on other different locations. So there's quote unquote spillovers, things are interconnectedness. And the default assumption in these discussions, and this is, the authors didn't do this, but certainly I see that in this world a lot, is that these are bad. But in this model, these spillovers are good, okay? So think of like an alternative model, maybe go back to kind of what we had before deregulation of banking, where, you know, each bank had a different, you know, instead of, you know, Cap I branches, you had Cap I independent banks, right? And there's a very limited interbank market. So basically, then your optimization problem becomes for each I, as each bank, you maximize, you know, how much you lend out in your location, and it's trivial. You can lend out all your deposits. So if there's a shock to deposits in your location, your lending goes way down. Marginal products are not equated across locations in terms of lending, and so you get, so the economy is less productive. At least lending is less productive than it is in this sort of multi-market bank model. So I guess what I want to emphasize here is that these things that sometimes people call spillovers and propagation are exactly what you would expect in a financial system that efficiently allocates capital across location and provides insurance, right? So you could sort of take some of these exercises and say, this is a good thing. And if we see more of that, that's not necessarily means that they're bad, but it's the financial system working like it should. So that kind of point came out of their model very clearly, and I think it's one worth emphasizing. And that actually ties into another literature that's related to this to kind of this banking thing. It's an older literature, comes out of development finance, and you can, you know, this paper's about climate type shocks. Well, you know, agriculture economies have always been subject to weather shocks. There's a lot more variability. You know, rainfall is the common one, but you also get, you know, I don't know, pests, locusts, things like that. And these are like, you know, these shocks create real, you know, volatile income, particularly for farmers. And there's, you know, one researcher, Rob Townsend, has actually looked very carefully at these kind of sort of shocks and financial implications, very much in the spirit of what's kind of going on in this and some of the related papers in this literature. But sort of maybe looking at broader, partly because they have better data. So in Thailand, Rob Townsend's collected incredible data on consumption investment, and used it to look at sort of flows of funds through financial intermediaries, not through financial families and things like that, across regions and villages and even individuals that are getting subject to kind of the shocks, very similar to the ones sort of analyzed here. And it's a book that kind of summarizes a lot of that work from about 10 years ago. And I suspect there's some very useful lessons and tools from that development finance literature for this kind of the exercises that this paper and the related papers are doing. So, so with that, let me sort of sum up. There's a common theme to the papers. I would describe as this: deposits are a lot more interesting and complicated than you think. So that's all I have. I'll turn over the organizers for whether we'll take questions or how you guys want to handle this.
Excellent. Thanks, Ned, for the comments, and to all the presenters. This session is scheduled to wrap up at 12:40, so I think there are a couple of questions in the Q&A that I'll direct the presenters to look at. For anyone who has a question that they asked in the Q&A or that they wanted to raise their hand and ask, I think maybe it's best to postpone that until the virtual reception at the end of the day. Please see the links on the conference program. And I think maybe it's worthwhile to wrap this session up and meet again at 1:05. We're going to reconvene at 1:05, give everyone a chance to get lunch or coffee or whatever it is at your time of day, wherever you're located. Thank you again to the presenters, and we'll see you soon.
Thank you to the session presenters from me.
A festive day celebrating the 20th Research Conference. And I was fortunate enough to be involved with the conference from the beginning. This conference is the flagship activity of the Center for Financial Research, which was established during Chairman Don Powell's time. And we owe big thanks to him for his vision and support. And the research community was lucky to have all the chairmen who followed Don Powell support the conference and the center. I should mention Martin Grunberg, Sheila Bair, and our current chairman, Helena McWilliams, and sincerely thank them all for their support. Of course, we should not forget Art Merton, who was the director of DIR when the center was founded, and his associate director, Fred Carnes. Art's support always continued over these 20 years, and sincerely thank you, Art, for being there. In addition, special thanks go to my good friend, Mark Flannery. He and I, believe it or not, conceptualized the first conference at a conference in Lisbon that started everything. I still vividly remember the spot that we agreed that we would do a conference on sub-debt in Lisbon, and it is hard to believe that more than 20 years have passed since then. And over the 20 years, a lot of people from the FDIC, many staff members, many economists spent hours to provide a first quality conference and contributed in significant ways for the success of this event. The profession owes a big thanks to all who supported and organized these conferences. Of course, we should not forget our discussants and session chairs, who are the integral part of three-phase review process. In addition, we can't thank enough to all those who submitted papers and presented their work. Finally, this year, as we're living through it, we're trying for the first time a fully online program. This was a learning experience for all involved, but as we witness, it is working seamless, perfect, working like a champ. And for that, we owe big thanks to Jonathan Pogash for his leadership overall whole conference organization, and Glenn Kivlin for his leadership on the technology side. Rosalind Bennett and Philip Shively, we should not forget them, and Division Director Diane Ellis provided great support in the organization of this year's conference, and thank you all. As I conclude my remarks, I want to introduce Troy, who is a co-organizer of this year's conference. And as you already heard, Troy and his colleagues produced a paper that looks at some interesting facts about the conference. So now I pass this stage to Troy to share with you these findings. Thank you all again for attending.
Thanks, Luke, for that background. I'm going to spend the next couple of minutes looking back on the Bank Research Conference. Halim Anderson, Michael Carabello, and I wrote a retrospective article on the conference that's forthcoming in the JFSR. We got plenty of assistance along the way, especially from Haluk, Rosalind Bennett, George French, and John Pogash. The article talks about how the conference has served to disseminate policy-relevant research on issues affecting the banking sector and financial system. My goal is to quickly tell you some more about the conference, but primarily through a few pictures and some slide headings. But first, the standard disclaimer. Done. We start with the evolution of conference submissions. On the left-hand axis in blue and gold are the number of submissions and acceptances each year. On the right-hand axis is the paper presentation acceptance rate, displayed as a line. There are two shocks in the number of submissions. First, around 2010 or so, submissions started growing. Given the timing, it seems reasonable to think that this is because the financial crisis brought more attention to banking research and stimulated interest in the conference. Submissions roughly doubled pre-crisis to post-crisis. As I'll describe later, the focus of conference agendas also changed. The second main shock occurs around 2015, when the conference moved towards broader topics attracting wider audiences. At the same time, conference organizers expanded outreach about the conference, more systematically reaching out to department chairs and banking researchers across a variety of institutions. Submissions suddenly increased fourfold, while the length of the conference was kept steady. The effect on the conference's acceptance rate is dramatic. Over the last 5 conferences, the acceptance rate is hovering right around 5 or 6%. The way we process these submissions hasn't changed, although the burden for doing so sure has. Each submission undergoes 3 rounds of review. First, the organizing committee reviews each one to determine whether it fits within the conference's topics and assess potential interest by the audience. Papers passing this round are then read by at least 2 FDIC staff economists that consider the theoretical framework, the empirical methodology, and the suitability of the data. The conference organizers then review the staff assessments and organizing the most promising papers into topic-based collections of roughly 15 papers. These papers are then sent for external review. These third-round reviewers are charged with selecting 2 or 3 papers to build into a session for which they'll serve as the discussant. This review is done blindly and serves as a defining feature of the Bank Research Conference. The external reviewers both select the papers for their session and unify them during their discussion and moderation. As Chairman McWilliams remarked earlier, conference agendas reflect both traditional topics endemic to banking and newly emerging topics. We went back over every paper presentation in the first 20 years and placed it into one of 16 categories. The table you see here plots their evolution. First, you see that topics like lending and capital are almost always present during each iteration of the conference. Other topics like fintech emerged more recently. This year's agenda includes several papers on climate risk, which may quickly join fintech in prominence. You can also see the change induced by the financial crisis. The conference programs for early years focused on issues of core functional importance to the FDIC, including deposit insurance design and regulatory and supervisory effects on bank behavior. Pre-crisis agendas included many papers on market discipline and market information. This theme all but vanished after the crisis, possibly due to the failure of market discipline to prevent or significantly mitigate the impact of the crisis. Post-crisis, papers on systemic risk and real effects become prominent. Researchers were seeking both an early warning indicator of potential broad financial distress and a means to gauge the success of attempts to control such risk. The article forthcoming in the JFSR includes an appendix of papers that are organized by topic. We hope it is useful to those putting together reading lists for their graduate courses. Presenters come from a variety of industries. More than 2/3 of presenters are academics, but central bankers also appear frequently. Government agencies like the FDIC and OCC, and international organizations like the IMF and Bank for International Settlements also appear, as do presenters from the private sector. About 75% of presenters come from institutions in the United States. A further 20 countries or so are represented among the internationals. These trends are mimicked in this year's conference attendees. There are almost 700 registered attendees, with academia and government making up the bulk. About a fifth of attendees are from the private sector, and a tenth are from central banks. Geographically, this year we have attendees from every habitable continent, from North America to Oceania. Welcome. Some presenters come back again and again. Presentations by co-authors are not included here. Jose is presenting again this year, and George, Mark, Bob, and Anjan are again serving as discussants. Since they're so critical to what makes this conference work, it seems only appropriate to thank them again for leading their sessions this year. Not only did they pick the papers as third-run reviewers, but they're synthesizing the presentations and placing them in the larger context through their discussion. And while we're at it, we might as well let them know that we look forward to seeing them again next year. I want to spend a short time talking about the evolution of publications of presented papers. And note that this table does not represent a full list of journals publishing conference papers. Over the first decade of the conference, the JFSR was the leading outlet, occasionally dedicating special issues to papers from the conference, such as Market Discipline in Banking and Basel II, Challenges for Implementation. By 2011, the JFE became the leading outlet of conference papers, and by 2016, RFS had surpassed them both. Following closely behind these journals are now JBF, JF, JFI, JFQA. The trend is clear. Over time, conference presentations are being published in more journals and in greater frequency. Finally, it's only fitting to talk briefly about the connection of the conference to the regulatory process. This is a timeline of some significant financial regulatory actions, with the ones in blue boxes being generally more important. Conference presentations, including many by those on their computers right now, discuss key aspects of these rulemakings prior to their finalization. Subprime mortgage lending standards, risk-based capital requirements, risk retention, the role of credit ratings, and the effect of prop trading were all discussed at the conference before, during, and after the rulemaking process. The conference has also been a leading source of research about executive compensation, including Special Master for Exec Comp Ken Feinberg delivering the keynote address on this topic right in the middle of the crisis in 2009. Regardless of topic, the Bank Research Conference has helped imbue a deeper understanding of the relevant economics issues underlying the regulatory process. The Bank Research Conference and the Center for Financial Research that now hosts the conference began with a simple vision. In the words of Art Merton from way back in the early 2000s, academics and industry representatives were to serve as sounding boards, providing valuable feedback on regulatory policies. And regulatory and industry economists were to help the academics identify relevant research topics. 20 years later, going strong and still getting stronger, the FDIC JFSR Bank Research Conference is delighted to be a nexus of banking research, policy, and industry. Thank you. At this point, I'd like to welcome Mark Flannery to the stage to moderate a panel discussion on 20 years of banking, lessons learned. Mark joins us from the University of Florida, where he's the Bank of America Eminent Scholar in Finance. His hats are many, though. He was chief economist at the SEC, senior advisor at the OFR, and on the Model Validation Council for the Federal Reserve. But before all that, Mark was the inaugural director of the Center for Financial Research. He was there at the founding almost 20 years ago, so it seems only fitting for him to lead the discussion on what we've learned over that time. Professor Flannery, the floor is yours.
Thank you, Troy. Thank you very much. Everybody hear me okay? So we've got a panel of three very informed people who are going to talk about their view of the last 20 years in US banking. I'm going to start with some graphs, some pictures of what's been going on in various salient dimensions. Then each of the panelists will make a presentation of 10 or 12 minutes. Then we'll have time for questions and answers among ourselves and also with people in the audience. So I'll have to see how to change this. That's not right. Oh. Uh-oh.
Left-hand side mark.
There we go. All right. As I started thinking about bank history over the last 20 years, I was reminded of a paper by Boyd and Gertler in 1994 titled "Is Banks Dead? Are Banks Dead? Or is the news of their death over exaggerated?" or something like that. They motivated their paper with this black and white graph on the left, where they show that into the 1990s, the bank's share of total assets and the bank's share of credit had declined. Well, I've got a similar graph on the right here, which is for all the reporting US bank holding companies. And the orange is the ratio of total bank assets to GDP, and the blue is the ratio of total credit. And if we look at the past 20 years, that's about halfway through this period. And what we've seen is, unlike the Boyd and Gertler preceding data, we find the banks increasing and increasing quite sharply, even before the most recent couple of years. So I wanted to look into this a little bit more carefully. There's the 20-year mark. Now, one of my two big themes here is that banks' on-balance sheet credit has gone down. And Phil's going to talk about that, of course. And this vertical black line shows about 20 years ago. It's where I did about 2000. And the proportion of bank assets that are turned into on-book credit has been declining quite sharply in the past 20 years, and especially in the past 12 to 15 years. The number of banks has also been going down from about 16,000 to about 4,300. And again, the black line is 20 years ago. And there doesn't seem to have been anything special that happened in the past 20 years versus the 20 years before. As the banks have fallen in number, that's the red line here, they've grown in size. So in 1973, the average bank had a size of $166 million. Today, it's almost $4 billion. So there's been a huge increase in the nominal size of the banks, but also in the real size of the banks, and that corresponds to the declining numbers. Now, I've got some balance sheet proportions that I wanted to show you. This is total loans over total assets. Oh, this is commercial and industrial loans. Now, if you remember, the Bank Holding Company Act of 1956 defined a bank as an entity that had demand deposit liabilities and commercial bank assets. So historically, there's been this view that banks are big providers of credit to commercial entities. Well, here are the C&I loans, which have fallen quite sharply, especially since my vertical red line at 20 years ago. This is commercial real estate, which I was sort of inclined to combine with C&I loans to get a figure for total lending to commercial entities, and that's what this is. And we see that shortly after the turn of the millennium, this total share of lending, on-book lending, to commercial entities fell quite sharply, and it's way down from what it was in the 90s. So it's down from 30% to more like 15%. So there's been less credit. Now, here on the left-hand side, I've got the bank holdings of Treasury and agency securities. And that's dropped a lot. It started beforehand, but it's dropped a lot. On the right-hand side, I've got the bank's holdings of government-guaranteed mortgage backs. And that's risen a lot. And that's sort of a symptom of other changes in the industry, which is a move off balance sheet toward securitized entities. Now, maybe the most interesting one of my pictures here has to do with profitability. And if we look at income over assets, it's fallen somewhat. But if we look at the next picture, which is, here we go, income over tier one capital, it's fallen quite sharply. So in the 90s, up until the great financial crisis, the return on bank equity, this is a book return, was about 20%. It's now much closer to 10. And that's probably responsible for some of the changes in market to book ratios that firms are operating with. But banking has become less profitable in terms of generating earnings. Let me close with a pie chart or two. All right, here we go. So the first comparison is for commercial loans, for on-book credit. And that's fallen from 73% of assets to 62. Well, what's gone up? One of the things that's gone up is securities. Securities holdings have gone up from 9 to 12%. Another thing that's gone up is trading accounts. And that's gone up from a little bit under 5 to almost 7. So trading account assets are now much more important than they were before. And so too is cash. This is cash and due froms. You know, I wondered where did all the excess reserves go? And to some extent, they go into this category on the balance sheet. Cash and due from has risen from 3.3 to 5.5. And that's probably quantitative easing. It's also perhaps something to do with the liquidity ratio rules and requirements. And then the last thing takes us back to non-market or non-lending activities. This is Fed funds sold and repo assets. So this is money that the banks are lending to other entities, either banks or brokerage companies. And that's about doubled from 3 to 6% of the balance sheet. So all in all, the summary is that we have more banks, fewer banks, they're bigger, they earn less, and they do more off-balance sheet or securitization kinds of things, and they do more trading, but less on-balance sheet credit. So let me stop there and turn this over to Phil Strawn and ask him to talk about his view of the last 20 years. Phil?
Thanks, Mark. I thought I was going last. I guess I'm going now. That's totally.
You want to go last?
No, this is good. I need my slides. Can someone put up my slides? I don't have control over this. All right, I'll begin. I'm going to talk about the rise and risks of shadow banks. So Mark reached out to us about, I guess it was about a year and a half ago, and he gave us the homework assignment of opining on the most important changes in banking over the past 20 years. And I sort of coalesced in my mind around the continuing importance of shadow banks. And I'll show you some data on that in a minute. Still don't see my slides. There they are, good. So it's not 27 slides. I'm not sure what that number means. So the subtitle of this panel is Lessons Learned. And sadly, my thesis is more or less lessons which have not been learned with regard to shadow banks. So my basic thesis here is that our regulatory architecture is, if you will, not properly calibrated. You could sort of maybe argue about levels, but I think certainly in a relative sense, we've gone to over-regulating the traditional depositories relative to shadow banks. And I think if we look at what happened in March 2020, you can see exactly what I'm talking about. So March 2020, the shadow banking system initiated a fire sale. So for example, there was a turmoil in the treasury market because of these fire sales. I think that was mainly from the hedge fund sector. And what you would hope would happen is banks would be the liquidity supplier and buy up those treasuries, but banks were facing binding capital constraints because of the supplementary leverage ratio. So this is getting at the point of too much, if you will, regulation. And the way the Federal Reserve responded to that was two ways. One was by buying treasuries themselves very aggressively by turning QE back on. And the second thing they did is they basically put the supplementary ratio to the side for about a year to allow the big banks to also purchase treasury securities. So let me talk a little bit about shadow banking. Just in terms of a definition, it's kind of more, honestly, it's a little bit hard to define. My definition is something like the movement of credit and liquidity supply from traditional depositories into markets and non-deposit intermediaries. So in terms of sort of credit instruments, substituting traditional bank loans for bonds, and then taking more traditional bank loans and securitizing them, reshaping them in a manner where they can be held by all kinds of investors, mortgage-backed securities, CLOs, et cetera, and so forth. On the intermediary side, I want to sort of emphasize 4 versions of shadow banks: money market mutual funds, other kinds of mutual funds, particularly bond mutual funds, which look more like banks, ETFs, and hedge funds. So similar to what Mark did, let me just show you a little bit of data on the shadow banks. So here is a graph normalizing everything to 100 in 2000 of money market mutual fund asset growth. So the line in the middle is total assets, and then splitting it out into government versus private debt securities. So what you see here for money market mutual funds, as you know, there was a decline after the financial crisis, but subsequent to the financial crisis, the growth had been fairly slow until the very last part of the sample just before COVID. So in terms of increasing market impact, the money market mutual funds are less important than the other 3 that I'm going to mention. So if we look at hedge funds, this is just total assets under management by hedge funds. You see a run up before the global financial crisis and decline, as you would expect. And then after a few years of flat, you see again very rapid growth continuing. So by the time you get to the end of the sample, we're up to around 4 trillion in hedge funds, relative to maybe 13 trillion in the traditional banking sector. ETFs are where you see really the most dramatic change. This is a graph of ETF growth from 2000. So basically they're doing nothing until the last decade. The black line is all ETFs. So they're up to about 3.6 trillion today. Most of that is still in equities, but what I want to point to here is the explosive growth of ETFs, which invest in debt securities. So these look more like shadow banks, if you will. The total now is 500 billion, still pretty small in the grand scheme, but the growth rate is really tremendous. Last one are other mutual funds, non-money market mutual funds. So a gigantic sector. As of 2020, on the order of 14 trillion overall. And again, a lot of that is in corporate equities. The place where we think we're making contact with traditional banking, or closest contact, are the bond mutual funds. And you can see that this is the green line. These are really jumping off the page following the global financial crisis. So now they have over 2 trillion in assets. And these funds are holding not just bonds, but also, for example, they're a major holder of syndicated loans. If we compare the ETFs and the mutual funds with banks, so what I'm doing on these graphs is comparing this is bank C&I lending down here, and compared to ETFs investing in debt securities. So you can see this is only going back to 2012. Much, much faster growth in the ETF sector than in the banking sector. And as I mentioned, still relatively small compared to banking, but on a way, way faster growth trajectory. Same thing is true for mutual funds, although now, this is the growth rate going all the way back to 2000. And you can see where these lines really start separating is post-global financial crisis. So by the time you get to the present day, the bond mutual funds are as important holder of debt securities as are banks in terms of their lending to businesses. So the shadow banking system has really grown dramatically. I put together a little market share kind of calculation. And when we get to the latter portion of the sample, in terms of corporate finance, more than, I would say roughly 50% or a little bit more is now held by the so-called shadow banks as opposed to traditional banks. So why has this happened? You know, there's sort of two forces here. One is the good force of innovation, all for that. The other piece is regulatory arbitrage. So to the extent that our system is tilted towards too much burden on banks and not enough on shadow banks, it's going to push those risks into the unregulated sector. And shadow banks, you know, we learned in spades in 2008 are vulnerable to runs. They don't have the mechanisms in place that have been developed over hundreds of years to protect the traditional banking system, deposit insurance, lenders of last resort, all of the many, many regulations. These are either not there or way limited for shadow banks. Let's talk a little bit more about what happened in March 2020. So this is the sense in which lessons were not learned. So, you know, we have a global financial crisis. People understand that it's fundamentally a run on the shadow banking system that was behind that. And yet we have a second incident with COVID where we have another run on shadow banks. If you remember what things were like in mid-March, the ball was rolling down the hill at least as fast at that point as it was post-Lehman. The difference is two things. One are the banks themselves were well capitalized. So there was a massive drawdown on pre-existing credit lines because large corporations couldn't get access to capital markets because the shadow banks were in free fall. So they went back to the traditional banking system. But then the Fed also had to intervene rapidly and massively. So we had two of these incidents. My concern is that, you know, we should probably expect more of these unless something changes in the regulation. And, you know, think back to the 19th century when we had free banking, very little regulation, and every decade, for 20 years, there was another financial crisis. So this, I think, is something we want to avoid. I think it could happen if things don't change. What's fundamentally the problem? We should have learned in 2008 that we have fragility in the shadow banking system, but the core response of regulation was pile on more regulations onto the traditional banks and very little in the shadow bank. Outside of money market mutual funds, you don't see very much change in the regulatory system. And so that just amplifies this regulatory art problem.
Phil?
Yeah.
Excuse me, 2 minutes, please.
One more thing. Yeah. So that's the negative. I'm going to be slightly even more negative than I've been already, just to remind people that there's an emergent form of shadow banking that I haven't talked about at all yet, which is really not so much about the credit role of banking, but about the payments role. And so we see a massive increase in non-bank payments companies like PayPal and so on. If we look to other places like China, these kinds of entities have basically taken over the payment system. And we also have the emergence of private currencies in the form of crypto. So we've got the growth of digital golds like Bitcoins, stable coins like Tether. This creates all kinds of questions about regulation. When I look at them, I say this is banking, and yet the law doesn't look at it that way. It's very hard to know, for example, who has authority over cryptocurrency. Right now, the SEC seems to be making more noise about regulating over there. But when I look at it, I say, well, that's money. Shouldn't that be the purview of the Fed? One thing that some of you, I'm sure, know, just last month, the FDIC and the OCC put out a white paper on stable coins, basically pointing out stable coins are banks. They're vulnerable to runs. This is a point Gary Gordon has been making. I think it's absolutely spot on correct. And it strikes me as we need some kind of clarity about how are we going to regulate them? If we are, who does it? Who's responsible? And that white paper is very clear, basically asking the US Congress for legislation to create clear lines of authority, which right now are very blurry. So with that, I will adjourn and thank you all for your attention. I look forward to the Q&A.
Thank you, Phil. I don't want to get the wrong person in order, so could whoever's running the slides tell me, okay, Linda's next. That's what I wanted to know. Linda, 10 to 12 minutes, please. Welcome.
So thank you so much for having me. And I looked at the participant attendee lists and greetings to some friends out there and look forward to seeing you soon. I'm going to talk about historical perspectives on global banking, focusing on how the scope of activity and the counterparties for global banks have changed over the past decades. I'll then provide a few facts on the importance of foreign banking organizations within the United States. Afterwards, I'll turn to points around the cross-border liquidity management of global banks and the amplitude of response of these international liquidity flows to different types of drivers and shocks. I'll have perhaps a little bit more of a positive end note than Phil left us off with, but still with some challenges. I first want to stress that the views are my own and not necessarily those of the Federal Reserve Bank or the Federal Reserve System. By way of preview, I just want to underscore the three main points that I'll make. First is that global banking and associated financial integration across countries provides net benefits to those countries. International capital flows through global banks, my second point, do respond to different drivers and shocks, like monetary policy stance and changes in risk sentiment. Degrees of volatility from shocks are not the same for all types of flows or for all counterparties. So one lesson learned is that the amplitude of swings in international capital flows through global banks is moderated when global banks are well capitalized and have good risk management frameworks, or at least better risk management frameworks. My last point will be liquidity management within global banking organizations, specifically the part that in banking we consider the internal capital markets between parent banks and their foreign affiliates, is an important part of international risk sharing. One lesson learned here is that this supports continued credit provision, especially in key financial markets in stress periods, and that the flows within banking organizations and across borders have interacted with Federal Reserve dollar liquidity facilities, ultimately supporting credit provision at home and abroad. So on the short historical perspective, turning to the next slide, large banks in particular engage in cross-border lending to other banks and to both public and private sector borrowers. Global financial integration through gross international capital flows increased significantly in past decades. And of course, we're all here to give this historical perspective, so that's how I'm pitching this. This figure that comes from a paper by myself and Claudia Buch in the Annual Review of Financial Economics from last year shows high-level patterns in the composition of gross financial inflows to advanced economies in the top panel and to emerging market economies since 1990. Portfolio investment in orange was typically more important for advanced economies, foreign direct investment in green more important for emerging markets. Banking flows are within the other investment flows in blue. And you'll see from these pictures that this surge prior to the global financial crisis collapsed and then resumed at a lower scale. These bank-based cross-border financial flows tend to generally be more volatile, especially for emerging markets and especially when other banks are the counterparties. The composition of borrowers, sovereign banks or private non-banks, that are financed by international bank flows has also evolved over time. Global banks often served as a means of sovereign finance. They then shifted towards following multinational firms and foreign direct investment activity to provide financial services to trade and their own investment firms. Another related development from the early 1990s to the pre-pandemic period was that of two-way gross capital flows, coined diversification finance by Maury Opsfeld and Alan Taylor. And this increased more strongly than development finance, which are one-way net capital flows that transfer net resources across borders in response to changing investment opportunities. So this growth in two-way gross capital flows really contributes to international risk sharing and tighter cyclical linkages. The global banks are those among the large banks that have set up bank branches and subsidiaries in foreign countries, also providing different services through these affiliated entities. This is really something that's soared in the last 2 decades in particular. Global banks often expanded their footprints internationally, building significant market shares, often by bank privatization, when bank privatization occurred in emerging markets, and by broader acquisition strategies, mainly implemented across advanced economies. So this is one way that the global banks move beyond those traditional lending and trade finance activities to increasingly provide cash management and investment services. The US hosts about 100 foreign banking organizations, with 2020 counts somewhat higher at this 100 than those, for example, a decade ago, which were closer to 92. Their total consolidated assets in the US are around $5.5 trillion, with total loans extended around $1.7 trillion in 2020. This is a significant share of US lending activity. The parent banks come from over 30 different countries, and the FBO size distribution and the location of assets in line with different size buckets of regulatory approaches has shifted over time. And this lines up with some of the comments that Phil made, which is that there's some relative shrinkage in the foreign banking organizations that get the tightest regulatory and supervision approach. That's in the over $250 billion category, and a growth of assets just below that in the 100 billion to 250 billion bucket. In fact, the credit provision by that bucket now exceeds that of the larger bucket. These branches provide credit in the US, financial services to commercial and industrial sector customers. They also provide an extensive backstop financing for their customers by off-balance sheet credit commitments like lines of credit. The US FBOs fund their activities in part through uninsured retail deposits from corporations and money market funds. And as these hosted branches within the US are legally part of the parent banking organization, the liquidity and capital of those foreign bank parents are to some degree the shock absorbers for branches in the US. And these parent banking organizations often manage liquidity globally, allocating funding internally across their organizations and across locations according to their needs and their business strategies. So let's get into this like cyclical pattern. So some perspective, I mentioned my paper with Claudia Buch. We talk about some broader perspective on global banking's benefits and challenges. But from country perspectives, and even from the international monetary system, some net benefits are reduced when related international capital flows are excessively volatile. Of course, you'd want and you'd expect some volatility with open and integrated financial markets. These are market-based firms, and so as economic fundamentals, policies, risk sentiments change, there will be changes in flows. But excessive volatility can be destabilizing. My research, papers from others, including participants in the International Banking Research Network, shows that the amplitude of swings in international capital flows through global banks in response to shocks, like changes in risk sentiment, is moderated when banks are well capitalized and have good risk management frameworks. This brings us to what happened post-GFC, and that is that I think a positive development is the pattern of bank market share in international credit flows has shifted away from weaker and less capitalized banks. There was also a focus on reducing currency mismatch across the assets and liabilities of especially foreign banks that was helpful. These developments likely contributed to lower shock amplification across borders in what's now almost 2 years since the pandemic started, and which curbed amplification mechanisms around the dollar strains that occurred in March 2020. So in my opinion, this underscores one of the success stories of recent regulation and supervision. Of course, as Phil talked about, there has been a migration of some activity away from banks altogether. This has risen a lot in the global context as well. And that's another topic for discussion. As a final point, let me mention the cross-border financing flows between parent banks and their banking affiliates abroad, as well as between unrelated banks. These flows allow for some degree of centralized liquidity management and some efficiencies in bank capital allocation decisions. In the global financial crisis, again, for the historical perspective here, some European banks especially experienced difficulties in meeting their dollar funding needs. Many of those banks with US branches initially turned to these US branches to source more dollar liquidity for the parent organization. Once central bank swap lines were activated and dollar funding availability broadened through these means, some of those private banks instead met their own dollar liquidity needs through their own central banks. And the importance of this kind of synergy in the stress period is underscored by the actual volumes where outstanding balances at the Fed's central bank swap facilities peaked at over $580 billion in the global financial crisis and had real strong effects on reducing dollar funding market strains. This brings us to the pandemic. One more minute. This brings us to the pandemic period, where U.S. branches of foreign banking organizations had outstanding commitments like these lines of credits, which totaled nearly $1 trillion, or about 40% of bank balance sheets, branch balance sheets on average. When the COVID shock hit, this exposure came on balance sheet, resulted in increased funding needs. The foreign parent banks provided these dollars to their branches in the US, and that additional strain on markets, offshore funding markets, was again mitigated by the swap lines. So let me just conclude. I'm out of time, I understand. So global banking keeps evolving in scope, in scale, in counterparties. One historic criticism is the volatility of the capital flow flowing through these banks to both bank and non-bank customers abroad. I think a success of the regulatory changes that occurred after the GFC is reducing these most volatile flows, reducing the role of the weaker banks, and increasing the role of better capitalized banks. The challenge of shadow banks remains, and these presumably will come up in the discussion and in the panel tomorrow on the future of banking. So thank you very much.
Thank you, Linda. Now we turn to Bob DeYoung.
Well,
I don't know if you can do anything about this echo, but I'm hearing an echo.
only when you talk. Okay, so I'm going to share my presentation. So so I believe there it is. I'm going to talk about bank liquidity today. No. First of all, thanks very much to the FDIC and for Mark for including me in the presentation. It's been nice thinking about making this presentation, and I've enjoyed the other presentations, and it's actually an honor to speak at this conference again after being absent for a few years. So I noticed from the original presentation here that the first liquidity paper wasn't presented at this conference until 2006 and 2007. So the first 5 to 6 years of the conference, there was nothing about liquidity. So this is definitely something that's happened during the past 20 years, a new development when when this conference started, I was a bank regulator, and when we started to worry about bank liquidity, I was still a bank regulator, and now I'm a professor. So I think of the world a little bit differently now when I'm doing my job. I know a lot of people in the audience are professors. I ask you to ask your students the following two questions. They seem simple, but these two questions cause a lot of befuddlement. When you ask your students these questions, it's been my experience anyway. Can an insolvent firm be liquid, or can an illiquid firm be solvent? We know these answers to these questions. They're yes, but students seem to have a hard time thinking about it this way. And I think that's because in non-financial industries, as opposed to the banking industry, in non-financial industries, we know that the bankruptcy proceedings start when a firm can't pay its bills. That means we've already reached illiquidity, and we also know that in most bankruptcy resolutions, we end up with assets being worth less than the liabilities. So the firm is also insolvent. So we think they're the same. We think they're the same thing. We know in commercial banking it's not the same thing. We know that a bank can be illiquid while it's still solvent, because we witnessed historically bank runs. We know that a bank can be insolvent without being illiquid, because we've watched, as Ed Kane said, zombie banks, S&L, savings and loans, exist for a long time, being able to pay their bills and have fine cash flows, even though they were worth less than nothing. What I want to talk about is not just liquidity. I want to talk about the red circle on the right, liquidity, and insolvency on the other side. Now, before I move on, I want to point out that it's not just my students that are challenged by this. You all remember the Troubled Assets Relief Program in 2008, and it was originally purposed for these hundreds of billions of dollars to be used to purchase troubled assets from banks in order to increase banks' liquidity. But then we quickly realized that those liquid banks can't make loans unless they have adequate capital to hold against them. So TARP was very quickly repurposed to purchase preferred stock from banks in order to increase banks' liquidity and also to increase bank solvency. So this concept of banks' liquidity or being illiquid, banks' insolvency or being solvent, they're wrapped up with each other. We need to remember this. As I've said, if we go back to the beginning of the FDIC conference, there was no discussion of banks' liquidity risk, not for the first 5 years. So this is a new thing. But we do know at that time, I'm sure there were papers, many papers about bank capital. This is how we thought about a bank regulation. It's important to focus on insolvency. But after the financial crisis, we started to focus on liquidity as well. It's not that bank examiners never looked at whether or not banks were liquid. There's an L in camels, so liquidity was a focus of bank prudential regulation. But now we have the second set of hard minimums in Europe. More banks have to comply by this. In the U.S., only the larger banks have to comply. But then the liquidity coverage ratio and the net stable funding ratio. Now, I'm going to make a quick point. Neither of these is conceptually new. The liquidity coverage ratio is basically something that mimics something that we all know for finance professors, the quick ratio that non-financial firms have been used for years to gauge their liquidity positions. There's important differences, of course. Liabilities of banks can be run away faster and more unpredictably than financial firms. And of course, if you're a commercial bank suffering from some liquidity problems, the central bank stands ready to make loans to you in the short run. The problem after the financial crisis is we found systemic implications for liquid banks that were not illiquid because they were funding themselves with short-term market finance as opposed to short-term deposits, and this, as we've learned, has ushered us into a new era about a bank regulation. The NSFR, the net stable funding ratio, is also not conceptually new. Now, I put this weighted average formula up here, not because I want to talk about all the items. I put them up here to show you that the green things here in the stable funding part of this ratio, they're all loans. And these get high weights, 100%, 95%, 90%. So the numerator here is basically loans. And in the denominator, a whole lot of the heavily weighted items here are loans. And so we've got deposits to loans. Essentially, the NSFR is mimicking a deposits to loan ratio or loans to deposit ratio that bank examiners have used for years and years to see whether the balance sheet's liquid or illiquid or in between the loans to core deposit ratio. It's the inverse, but that's these regulatory requirements are new, but the concepts aren't new at all. So I want to talk in the rest of my presentation here about my own research, since I know it better than many other things. Karen and I have a paper about 5 years ago about whether or not banks actively manage the liquidity. It builds on research that Mark Flannery's done in the past. We looked at 20 years of data. Now this data is before Basel III, before we had liquidity ratio regulations. We found in partial adjustment models that these banks acted as if the NSFR was something they wanted to target. When we calculated NSFRs for these banks, looks like they set targets for the NSFR, even though it didn't exist yet, and it looks like they adjusted quickly back if they got knocked away from that target. Again, the point is that the loans to core deposit ratios and the NSFR are very, very similar for typical banks. The data here shows that not surprisingly, large banks tend to be less liquid than small banks. This is not a surprise. That makes them more dangerous, but of course they have access to sources of liquidity that small banks don't. The remarkable thing about these two pictures is that on the left of the red line for the global financial crisis, illiquidity wasn't just increasing, it was increasing steadily by large amounts. So over time, we missed this. Banks became more and more and more illiquid over time. Okay, so what causes illiquidity or liquidity risk at banks? Well, like the scorpion said to the frog, if you're familiar with that old joke, it's in their nature. We all know that banks fund liquid assets with liquid liabilities. They create liquidity, and this is great because it makes borrowers and depositors liquid, but it creates liquidity risk as banks. Banks are fragile because this is what banks do. A point I want to make here for the rest of the presentation is this liquidity risk, the process that creates liquidity risk, this lending and borrowing, also creates credit risk at banks. So these are liquidity risk and insolvency risk are jointly determined, but our capital regulatory ratios and our liquidity regulatory ratios are independent of each other. And going forward, I think this is something that we need to think about, how liquidity risk and insolvency risk are jointly determined and adjust our regulations accordingly. So a paper with Minji Huang, which was recently published, we took a look at 168 traded U.S. banking companies. We observed their liquidity creation. By the way, this paper by Alan Berger and Christa Baumann is probably one of the most important empirical banking papers or methodological banking papers published during the lifetime of this conference. So I want to give them a shout out. We also observed systemic expected shortfall, the systemic risk at each of these banks. And we also, thirdly, we observed the CEO compensation packages at these banks. And our main finding, I won't entertain you with the gruesome details of this paper because they are indeed gruesome, but the main finding at the end is it appears that by regulating CEO bank compensation packages, regulators should be able to increase liquidity creation by banks. But by doing so, these changes in CEO compensation packages are also going to come at the cost of increasing systemic risk generation by banks. Point being, when you incentivize CEOs to run their banks differently, you get more liquidity creation and more systemic risk, or you get less liquidity creation and less systemic risk. Again, these two sets of risks are jointly determined according to the results here through, in this case, by looking at CEO compensation packages. Finally, this leads us to, if my argument here is that we need to that we need to think about capital regulations and liquidity regulations in a more holistic fashion because these risks are jointly generated. Do we have any hard evidence about whether or not banks consider holding capital and holding liquidity to be complementary or substitutes for each other? There's about a dozen papers, some theoretical, some empirical, on this issue of whether liquidity and capital are substitutes or complements of banks. And the answers are all over the place. I'll just point to two of them. One of mine with Isabel and Amin at the University of Limoges, and then one that's still a working paper, and I only know about this second paper because I sat on a dissertation committee on Monday, and this was one of the 3 essays. In the first paper here, we found out that U.S. banks experienced unexpected. We looked at U.S. banks that experienced unexpected negative shocks to their capital, and we found out that banks responded by increasing their balance sheet liquidity. So the results of this study suggest that the banks consider capital and liquidity to be substitutes. In Foliano newspaper, they comes to a different conclusion. They took a look at Dutch banks who, in 2003, I believe, were saddled with binding liquidity standards by their regulators, and they found out that these banks responded by increasing their capital ratios. And this result suggests that exactly the opposite. Capital and liquidity are complements of each other. And to go back to the slide, like I said, there's about a dozen papers out there, articles on this topic, and they all look at slightly different situations, and they all come to somewhat different answers. So during the lifetime of this conference, we developed new liquidity rules, and we laid that on top of the old capital rules, which during the lifetime of this conference, we made tighter and more binding. But if you take a look at these two sets of rules, they're largely, not completely, but they're largely independent of each other. But I think there's plenty of evidence that insolvency risk and liquidity risk are jointly determined at banks, and based on this literature in ways that we don't fully understand. And so I think this is an important area for future research for the next 23 years, the next 20 years of this conference. So that's what I have to say, and I thank you again for including me in the panel.
Well, thank you, Bob. Thank you to all 3 of the panelists. Glenn, I can't see the chat. I can't see if there are any questions from the audience.
Yes, actually, we have a question from Greg. Greg, do you want to pose your question?
We're waiting for Greg to say.
I can read it if... So the question is directed to Phil. And the question is there a current concern that if we begin regulating shadow banks more intensively, then these activities will move to a new unregulated institutions, leading into a bit of a cat and mouse game?
Yes. Great. That's a great point. I mean, it's such a tough problem. My former colleague, Ed Kane, had a metaphor, I guess, from Hegel. He talked about a regulatory dialectic where you're always sort of chasing, you regulate one area and the risk moves somewhere else, and then the pendulum swings in that direction. So no, I don't have great answers, but I just did want to observe that, in the last 2 big financial crises, the banking system was a source of stability, and it was the shadow banking system that was the problem. And it's kind of, I don't know, ironic, sad that we reacted to 2008 by piling on to banks. And we did a little bit with shadow banks, but not very much. And now I see a whole new emergent form of shadow banking coming online. So that worries me. I don't have any great answers as to what we should do, but certainly we should study this and think hard about it.
Well, Phil, I certainly agree with the need for more study. When I was at the SEC, I took part in some of the Basel stuff, surprisingly. And the thing that all countries have in common is bank regulators. So when they get together to cooperate, that's where they look.
Right.
And some countries have a lot of free market stuff, and some countries have less. The SEC isn't sure whether crypto coins are a security or not. So we have a lot of cracks that things are falling into. And as I think you pointed out, evolution is taking place while those cracks are getting filled or not filled by regulatory oversight. So it's a pretty important current issue.
It is. I mean, if you think back to the 19th century, it took an awfully long time to, if you will, solve the instability in banking. I mean, it probably took 75 years all the way to the 1930s before we sort of figured out a structure that made banking relatively safe. And I think we're now, you know, kind of at the beginning of a process. It's something like, I don't know, the United States in 1850 or something, with the emergent technologies, and really nobody knows where they're headed or exactly how we're going to deal with them. But certainly we need to think a lot about that, because we're going to see more crises, I think.
Yeah, and I could just maybe add there that, of course, in the US, our whole framework is around an institution-based approach as opposed to an activity-based approach with a fragmented set of, multiple set of regulators across different types of institutions. So that raises the challenges.
It's easier because an institution is easier to identify than the administration of a function. Well, Bob, I wanted to ask you a question about small banks, which is not what we talked about today. But I wonder what you think is going to happen to the small banks that exist today. Will they all occupy their own little niches, or will they eventually go the way of the dodo?
Oh, I think they'll go the way of the dodo very, very slowly. If I know my history, the dodo disappeared really quick because hunters came to an island and killed all the dodos. I don't think the small community banks are going to disappear that quickly. We've had deregulation for 25 years, 30 years, 35 years in some states, and it's taken a long time for some of them to still exist. I think that's only natural, right? Now, remember why they've disappeared. They disappeared because they existed only because we had regulation that allowed them to exist, right? We didn't allow competition, so we had all these small inefficient banks. So community banks exist. They're just a lot bigger than they used to be. Okay, so it's not that they disappeared. I think we make a mistake if we look at the number of community banks and draw conclusions based on that. It's not the number of community banks. If you look at the retail side of community banks, youngsters today, younger folks, they don't want to be part of a community bank, right? They don't want to go into the bank. They don't want to deal with the bank. They don't get any warm and fuzzies from having a relationship with the banker. They want to do banking very different way. Yeah, very different way. And so on the retail side, I don't see that they have too much of a long-term mission going forward. I know the Federal Reserve only cares about antitrust regulations in banking because of the small business lending market, I believe. And even there, you know, I don't think it's the decline in the number of community banks that's causing fewer new business starts and fewer new business, less entrepreneurial activity. I think it's because we have a whole bunch of regulation that's increased, and it's just harder for people to start there and run their own businesses. I don't think it's a shortage of credit. So to round this off, I think we continue to see smaller, fewer and fewer community banks. They'll be larger. They'll still exist, but the consumer's sovereign. So there's less reason for them than there used to be.
Okay. We also have a question from Alan Berger. So if it's okay with you, Mark, we can call him Alan and then keep time after that. That work for you, Mark?
That's fine. Yes, please put him through.
Thanks very much. Can you hear me?
We'll get back to you, Phil.
We can hear you softly, Alan.
Okay, I'll speak up. First of all, I want to say thanks very much how Luke and Mark and everybody at the FDIC has put on this conference for 20 years. It's a really great conference. I've attended the vast majority of them, and I really appreciate the opportunity to participate. I just wanted to bring up one topic. I was a little surprised. If we talk about banking the last 20 years, there was one topic that I think happened that nobody mentioned, which was that we had something called the Gramm-Leach-Bliley Act in 1999, which says for the last 20 years, it's not just the last 20 years, but mostly for the last 20 years, we have allowed commercial banking organizations also do investment banking, insurance underwriting, and these other activities. And I'm a little surprised at how little research really there has been over time on this topic, which it seems like is a really important topic. Every politician that I can tell, Democrat or Republican, all say we need to break up the banks and stop this gambling, stop this, go back to Glass-Steagall, and Trump said it, and Bernie Sanders said it, and Hillary Clinton said it, and Joe Biden said it, and they all said it. And we don't really have in the way of great answers. Does this extra activity make the banks more efficient or less efficient? Does it make them more risky or less risky? Does it take away from their core competency? Does it make the economies of scope? I'm not saying there's no research, and I know all the people on the panel have done research on this, as have I, but I think that might be something we might think about over the next 20 years, unless the politicians get their way and they overturn this. So I throw that out there for all of you if you're interested.
Well, yeah, there was a lot of discussion of the combination of banking and investment banking before 1999, and then we some people thought they sort of hit the jackpot, and the world went ahead. So who's got something to add to that?
Right, look, I'll add something. I mean, again, just maybe I'm overly focusing on 2008 and 2020, but those were pretty big things. Those are two major shocks, really the only two shocks, big shocks in that 20-year period. And they weren't centered around large banks like JP Morgan. Those were the entities that were helping out. They weren't the source of the problem. So my view is, going around and breaking them up would really not be helpful.
Well, but certainly we could name banks that were part of the problem.
Oh, go for it. How many are there? There aren't very many. There's Wachovia.
Yeah.
That's about it.
City's always a problem.
It's true. But I mean, Lehman, Bear, Fannie, Freddie, it was the mortgage companies back in 2008. And then in 2020, it was money market mutual funds, bond mutual funds, hedge funds, fire selling assets. And banks were, there picking up the pieces. So I don't see them as I don't even see the very large banks as the core problem right now.
And maybe just to add to Phil's remarks, which are focused on the, if you will, the extreme events, there has been an emerging literature on measuring complexity in banking organizations. And, with different co-authors and many of you in the audience, some of that work is taking place, but that looks at the number of businesses, the concentration of businesses, the organizational structures. These things changed after Gramm-Leach-Bliley and other regulations. And what you tend to find are risk trade-offs with some diversification benefits, some improvements in liquidity risk management, but sometimes also increases in idiosyncratic market risk exposure and systemic risk exposure. So I think there's kind of more of a, an understanding now of the trade-offs than there had been in the past.
Thank you, everyone, for time. I unfortunately have to keep this moving with the virtual presentation. It's harder to extend things. So we appreciate so much you joining us today as panelists. We all benefit greatly from your attendance at these conferences. So thank you very, very much.
Thank you.
Hello, everybody. Welcome to the next paper session, which is on understanding the industry and organizational impacts of fintech. We have two very nice papers. One is on surviving the fintech disruption, and the other is on the rise of finance companies and fintech lenders in small business lending. which has sort of again become a very important topic since the Paycheck Protection Program last year. So with that, I'll just turn it over to the first speaker, Yue Hua.
All right, thank you, Dr. Prabhala. Thank you for having our paper on the program. So this is joint work with Wei Jian at Columbia, Rachel Xiao and Vincent Yao at Georgia State University. And the title of our paper is Surviving the FinTech Disruption. So globally and not only in the US. And if we really want to think about fintech or financial technology, in the historical context, you can think of wire transfer in the late 1800s or credit card ATM innovation in the 1950s or 60s. Now, the recent fintech innovation is quite distinct in the sense that it focuses on a few distinct characteristics. Number one is decentralization, such as blockchain technologies or crypto assets, or a disintermediation, such as peer-to-peer lending. So economists has been debating about the trade-off between new business opportunities versus labor force displacement caused by technology in general or fintech innovation in particular. Empirically, for fintech, there hasn't been much study on what is the real impact on jobs, on firms' demand for skill, their innovation responses, as well as firm performance. And this kind of, where our study comes in, we try to kind of resolve this common empirical challenge, which is, we try to come up with a set of ex-ante measure that can capture an exposure, an occupation's exposure to technology at the micro level, at the occupational level. To give you a big outline what we do, in general, in big picture, what we try to study is the relationship between technological advancement in the context of fintech innovation and firm demand for skill and firm performance. And what we do is we start with developing a new time-varying measure of fintech exposure at the occupational level. The measure is constructed by conducting textual analysis and cross-analyzing the similarities in the textual information in the job task of an occupation and fintech patterns. And the nice feature about it is it can be aggregated into firm level or industry level or geographic level. It could also be disaggregated to any subset of fintech innovation, let's say cybersecurity or P2P lending or crypto or blockchain. So once we come up with a set of measures, and what we do next is explore changes in firms' recruiting strategies using the burning glass data on job posting and innovation strategies. And we also look at firms' performance in terms of their sales and R&D and such in the end. In terms of where we think that we can add to our existing our understanding of the literature, we think that the paper is quite unique, in the sense that we try to come up, we try to quantify the effect or the impact of fintech on jobs and demand for skill, and that hasn't been studied in the literature. There are there are studies on AI in general, or automation or software, but fintech, in our view, they're quite different. A set of technology that is aimed at the provision of financial services. So we can draw any conclusion from previous literature, and it was an independent study. And the second, we try to integrate the disruptive effect of technology with workers and kind of responses by firms, and in the sense that our data burning glass cover job postings of all industries. We connect finance and other industry, and how together they are weathering through the current wave of fintech disruption. In terms of the data, the fintech pattern data is coming from a recent study at the IFS special issue on fintech. This paper by Chen, Wu, and Yang, 2019. They shared us a list of fintech pattern of over 6,500 of fintech pattern findings over the sample period of 2003 and 2017. We also collect data on our own in terms of gathering for each fintech pattern, their assignment over time, and to see who are the assignees of the patterns over the entire sample period. And that will be useful for us to classify who are the innovators and who are the people who are not innovating themselves, but acquiring patterns after it got granted. So in terms of our job, occupational data is coming from ONET. We have about 960 occupations identified by SOC code at the 8-digit level. And the job post data is from Burning Glass. It covers over 180 million job postings in the US in 2017, as well as 2010 to 2018. It covers job locations, occupations, employee identity, as well as skill requirement. Of course, we also supplement data with other data such as the American Community Survey data from IPOMS, and the union data, as well as CompuStat and CRISP, which are more standard in the finance literature. At the center of our study is to come up with a measure to capture an occupation's exposure to fintech innovation. So here is a picture trying to give you a sense on a high level of how we do it. On the top, what we have is a set of financial terms, and then that got applied using machine learning algorithms to the entire set of fintech, entire set of pattern finding data at the USPTO, and you identify a set of pattern findings that is fintech related. So from that, okay, we can get the titles and abstracts of those fintech findings, pattern findings, and that will constitute our textual database for fintech keyword. Okay. In the bottom, what we have is all those occupations. Each occupation, such as like credit analyst, doctor, driver, each occupation will have different tasks. Each task will have a detailed description what those detailed job tasks are. So we cross-analyze the two for each job task for an occupation. We come up with a task score based on the similarity as well as the intensity of fintech innovation. And then once we have a task score for each occupation, we aggregate across tasks to get an occupational level score. Okay, so in general is somewhat similar to the one adopted by Webb 2019 in his measurement of AI technology. So that's kind of a big picture. In more detail, what we have is essentially we have intuitively the measure captures the amount of shadow that a cloud of fintech innovation casts on a given job task. Okay, for a given task, the exposure measure is defined as the cosine similarity times the length of the fintech innovation. So basically two terms. Number one is the sensitivity of the job task to fintech innovation, and number two is the intensity of fintech innovation. If any of the two is high, that occupation will have a high exposure to fintech innovation. In a sense, if there's a lot of fintech innovation is directed to the task of a given occupation, that occupation will have a high score. Okay, could be aggregated at occupation level, and then it's time varying because we used fintech pattern over the last 5 years. Now, to give you a sense, what are the keywords from the fintech pattern innovations? As you can see, payment, credit card, data, device, mobile, transaction. And transaction is the number one word coming out of all the fintech pattern findings. So you may wonder what occupations are in the top. As you can see that the first one is information security, security analyst, because data security, cybersecurity is one category of fintech. And then credit analyst and travel agents, many of them handle payments as such. So, and then the bottom, you can see dancers and doctors, where they're less exposed. So in general, it is more or less in line with our general intuition. Now, in terms of, just to give you a sense of the time series of the fintech exposure measure, because of there's an increase in fintech innovation, you do see that the exposure, the average fintech exposure across occupation increases over our sample period. Okay, it's coming from cybersecurity, mobile transaction, data analytics, blockchain, P2P lending, and robo advising and Internet of Things directed to financial services. Now, you may wonder, how this is related to AI exposure. We plotted our measure against the Web 2019 AI exposure at the occupational level, or software exposure. As you can see, is mostly flat. So our measure is unrelated, or is not the same as what previous measure was captured. And we control those both measures here in all of our formal analysis. Now, in a very high level, then you might wonder which occupations are targeted by fintech innovation. So first of all, the occupations that with the high fintech exposure, those tend to be occupations that, in terms of wage, they are like middle-waged occupation had the highest exposure. Okay, so the very end, the CEOs and the executives and the doctors, they're not exposed highly, but the middle-aged occupations are more exposed to fintech shocks, innovation. And then in terms of education, similar story is kind of the middle-educated occupations with a lot of middle-educated kind of employee. Those are more likely to be exposed to fintech shocks. In terms of gender, fintech innovation is mostly gender neutral. In terms of age, middle age is occupations with a lot of middle age workers. They are more likely to be experiencing shocks from or exposed to fintech innovations. Okay, now that is just to give you a sense that some stylized fact. So what I will do next is to move on and tell you our main findings. Okay, I do have quite a bit, so I will skip some of the slides in between. And here is a figure summarize our first main findings. So what we look at is we look at the job posting share for a given occupation in a given state. Okay, and then plot that against fintech exposure percentile. Okay, as you move along, increase fintech exposure for a given occupation, you see that over our entire sample period, the cumulative job posting share changes decline as you move, as you can increase fintech exposure. So although ex ante a priori, we don't know whether those fintech innovations are supposed to be substitute or complements. Exposed empirically, when we see that they are having a disruptive effect in terms of those occupations highly exposed to fintech shocks, they are experiencing a decline in their job posting, in their demand for worker. Okay, so
5 minutes.
All right, thank you. So in terms of regressions, we do do formal regressions, and this is a regression where we show exactly what the figures show, that we have a fintech quarter for dummy. Those are the top quartile occupations. We call them most exposed occupation. As you can see, a decline. There's a decline in their job, in their changes in posting share. Okay, and then the magnitude of the coefficient is also economically significant because relative to an average of 16 basis point, the decline is about 45 basis point. Now, firms are not going to stand still, right? They demand less, they're going to post less job posting, but there's things that they won't be just doing that passively. What we do, we also look at for the fintech exposed occupation hiring, what skills that require experience and education attainment. What we find is they are resorting to an upskilling strategy where they require those potential new hires to have both finance and the social and the software skill. This is a combo skill rather than only have one of them, which is like finance but not software. They also require them to have more working experience, also to have higher education. So clearly, firms are intentionally trying to hire more skilled worker, able to cope with the fintech innovation. Now, fintech innovation are directed to financial service industry. You may wonder, being the main target, how financial firms respond. The result I showed you are for all firms, and now for financial firms, that's where it's a separate study, and also we can differentiate fintech innovation into more disruptive to the financial industry, and those are based on the market reaction to the pattern findings, and we follow this methodology by the same paper. So what we find is that for financial firms, okay, when they are exposed to disruptive fintech innovation direct to the financial industry, they experience a sharp decline in the job posting. So indeed, the stock market as well as the hiring kind of agree with each other. Those fintech innovation are hurting the financial firms the most. But in terms of other type of fintech innovation, financial industry actually increases the job posting share. Okay, so and that's interesting. So that's a kind of a heterogeneity that we thought was interesting to know. Now,
2 minutes.
Firms, they do not stay put only just because of hiring. They might also change their innovation strategy. So what we do next, we look at the innovation responses of firms. And what we find is for financial firms, when they are exposed to fintech shocks, they tend to innovate more themselves. Okay, either file more patents themselves or acquire more patents. Okay, so they're not standing put. They are adapting to those challenges. Now, because of this differences in innovation intensity and responses, we can classify firm into innovator, which do file patents, or acquisition inventor or acquisition innovator, where acquisition innovator just people who just buy patent, they don't innovate. Firms that buy patent but they do not innovate themselves. What we find is that the inventors actually they are increasing their job posting share. I mean, on the net, okay, the effect is almost muted in the sense that Other firms, there's a disruptive effect in job posting share, but that's not true. The opposite is true for inventors and the acquisition innovators. Now,
time to wrap up.
Is it?
30 seconds. Go ahead.
Okay, so the last thing what we do is we look at the firm outcomes. Okay, what we find is we look at the changes in employment, sales, R&D. We also looked at in the recent version we looked at TFP, productivity. What we find is that firm are generally not firm outcome are not as affected in general to fintech shock. But the only bright spot is the firms that innovate themselves. Okay, the inventors, they show increasing employment, sales, and productivity. So let me conclude. We try to understand how firms respond to fintech shocks in terms of their recruiting and demand for skill, innovation strategy, and even firm performance in general. And so given the time concern, I will stop here. I look forward to any comments from the discussion as well as from the audience. Thank you.
Okay, great. I hope you can hear me. Thank you so much for including us on the program. I'm going to be talking today about the rise of finance companies and fintech lenders and small business lending. And this paper is co-authored with Philip Schnabel. So our paper is motivated by two facts about small businesses. The first being that after the 2008 financial crisis, we saw a big drop in lending to small businesses, particularly from the 4 largest banks that cut lending to small businesses by almost 44%. And both academics and policymakers have referred to this missing bank lending post-crisis. The second fact is that small businesses are critical for economic growth. Like nearly all businesses in the US can be classified as small and medium, and they account for almost half the employment in the US. They also create most of the new jobs in the economy. But if we look at overall recovery from the financial crisis, employment went back to pre-crisis 2008 levels only by 2014. Right? So in this paper, we ask whether this reduction in bank lending led to a slow recovery after the 2008 financial crisis. Right? So we want to understand what the role of the financial sector has been and whether lack of credit to bank-dependent firms slowed down recovery from the crisis. So consequently, we want to understand how reliant small businesses are on bank funding, and are they able to substitute to other sources of funding in the absence of bank lending? We think this question has important policy implications, particularly given what we saw in the COVID-19 crisis, where support to small businesses was allocated through the banking sector. But I think it's important to understand what the entire landscape of small business lending looks like to best implement policy. So we faced 2 main empirical challenges in trying to address this question. The first is a measurement issue, right? So we want to understand small business lending. We need information on all sources of financing to small businesses. Unfortunately, most firms in the US are private, which means we don't actually have financial information. And what we currently have, which is collected from regulatory data, such as the CRA data, focus exclusively on bank lending. And even so, sources like the CRA data, they don't cover all banks because they ignore some of the smaller banks and the credit unions, nor do they include all small businesses because there's a limit of $1 million on the loan size. But anecdotally, we also know that non-bank lenders and particularly fintech lenders have been growing since the financial crisis. So to understand total lending to small businesses, we need information on all sources of financing to the business. The second challenge, as with any empirical paper, is identification, right? Being able to disentangle credit supply from credit demand. Because the decline in small business lending that we see could be due to a lack of credit supply or low demand for credit from small businesses. So we need a plausibly quasi-exogenous variation in credit supply. And in this paper, we're going to try to address both of these issues. So we address the measurement issue by providing a new loan level data set on secured small business lending in the US. We collect the data from what are known as the UCC or Uniform Commercial Code filings. So I'm going to talk about this in detail in just a bit. But the advantage of this data set is that this contains information on all lenders in the economy, includes banks and non-banks like finance companies and fintech lenders. So we have about 11 million loans covering the pre-financial crisis period, the financial crisis, as well as the post-financial crisis recovery. And because it's loan level data, we also have information about the firm itself, such as which industry they're located in, what collateral they pledge, and so on. To deal with the identification issue, we're going to be exploiting a region's pre-crisis bank dependence. So the idea is that there was a national decline in bank lending following the financial crisis, but there's geographic variation in which regions were affected based on the region's pre-financial crisis dependence on banks. So we use this pre-crisis bank dependence to study non-bank lending, total lending, as well as real outcomes in the region. We also deal with additional identification challenges by looking at lending within the same firm by banks and non-banks. We exploit some quasi-natural experiments for decline in bank lending. And we compare lenders that make similar loans but happen to be regulated differently. So the main takeaway from our paper is that non-banks are an important source of financing to small businesses and that they've been growing post-financial crisis. And our result can essentially be summarized in 3 figures that I'm going to show you. So in the first one, we plot annual lending from both banks and non-banks throughout our sample. And 2 things are clear from this figure. The first is that non-banks are an important source of financing. They were important pre-financial crisis, but they've grown particularly in the recovery period, so post-2010. And by 2016, nearly 60% of all lending to small businesses is coming from non-banks. Within the non-banks, we see that this growth has been concentrated among fintech lenders and finance companies. Now, fintech lenders in particular, they were practically non-existent pre-2010, but post-2010, nearly a third of the growth in non-banks has come from fintech lenders. Third, we see that this non-bank lending growth is actually offset decline in bank lending. So regions that were more reliant on banks in the pre-crisis period, they see a greater growth in non-bank lending, but this growth perfectly offsets the decline in bank lending such that there's no variation in total lending across regions that were more or less bank dependent. Similarly, we find no real long-term real effects across regions that were more or less bank dependent. So before I get to the empirical strategy, let me just talk a little more in detail about this novel data set that we collect. So our data comes from UCC filings. So the UCC filings are used to determine priority in bankruptcy. So whenever a secured loan is made, the lender files a public notice letting everybody know of their claims on the borrower's asset. So the idea is if a borrower goes bankrupt, these filings determine who has claims to the asset and what the priority of the claim is. And these filings are made publicly at state level registries. And they include information about the borrower, the lender, when the loan was originated, and the collateral that's pledged. So we're able to collect this across all states in the US from 2006 to 16. And we have detailed information about the borrower, such as their industry, where they're located, the ownership, the collateral that's pledged, and so on. The UCC data itself is going to cover, by definition, the filing is only required for secured loans. And the state level filings actually only cover the non-real estate loans. So real estate loans are made at county level offices. And because we collect state level data, we're going to be missing real estate collateral. The one downside is that the loan contracts are themselves private information. This means we can see when the loan is originated, but the loan terms, such as the loan amount or the pricing, that is private information. Nevertheless, with this data, we can create a quasi-credit registry for business lending in the US. And the biggest advantage is that it's going to include all lenders, both banks and non-banks. Because this is a new data set, I just want to spend a minute talking about the external validity of the data. As I said, we cover non-real estate secured lending, which means we're going to be missing unsecured credit and real estate lending. So we just want to get a grasp of the coverage of the UCC data. So we're pretty confident that nearly all small business lending is secured through different sources using both Fed regulatory data as well as surveys. We see that more than 96% of small business lending is secured. Potentially the largest source of unsecured credit that's missing is credit card borrowing. But even though lots of small businesses have credit cards, in terms of total borrowing on the credit card, it's less than 2% of small business lending. But the bigger part that's potentially missing is the real estate lending. But even so, our estimates suggest somewhere around 13 to 22% only of small business lending is secured by real estate. Again, through data that the Fed has on business lending or independent surveys from the NFIB. Interestingly, if you actually look at how many small businesses even own real estate, that coincides nicely with these measures of real estate lending, because only about 19% of small businesses even own real estate to be able to pledge it. So we think conservatively, our data covers about 73% of small business lending. In contrast to something like the CRA data would cover only about 43% because it's missing the entire non-bank lending part of the market. In the paper, actually, we detail how the CRA data is complementary to the UCC data. So let me get to the empirical strategy, right? So as we said, a concern is being able to disentangle credit supply from credit demand, because the decline in lending post-2008 could have been because of a negative supply shock or because of decreased demand for bank lending. And the idea is to use geographic variation and bank dependence of a region under the assumption that there is a national bank lending shock, but regions are differentially affected based on their historical bank reliance. Of course, this is going to be under the assumption that this geographic dependence on banks is uncorrelated with non-bank lender demand after 2008. So we first want to validate our empirical strategy. So the first thing we want to show is that both in the UCC data and the CRA data, the decline in bank lending in a region is uncorrelated with the pre-crisis bank share, meaning that there is a uniform national decline in lending across regions that were more or less bank dependent. So this could be because of changes to regulation post-2008, could be because of risk management practices of the banks or losses they faced during the financial crisis. However, even though bank lending drop is uniform across regions, total lending or bank lending as a share of total lending is going to fall more in regions that were more bank reliant. Okay, so what we see is total lending drop in the financial crisis is higher in regions that were more bank reliant pre-financial crisis. And this is the variation that we're going to be using. So just as information, this is a plot of pre-crisis bank shares across the country. So we do see there's variation across the country, but there is some state level clustering. So we're going to be including state fixed effects in all of our specifications. So the main specification we have is we're going to look at change in lending at the county level on our coefficient of interest is going to be the gamma on the pre-crisis bank share of the county, including state fixed effects, county controls. In the paper, we also do this at detailed county industry and county collateral level. Okay, so what do we see? We see that regions that were more reliant on banks in the pre-crisis period, they see a greater growth in non-bank market shares and non-bank lending between 2007 and 16. However, what's interesting is that this non-bank lending growth has substituted for a decline in bank lending, such that there is no difference in total lending across regions that were more or less bank reliant in the long run. Once we actually do a formal regression of this, we see similar effects. So moving from the 10th to the 90th percentile of bank dependence increases non-bank market share between 2007 and 16 by about 7.2 percentage points and non-bank lending by about 18%. Even after controlling for detailed borrower industry and borrower collateral, our results are qualitatively similar. But of course, we're concerned that this pre-crisis bank dependence is potentially correlated with non-bank loan demand post-crisis, or maybe they're serving different borrowers after 2008 than before. So what we want to do is exploit a within-firm estimator to look at lending to the same firm by banks and non-banks, under the assumption that there's no change in borrower preference for bank versus non-bank loans after the financial crisis. Right, so we look at the set of borrowers that had both bank and non-bank loans in the pre-crisis period, and we look at the likelihood of the borrower getting a repeat loan after the crisis for each lender type by including firm fixed effects. So what we see is in the first two columns, which includes the firm fixed effects, we see that the same borrower is more likely to get a repeat loan after 2008 from a non-bank than a bank. We might also potentially be concerned that the pre-crisis bank share is correlated with other factors such as county growth and so on, which affects non-bank lending growth in the post-crisis period. So we want to use other variations in bank credit supply, and we're going to rely on the existing literature for this. Particularly, we're going to use three measures of credit supply shock that have been previously used in the literature, which are based on regulatory changes post the financial crisis. So the first one is the first one is going to be an accounting rule change that required banks to consolidate off-balance sheet activities to the balance sheet, which reduced their regulatory capital and in turn reduced lending. Right, so certain regions had banks that were more affected by these changes, and these regions again see a greater growth in non-bank lending and non-bank market share. But again, we see no change in total lending in the long run in these regions. Similarly, if we look at regions that were more exposed to stress-tested banks, we see non-bank lending increases, but it's again substituting for the decline in bank lending. And finally, we use variation in bank capital that was implemented as part of the Dodd-Frank Act, where banks were required to increase their capital. And again, regions where banks had to increase capital to a greater extent see a greater growth in non-bank lending, but no change in total lending. So our result is extremely robust to the different variations in credit supply that we use. So we see regions that were more affected by decline in bank lending see a greater growth in non-bank market share and non-bank lending, but this growth is actually perfectly offsetting the decline in bank lending. So there's no change in overall lending across these regions. Finally, our concern is that there might be differences in the types of loans that banks and non-banks serve. So even if a bank and a non-bank is lending to the same borrower, they might be lending to making different types of loans, or the demand for loans that are served, that non-banks serve, might change after the financial crisis. So to account for this, we're going to be comparing very similar lenders. So particularly what we're going to do is we're going to compare finance companies that are independently operated, so a non-bank finance company, and we're going to compare that to a finance company that is held as part of a bank holding company. So for example, you can think of Bank of America Equipment Financing, which is a non-bank subsidiary of the Bank of America bank holding company, but it is regulated as part of the parent bank holding company. So if it's about these two types of finance companies, they serve similar borrowers, they make similar loan types. So if we think that our results are driven by demand for certain loan types, we'd expect the bank affiliated and bank owned finance companies to behave very similarly to the independently run finance companies. But in fact, we see that the bank owned finance companies, they behave a lot more like banks, where they're reducing the market share while independent finance companies are stepping in.
2 minutes.
Yeah. So finally, we also see that we know that overall in the long term, there was no change in total lending. We validate that by looking at actual real outcomes across the regions. And again, we see that this bank share doesn't predict any difference across real outcomes in regions that are more or less bank reliant, both at the county level and detailed county industry level. In the paper, we have a lot more robustness tests that I'm going to skip in the interest of time. But our paper is introducing a new novel data set on small business lending in the US, which includes both bank and non-bank lending. And we show that these non-banks, particularly finance companies and fintechs, have substituted for the decline in bank lending. And there is no long-term impact on either total lending or real outcomes in the region because of the substitution. And if there's one major takeaway from our paper, it's that non-banks are a major provider of credit to small businesses. Nearly 60% of loans to small businesses in 2016 were coming from non-banks. So when we're thinking about policies that concern small businesses and small business lending and how best to support them, we should be also talking about non-banks. Thank you.
Thank you very much for the opportunity to discuss this paper, these two papers. Let me get to the... So basically, in a nutshell, what we have is two very nice papers on the disruption to the banking system. One is that focuses on the disruption from non-bank lending to banks. The other is a disruption that comes because of fintech. And there are two very different impacts that are measured by the two papers. One measures the loss of bank lending volumes or market share of banks. The other one looks at the labor effects of these disruptions. I thought it was quite a pleasure to read both these papers. It was very educative to sort of see the questions that were posed and the data sets that were used and how they were sort of brought together to answer the research question. So let me summarize what I think the big picture I thought takeaways from both these papers were, and then I'll get into each of these papers. So one of the things that strikes one when looks at both these papers is that there's nothing that happens to the companies that borrow from banks. And I was wondering how you think about this outcome. So is our financial system overall so resilient that we don't really require banks anymore from a policy viewpoint? Is something worth pondering? Or are we missing the impact by, and we need to measure it in some other way? And this thread kind of is what strikes one when you look at both of these things. The disruptions are significant, and it struck me that it was very surprising not to find anything happening to borrowers. The related research question is basically, are banks no longer special? Especially from the Gopal and Schnabel paper. If non-banks can step in and do whatever banks were doing, this kind of raises a research question as to, are banks no longer special? And there's also important policy implications, which is that we put a lot of machinery to support banks, deposit taking, and then onward lending, supervision, the FDIC itself, if I may say so. And then if banks are no longer special, we have to think about what this machinery is all doing and what its purpose is. I thought also that in both the papers, especially the second paper, is that you see that the banks and non-banks coexist over here. And so I thought that one needs to not focus on one type of entity or the other, but to understand how these two types of entities can coexist in equilibrium and what their market shares and their size and their focuses should be like. I think that seems to be an open question, and when one again looks at these two papers. So let's look at the first paper on surviving the fintech disruption. So I thought that in this paper, the data compilation was very impressive. There's data on patents for fintech, occupations and tasks. There's job posts. There's data on demographics, and there's actually data on real employment. And all of this is put together and matched at occupation times geography times firm level in some of the tests. And I thought that, it was really quite impressive how much work went into putting together all of these things in this coherent fashion. What are the results we have? Basically, we have a measure of exposure to fintech disruption, which is basically a cosine similarity, which is normed in a particular way in the text that you see in fintech patents and the text that you see in the task descriptions. There's a subtle distinction between task descriptions and occupations, but we will spare that in the interest of time. So what you kind of find is that occupations that are exposed to fintech lose jobs. I should say job postings. They also lose jobs, but the actual effect on jobs is not as much. And this is a point that I'll come back to shortly. And again, a headline finding is firm performance doesn't seem to be impacted at all by any of this. So the umbrella comment that I have for this paper is that the results are nice and the data are impressive, but I think, in the next version, maybe you could focus on increasing the mapping to whatever theory we know about these sorts of things, and also for policy implications. So let me get to some more specific comments. So one thing is that we know that fintech is a global phenomenon. There's a large number of players with different models, and they disrupt all parts of the supply chain of the finance industry. So there are other things also. For example, payment firms, are on the rise around the world. There's small business lenders, which Mansa has just finished talking about. But there are guys like Affirm who allow you to take credit when you buy something online. There's eBay seller credit. There's so many of these entities floating around, and many of them use tech. So my question was this when I read this paper, that the paper relies on a patent-based measure of fintech innovation and disruption. So I'm wondering what type of fintech disruptions are captured, what portion of fintech is captured by this patent-based measure. So it wasn't clear to me, and what it doesn't capture. Now, this does not take away in any sense from the interest in this paper, but I thought that this is something that the authors might find it useful to comment on. A smaller issue, and which I saw even in Mark Chen's fintech paper, there's a Internet of Things, and I'm not sure why this should be in the fintech. And maybe it's time to refine some of this and get that out of the way, or explain why that is part of fintech. So let's go to the results. The first result is fintech exposure results and job posting declines. And one of the things that you see out there is that it is quite robust to excluding reposts. Reposts are postings that are put up again because presumably they couldn't fill the job in the first place. I was wondering whether the reposting was itself of interest. Should you study that? And, because then you get an idea that when there's disruption, it takes longer to find new employees. It's just a thought on how you could enrich the econ quotient of the paper. The employment effects, the actual employment effects, as opposed to postings, are kind of modest. And I thought that the paper could strengthen the story. And one possibility is maybe that the existing human capital is completely retrained. For example, we have ATMs, and I myself worked as a cashier in bank counting notes long time ago. And basically, the cashier's jobs remain, but they do many more things like issuing demand drafts and doing other services for customers. So one question is basically that what happens to the existing guys? And so maybe fintech increases the demand for new labor, which the paper shows convincingly. And then what happens to the existing labor? It gets retrained, or maybe it gets reallocated across the industry. And that is kind of what I was wondering along the lines of the bank entry. Gordon Phillips and co show this nice result when banks enter, labor gets reallocated across the industry in efficient ways. And I was wondering whether something like that is going on and whether it can be teased out here. I don't know. The next result is upskill demand sort of increases, and this is a pretty convincing human capital result. Software demand increases, educated labor demand increases, experience demand increases, and all of these effects are less in states in which the education system is rich in ITs. These are quite nice, but this brings back to the theory questions. What is the distinction between the new hires versus the existing hires? Do the firms retrain, reallocate, or fire existing workers I think the story just, just focusing on postings alone, I'm not sure what is exactly going on in the bigger picture. And the second effect is reallocative effects. Supposing I end up taking some of the new postings, which are high skill, what happens to the other people? Do they get upskilled? Do they move to other banks with low tech in the same industry? Or do they move across industries? And can we say something? So I thought that it might be useful in this paper. Of course, you can't say everything, spell out everything or test it, but I thought it might be useful to spell out a theory, start with it, and then say whatever you can say and whatever you cannot say with this data. And I think that might be a more useful way of organizing the paper's results. I thought that the paper underemphasizes why fintech is special, and it sort of shows very nicely in various ways that fintech is different from AI in manufacturing, in the types of jobs it displaces and what effects it has. I would actually make that a special focus and put it separately. What is so special about fintech, and just put it out there instead of throwing in it as a placebo here and there all over the paper. I thought the results are interesting and important and can be fleshed out a little bit sort of more. There's another nice result in the paper that industries and geographies with exposed occupations to disruptions become concentrated. And I wasn't exactly sure what to make of all of this, these results. Is it like a distance in lending where entities consolidate, grow, and then they're able to reach out much further, or something else? And related to that, I don't know whether there's firm level concentration apart from geography and industry. I thought this might be worth checking out in the data. In the patents results,
10 minutes elapsed.
Yeah, thanks. In the patent results, so you find that there are two types of firms. One is those who are innovators, and those are the others who buy innovations. And basically, organic innovators tend to do better. I thought again you could tie it to the literature. Sometimes what happens is that the people who acquire innovation do so to kill the companies. And Raghu Rajan and Zingales and co have a paper on that. And so these people require less people. And if you acquirers buy tech, then they hire finance labor. And whereas if the innovation is in fintech is developed internally using tech, then maybe you just hire more tech people. So this kind of story might help help the paper. One missing thing is what happens to data-driven acquisitions. I can do all the fintech I want, but unless I have a lot of data to run the algorithms and to serve more customers, it doesn't. It's not efficient use of all the machinery that I've developed. So one question is that do these types of acquisitions happen? And more generally, I thought that the SDC mergers and acquisitions data could be used to complement this paper in nice ways. So at the end, I thought that some mapping to theory and policy may be required. I don't know from a policy viewpoint what I take away from this. Are there large frictions? Are there less frictions? Should policymakers do something about this? And something about the theory also. There's kind of notion that new tech adoption is sticky. There's work by Clayton Christensen, and we have something in the RFS on the same thing, that legacy practices inhibit new adoption. And I thought something like that you could pin down once again over here using this data. Now on to the second paper by Gopal and Schnabel. I have less to say on this paper. It is extremely well executed. It is topical. It is complete and quite mature. It does a fantastic job on assembling new data that covers 73% of small business lending. Other data sets cover 8% and 41% of the data. And so that is a contribution in itself. The paper looks at supply shocks to banks and argues that fintechs or non-banks pick up the slack that happens when banks are shocked negatively. So I'm going to focus on high-level comments over here. The paper is executed quite beautifully, and there's very little to really complain about that. So one question that comes about is that if non-banks have costlier funding, why do firms not bear the cost of this shift? And why can't we detect it in the data? One argument is that maybe the non-banks have some other cost advantages. I didn't see that, what they are out here. And it might be worth spelling this out. The second thing is regulatory costs are cited as why banks exit from small business lending. I didn't understand what these regulatory costs are as they relate to small business lending and why they should affect small business lending as opposed to anything else. But let us take that as given, that along with a lot of other things, small business lending is there. But then what are the regulations faced by non-banks, and what is the sort of status of these things? And does this two-track regulatory environment make sense? In banks, the FDIC supervises deposits. What do the funders of the non-banks look in all this? And I thought that this entire description of this ecosystem was could be sort of enriched maybe in another paper. And these issues on shadow bank and the regulation came up in the earlier panel discussion also. The third finding is that banks and non-banks actually coexist for most borrowers when you look at the paper. So what happens is that instead of a situation where banks are lending alone, it seems to be that banks and non-banks now together lend. And so I'm wondering whether this should be empirically modeled, whether it should be part of the narrative, rather than saying that non-banks take up the thing. I think this coexistence business, I think, needs to be pulled out. I also thought that the paper seems to understate the economic effect. If I were to think of banks and banks pulling out of small business lending, the consequence should be quite dire, right? Businesses should suffer. And here we find that there's no change. So no change seems to be actually a big change with a proper counterfactual. But I don't know how this can get specified or teased out in the data here. Pretty much the last point over here is that this paper tries to rule out the demand side and says that it sets it up saying that there's supply shock to banks and that is why non-banks come in. But I thought the demand side was also interesting. I mean, you're setting yourself up, a straw man in such a way that the part that you don't address, that is demand, becomes uninteresting. And why is it uninteresting? I thought that it was also interesting. And can one tease out the relative magnitude of the two? You have some estimates of the supply side effects, and can you sort of see the residual as the demand side effect, and then try to say whether that is zero or whether that is positive? The general point I'm making is that a positive effect of supply shock does not mean that the demand side is not evidence against the demand side. Both might coexist, and I'm wondering whether there's some value in teasing them out. I also wondered why the non-banks are able to step up so easily, and what is it about these non-banks that allows them to sort of come up? I didn't sort of understand that. In the end, I think there are two very nice papers on bank disruptions from non-bank lending and fintech. I thought it was a pleasure and very, very educative to read both the papers. So let me stop right here.
Thank you very much, Prabala. We have not that much time left, so I'm going to ask people to defer questions that they have to the virtual receptions later today. I'll give a minute for each of the presenters to respond if they'd like to.
All right.
Please do keep it at a minute, though.
Okay. Yes. Thank you, Prabala. That's a very constructive discussion. All your comments are on point, and we will incorporate more theories and more a framework in the next version. And I thought it's super interesting to study the existing labor of a firm, and that in data-wise, we have to go to census data in order to conduct maybe a separate project. But thank you very much. I really appreciate it, and thank you.
Yeah, I just also want to say thank you so much for the discussion. I think you raised very interesting points there. I mean, and we think a lot of those questions are important big picture for future papers or future policy work. Definitely, I think when we started this, we didn't expect to see this sort of complete substitution, right? I mean, there's been a long literature arguing banks are special. So we did think that there are going to be negative consequences of banks pulling out. So it was quite a surprise for us to see that non-banks are able to step in. I mean, yes, it doesn't happen in the immediate short run. It takes them a few years, but yes, in the long run, they are able to substitute and step in for decline in bank lending. So I think that obviously very naturally raises the question as to whether banks are still special or whether they actually are adding value to small business lending. And yeah, I think we agree that it's not that the demand angle isn't interesting. I think the way the literature had been framed up to this point was that there was a drop in credit supply from banks to small businesses. And we were actually focusing on the consequences of this supply drop. But of course, I think like the demand angle is also equally interesting. Yeah, thank you.
All right, thank you, presenters. Thank you to our discussant, and we'll take again a short break. I look forward to seeing you back at 3:35 Eastern Standard Time.
Everybody to our fourth and final session for today, which is on COVID-19 and financial contagion channels. Both papers that we're going to discuss today are focused on the pandemic, and given that we're living through this experience, I can't emphasize enough the importance of the papers that we're going to talk about today. And we have two great papers. The first will focus on the consequences of information production in the very safest debt we have in the economy. Okay, we trust it to be safe, and we really want to understand the consequences of when that is called into question. The second paper will focus on unused capital buffers, and at a time in the pandemic when the demand for lending is so strong, the consequences of unused capital buffers also is very important. With no further ado, I'm going to turn it over to our first speaker, Nathan Foley-Fisher. Welcome and thank you.
Oh, thanks very much, Jerry, and thanks to the organizers for including our paper on the program. This is joint work with Gary Gorton and with Stefan Barani, who's my colleague at the board, and so that the usual disclaimer applies. So let's get started. Our key objective in this paper is to document the arrival of adverse selection in a market for privately produced safe debt around the time that the COVID-19 pandemic broke. And so just so that everyone is on the same page, what we mean by privately produced safe debt are the substitutes for the debt that's issued by the US government. So this private sector debt is designed such that individuals wishing to trade that debt don't have any incentive to acquire information about the collateral backing the debt, and they expect to trade it at par or close to par. However, and this is the point of the paper, in some bad states of the world, investors may have an incentive to know something about the fundamental value of the collateral that's backing the debt. And in those states, some investors may choose to acquire information. And at that point, the debt that was previously information insensitive becomes information sensitive. And it's that choice of some investors to acquire information about the collateral that gives rise to adverse selection in the market, because other market participants cannot acquire the same information about that collateral, perhaps because they have not invested in the technology to become informed. So to summarize what we do in the paper, we're using the pandemic as a natural experiment in the secondary trading market for some highly rated debt securities that are called collateralized loan obligations, CLOs. And I'm going to describe those in a moment. But let me start with a picture that shows you what happened to trading conditions in AAA rated CLOs around the time of the pandemic. So what you see is that the trade prices in the upper box plots for all AAA rated CLOs went from being at or very close to par pre-crisis to becoming dispersed. That's the box plots in the upper part of the figure. So we're going to exploit dispersion a lot in this paper, dispersion in prices, dispersion in bid-ask spreads. The bid-ask spread is what you see in the lower part of the figure. That's the dashed line. I'm not going to show you dispersion for now. Our central claim is that investors are distinguishing among different AAA rated CLOs. They're producing information, and that is what is creating adverse selection in this market. So let me give you a summary of how we established that there's adverse selection in this marketplace. What we're showing is that when the pandemic broke, the prices of those AAA rated CLO tranches begin to reflect private information. At the same time, we show that large dealer banks like JP Morgan were issuing warnings to their clients that there were informed traders in the CLO market at that time. And then we show that the cost of dealer intermediated trade is increasing heterogeneously for AAA rated CLOs. That is, uninformed dealers began to require compensation, the bid-ask spread, which is consistent with adverse selection in the market. And so for the rest of my talk, my plan is just to focus on the adverse selection test using bid-ask spreads. I'm going to introduce the environment, and I'm just going to highlight the main findings, given the time that I have available here. So let me start with a little bit of background on CLOs. CLOs are off-balance sheet securitization vehicles. They finance loans to highly leveraged firms. So that's the left-hand side of this schematic. The CLOs finance the loans by issuing a set of tranche debt securities. Those are on the right-hand side of the schematic. CLOs are a very important source of credit for firms in the United States. They hold about 60% of the $1.1 trillion in leveraged loans outstanding. And the leveraged loan market itself is used by about 70% of all US firms. And it's especially important for firms that are below investment grade. Some of the features of CLOs are more or less common with other securitization vehicles. So most people are familiar with credit enhancement through tranching. Tranching and other contractual features are permitting, they're allowing CLOs to issue about 60% of their liabilities as AAA rated debt. And these AAA rated CLO tranches are what we are calling privately produced safe debt. So CLOs issue monthly reports, they're called trustee reports, and those reports contain data on the performance of the loan portfolio that's backing the debt. And those data are kind of the backbone for a lot of the analysis that we do, but it's not the only data that we use. So we're combining data from several large databases in this work. We're identifying CLO debt securities using Bloomberg. We track individual CLO transactions using Trace. And crucially, we're using the regulatory version of Trace, so we know individual dealers conducting transactions, intermediating transactions. And we're going to track daily changes in credit ratings. And we're also going to collect that information about the underlying loan portfolios from Moody's proprietary data. So those data are based on trustee reports, but they contain a lot of additional data that we're going to use as well. So here's some of the data that we're going to use. This is just showing you cross-sectional information about the loan portfolios of CLOs, and I've separated out between the sort of pre-pandemic period versus the pandemic period. So in the interest of time, I just want you to focus on the bottom row of the table that's highlighted in red. What we're using is Moody's own definition of industries that were vulnerable to the pandemic, and we're going to identify those vulnerable loans in CLO portfolios. And what I want you to take away from this table is that there's the cross-sectional mean and the standard deviation shows you that there's a huge amount of variation across CLOs in their ex-ante vulnerability to these vulnerable sectors through their loan holdings. And we're going to use that variation in our analysis in a bit. So we think that the future performance of those individual loans is the most likely source of private information that is giving rise to adverse selection in this market. So to be sure, there are a number of ways that adverse selection can enter into this market. Some market participants may not even be tracking the structure of individual CLOs or the contents of those loan portfolios. But even if they do, many participants haven't invested in the tools like credit analysis and loan correlations in order to form a confident assessment of the future performance of those loan portfolios. So to give you a concrete example, if you're an analyst at Blackstone, then you have the knowledge and infrastructure to study loan correlations in real time. But if you're a pension fund manager, you probably don't, and you probably just rely on news and credit rating reports. And so that kind of brings us to who were the informed traders in this market. And so real-time news reports suggest that informed traders were indeed present in the market. So this is a quote from a Bloomberg article which cites a warning from JP Morgan to its clients that some CLO traders were especially informed. So we give a lot more details in the paper, but as I mentioned earlier, we think that the most likely source of private information leading to the arrival of adverse selection is that investors can form their own views on the performance of the underlying loans in CLO portfolios. We don't have access to that kind of information, and so what we need to do is we need to come up with a way to test for the arrival of adverse selection using the data that we do have. So let me explain a little bit how that works. It helps to kind of start and to have a framework for what the presence of informed traders would mean for the uninformed participants in the market. And so you can think of dealers as being uninformed intermediaries. The decisions of those dealers in the presence of some now informed traders is what is revealing adverse selection in the market. And so the way that we study their decisions is to use the variation in their trading costs. So what we do is we calculate the imputed round-trip cost of match trades that are occurring within one day. So you can think of this measure as the difference between a dealer's sell price and the same dealer's buy price for the same security on the same day. And so intuitively, even though dealers are typically arranging trades in advance, there is no commitment to trade. And so what that means is that dealers, who are the uninformed agents here, require compensation for adverse selection because they may end up holding the tranche and maybe trading with informed clients. So let me show you the basic idea behind the information-based theory of debt that we're sort of grounding this empirical analysis on. So the value of the collateral underlying the debt security at maturity is what's shown on the horizontal axis. And the payoff of the debt at maturity is on the y-axis. The value of the debt to the investor, that's the black line, is lower than the debt payoff at termination, that's the red line, because of the risk of default. And the black line is representing the put option value of the debt. So if the debt is traded, then there are two regions for the collateral value on the y-axis. In the region to the right, the debt is deep in the money and the debt is going to trade at par with a high probability. And so information about the collateral has very little impact on the market value of the debt. But as the distribution of the collateral shifts closer to the kink point in the payoff, then now traders have incentive to acquire information about the collateral. And at that point, the debt becomes information sensitive, and that's when adverse selection can arise because investors are producing private information about that underlying collateral. So this figure next is going to show you how we connect that basic information-based theory to the bid-ask spread. And we're going to represent that with illiquidity on the y-axis. So the difference between the left and the right-hand figures is just the state of the world. The blue lines here are representing a single security. And what you see is there's a nonlinear increase in illiquidity when an individual CLO price drops sufficiently low. And that's what follows from the previous figure. When the debt switches from being information insensitive to being information sensitive, then the dealer is going to require additional compensation in the form of that bid-ask spread. So on the left-hand side of the figure, what you can see is that in normal times, prices are always above that information-sensitive threshold, and the dealers don't need to worry about adverse selection. So if we think about distributions now across CLOs, that's those box plots that I'm showing you, regardless of whether the prices are relatively low or relatively high, the distribution of bid-ask spreads across CLOs is going to be basically the same. And that's what those box plots are showing. But on the right-hand side, what you see is that when you go into pandemic times, dealers who start to worry about adverse selection and are asking for compensation in the form of a higher bid-ask spread, that's what's going to push the distribution of the lower-priced CLOs wider than the distribution across CLOs for higher-priced CLOs. So it's all about what happens, again, when the pandemic pushes those prices lower and how dealers are responding to that. I just want to stress that it's not that prices are dropping because dealers are pushing them down. The prices dropped in equilibrium because that's what traders in the market were willing to transact. The dealers are observing those prices dropping and are inferring that some traders have information and are consequently raising the bid-ask spread to compensate themselves for that adverse selection that's in the market. So the previous figure illustrates the empirical test, which is essentially a diff and diff using quantiles on the distribution of bid-ask spreads. And so the test is going to be about whether we can and how we compare the difference between the upper and lower quantiles for high and low price tranches before and during the pandemic. It's a triple difference. This table is showing you aggregate statistics. So when prices move down, the distribution of the imputed round trip cost, the bid-ask spread for lower prices in AAA rated CLO tranches is going to be wider during the pandemic. And that's the effect that you expect from the picture that I showed you before. But of course, we need to worry about identification. And what we're trying to show is that the pandemic has an effect on AAA rated CLO bid-ask spreads through its effect on prices. And that's the blue arrows that we're interested in here. That's the causal channel that we have in mind. And the pandemic, we argue, is a plausibly exogenous shifter of the level of prices from the dealer's perspective. So the issue is that the pandemic may also have a direct effect on the illiquidity of debt securities. That's the orange arrow, the confounding effect. And one obvious potential confounder that springs to mind is risk, and how an increase in risk may directly affect bid-ask spreads. And so we think about risk in two ways. So first, there's the risk to an individual CLO, which is what the traders are trying to price. It's extremely unrealistic to think that dealers are studying the individual CLOs that they're trading and forming a view on the future performance of each individual loan that underlies the individual CLOs that they're transacting on a day-to-day basis. They simply don't do that. It's much more likely that they're just looking at the credit rating of the CLO tranche. And that's why we're focusing on this homogeneous set of AAA rated CLOs. When you can, and those dealers, they see the price level from the traders, and that's what causes them to worry about private information. But the second way,
4 minutes.
Thank you. The second way that risk can enter into the dealer's decision is at the aggregate level, in the form of higher funding costs, for example. And that's the kind of risk that we do think is potentially confounding our estimate. And of course, dealer funding costs may be heterogeneous across dealers, and they may also heterogeneously vary in and out of the pandemic. And so we're going to have to deal with that. So the way that we implement our test is using a quantile regression framework. So the unit of observation is tranche I intermediated by dealer K on day T. And we have the bid-ask spread on the left-hand side. We have the coefficient of interest, which is the interaction term between this COVID dummy and a low price dummy, which is that tranche level indicator, which takes the value 1 if a tranche transaction price is below the median on a given week. So to address this potential identification concern, we have tranche level fixed effects. And then we also have a COVID dummy interacted with a dealer identifier dummy, which is a pretty blunt way to control for the potential effect of unobserved heterogeneity in dealer funding costs before and during the pandemic. That, of course, varies across quantiles. So it may seem a little bit complicated, but just intuitively what we're doing is the same thing as that basic triple difference. It's just allowing us to control for the potential confounding effect of risk. And this is the table that's showing you the result. If you just focus on the numbers that are highlighted in red, the result is telling you that in normal times, there's no difference between the bid-ask spreads of high and low price CLOs. But that changed during the pandemic. And the shift is really at the low end of those distribution of prices, which increase the upper quartile of the distribution of bid-ask spreads, but it doesn't change the lower quartile. And that's exactly what we expect from a framework with adverse selection. It's entirely consistent with the figures that I just showed you. So economically, the difference is significant. If you think about the counterfactual world where a AAA CLO tranche at the bottom quartile of the distribution moves to the upper quartile of prices, the differential effect of low prices in the pandemic is 12 percentage points. It's a huge amount for securities that are typically trading at par with a bid-ask spread of about 8 percentage points. The two columns on the right-hand side of the table show you that this differential effect is not present in CLO tranches further down the stack of claims because they are always information sensitive. And of course, I want to be clear, the bid-ask spread increased for other reasons as well. That's the aggregate and the dealer-specific risk that we're careful to control for. But it's these estimates that allow us to separate out these two effects and to calculate that about half of the total increase in the bid-ask spread that occurred during the pandemic was due to adverse selection.
1 minute.
Thank you. So we're making the claim that information is what causes the effect that we observe. And ideally, we'd like you to be able to show you all of the relevant sources of information. But that's completely unrealistic because some of that information is private. We simply have no access to it. But I can show you just one way that information is entering into dealers' calculus. And so here, the unit of observation is those AAA rated tranches per week. And you're looking at two different distributions of bid-ask spreads across CLOs for each week in the first half of 2020. So the light box plots are distributions of those bid-ask spreads for CLOs that have relatively low exposure to those vulnerable industries. And the dark box plots are the distributions for CLOs that have relatively high exposure. So we have more formal tests in the paper, but the key takeaway is just that you can see that the bid-ask spreads are going up more for the more vulnerable CLOs. And so the key point is just that we can show you one source of information sensitivity here. Again, I just want to emphasize, dealers don't study trustee reports for every CLO. They're just trading intermediaries. In the paper, we also talk about how the CLO managers responded to adverse selection arrival. But given the time that I have, let me just conclude. What we're showing in this paper is that during the COVID pandemic, adverse selection appeared in this AAA rated CLO market. In normal times, traders had no incentive to produce information. In bad times, there's only some agents that can produce information. They did produce information, and the uninformed dealers who were intermediating those transactions demanded compensation for the presence of that information in the market. We're showing that the Lemons premium accounts for about half of that increase in the bid-ask spread. And that's all I have. Thank you very much.
Jerry, should I just go?
Go ahead.
All right, thank you. Thank you to the organizers for including this paper in the program. This is joint work with my colleagues Arun Gupta and Matt C. from the Federal Reserve Board, so the usual disclaimer applies. Let me start with the motivation for the paper. As you know, after the global financial crisis, regulatory authorities worldwide introduced the Basel III capital standards, and with that introduced this idea of regulatory capital buffers on top of the minimum requirements that the banks could use to absorb losses during times of financial stress, and in this way help the economy by maintaining the flow of credit during an economic downturn. In the US, the capital buffers include the capital conservation buffer, which has been recently replaced with the stress capital buffer. It also includes the GSIB surcharge and the CCYB or countercyclical capital buffer, which for the US is set at 0 currently. I would say that the buffers in general have been providing the right incentives so that banks can raise their capital ratios and can increase their resiliency, particularly during good times. Interestingly, though, what we observed during the recent episode of the COVID-19 pandemic is that banks seem reluctant to use their buffers. As we document in this paper, none of the US largest banks have dipped into their buffers. And recent evidence, particularly from Europe, indicates that only few of the global banks have used their buffers during the pandemic. So in this paper, we're going to get at this question, and in particular, we're going to look at the lending implications of this unwillingness of the banks to use their capital buffers, and in particular, we're going to focus on small, medium, and enterprises or SMEs. And second, we're going to also explore some of the potential reasons that explain this behavior. So in trying to understand this unwillingness of the banks to use their capital buffers, we're going to pose it in this paper that there might be some sort of frictions that would make this choice very costly. In particular, we have to consider that, for example, by construction, when a bank decides to use its capital buffer, it will immediately face some restrictions to its capital distributions in the form of dividend payouts or share repurchases or even bonuses payments. Second, there could also be some market stigma associated with the usage of a capital buffer, by which it could sort of like send a negative signal to market participants or investors, which might interpret the use of the buffer as some sort of like weakness of the bank relative to its peers. Third, there could also be some sort of uncertainty associated with potential regulatory pressure and the need to rebuild the buffer after being used soon after, let's say, the bank decides to use it. So we're going to look at these particular reasons and try to quantify the potential costs associated with each of them in the second part of the paper. Back to the idea of measuring or understanding the lending implications of this behavior. In this paper, of course, we're gonna face the typical empirical challenges of separating supply from demand changes, for example. So for that purpose, we're gonna use information which is confidential, but it's at the loan level that we collect for the largest banks that are subject to the stress testing exercise in the US. And this data matches the banks with their borrowers. So we're going to see in particular details of the credit lines, and we're going to use in particular credit line commitments. And we're going to base our identification on the following idea. So we're going to argue that when a bank operates with a capital requirement which is pretty close to their regulatory requirements, the banks are going to try to preserve their capital in the face of a shock, and therefore will be less willing to use their buffers. We're going to call these banks buffer-constrained banks. So what we do in the empirical exercise is we split the sample of our banks into those that entered the pandemic capital, say, buffer-constrained, with those that were not necessarily buffer-constrained, and we're going to compare the lending of both before and during the pandemic period. Definitive, strictly speaking. Before I show you the empirical results, let me just provide a little bit of information in terms of this relationship between bank capital and lending that we observed before and during the pandemic. The left chart in this slide presents or shows the regulatory capital ratios for the largest banks in the US, the G-SIBs. And as we can see, by the end of 2019, banks were operating with CET1 or Common Equity Tier 1 ratios above 12%. And of course, the pandemic hits the economy in the first quarter of 2020. The capital ratios decreased because of the loan loss provisions that they have to put up in light of the losses that they were facing due to the recession. But interestingly, over the next 2 quarters, in the second and third quarter of 2020, the capital ratios actually increased. So in contrast to this high level of bank capitalization, what we see on the chart on the right, which shows the evolution of commercial and industrial loans before and during the pandemic, we see that although C&I lending increased significantly in the first quarter, right when the pandemic hit the economy, because many corporations went to the banks to, draw down the credit lines, right after that, we see a significant decline, even when we consider some of the government support, like the Payment Protection Plan or PPP loans. If we discount the PPP lending, what we see on the red line here in this right chart is that C&I lending has been decreasing in the second and third quarter of 2020. So we're going to look at this evidence, and we're going to argue that even after controlling for potential factors associated with loan demand and bank controls, we're going to find evidence of a credit supply shock or a credit supply driven reduction in lending, affecting in particular SMEs and other vulnerable firms. Before in case I run out of time, let me just give you a preview of our results. So we do find empirical evidence that relative to buffer unconstrained banks that entered the pandemic buffer constrained reduce their C&I loan commitments to a group of firms that we deem as vulnerable, in particular SMEs or firms with no access to capital markets, small and private firms. They also contracted their loan supply to young firms. Those are firms with shorter lending relationships, and also firms that had credit lines that matured during the pandemic and therefore were up for renegotiation. The reduction, at least on the intensive margin, is between 5 and 9 percentage points, which is really significant and sizable. We also look at the extensive margin, and in particular, we find that these banks were roughly 5% more likely to terminate an existing lending relationship with these types of firms. As I mentioned in the second part of the paper, we try to quantify the potential costs that might explain this type of unwillingness of the banks to use their capital buffers. And we do find that two types of events, rating downgrades and potential dividend cuts, represent about 300 basis points reduction in abnormal cumulative returns in a 3-day window during times of financial stress, which we consider, again, very sizable and a potential explanation for this behavior. Let me walk you through a very simple numerical example now to explain what we're doing in this paper. So let's imagine that a hypothetical bank entered the pandemic with a capital requirement of about 12%. And in the US, as I mentioned, the minimum requirement of 4.5, which covers the possibility of insolvency, is shown here on the orange area. And what I said is that on top of this, the requirements include this costly region of capital, which we denominate costly region of capital, which are the Basel III capital buffers that for the US, as I said, include the stress capital buffer and the GSIB surcharge. So let's imagine that this hypothetical bank has a stress capital buffer of 2% and a GSIB surcharge of 3.5 or something like that. So let's imagine that both the capital buffers represent about 5.5%, that on top of the 4.5 would bring the capital requirements to 10%. The green area represents voluntary capital buffers that the banks decide voluntarily to maintain, say, for operational purposes. And this variable is going to be really key in our analysis because we're going to look at the behavior of or different behavior of banks depending on the size of this headroom or cushion. So imagine now that the pandemic hits the economy so that some of the losses will start eating their capital ratios. Depending on how big their headroom is, a bank may use this green area to absorb the losses. However, if the bank operates with very little of a cushion, it might be forced to absorb the losses deepen into this area, the blue area of a costly, capital buffers. What we observe in practice is that banks do not do that. Banks will try to get to a limit in which, they will decide to preserve their capital ratios and do not dip into these buffers. And they're going to do it by reducing the denominator of their capital ratios. In other words, by deleveraging. And in doing so, of course, they're going to curb the availability of credit to credit-worthy bank-dependent firms like SMEs or other small borrowers. The idea behind this behavior is that banks might be operating under the idea that these capital buffers are de facto minimum requirements. All right, let me now provide sort of like the details of our empirical work. So as I said, we're going to use data from a regulatory report, the so-called FRY14. This is low-level data, confidential. And we claim that this is the closest thing to a credit registry for the US. We're going to use information for the largest domestic bank holding companies, about 16 of them, that will grant loans to more than 50,000 firms, public, private, small, large. And as I mentioned before, we have information about the credit lines that individual firms have from these banks. And in particular, we're going to use credit line commitments, which will somehow be immune to things like credit line drawdowns. So rather than using the utilized portion of the credit lines, we're going to look at the loan commitments, which will be closer to the idea of a credit supply. In terms of the empirical strategy, as I mentioned, typically we're going to extend the Kwajalein framework that looks at the firm that borrows from two different types of banks, banks that are subject to a shock, in this particular case, banks that enter the pandemic, buffer constrained relative to buffer unconstrained banks. In practice, this approach is implemented by the use of firm fixed effects, right? Firm time fixed effects. In the context of our paper, most of the firms that we're going to be looking at are small private firms that borrow from a single bank. And therefore, we cannot use the Kwajalein framework because those firms are going to be absorbed by the firm time fixed effects. So what we're going to do is, instead of looking at individual firms, we're going to look at groups of firms that are similar in some dimension. For example, they might be of similar size. They might be located in the same geographic area, like the same zip code, or they might be operating within the same industry. So rather than using firm times fixed effects, we're going to use groups of firms times fixed effects. More specifically, here is the diff and diff specification that we use. For the intensive margin, we're going to look at the growth in line commitments quarterly, and that as a function of a dummy variable for the pre and during pandemic period, and a dummy that identified whether the bank entered the pandemic with a buffer constraint, and of course the double interaction. And we're going to augment this framework by including a third term. In other words, we're going to look at a triple difference as well. And this third term is essentially to identify the different types of firms that we're going to be looking at. As I mentioned, we're going to look at firms that are private, bank dependent, SMEs. We're going to look at firms that enter or that have a young lending relationship with these banks. And third, we're going to look at firms that enter the pandemic with a credit line that matured during the pandemic. As I mentioned before, we're going to include the fixed effects, the firm time or the group of firms times fixed effects, as I mentioned. For the extensive margin, we're going to be replacing the left-hand side in our regression framework with a dummy variable that indicates whether the bank terminates or not a lending relationship with this type of firms. In the previous framework, when we were looking at growth in loan commitments, we were expecting a negative coefficient, right? Meaning that the banks that enter the pandemic buffer constraint would be reducing their commitment growth to firms during the post period, in other words, during the pandemic, if we were looking at these particular firms. In the case of this regression framework, we're going to be expecting a positive coefficient on the triple interaction, which is interpreted as, this banks that enter the pandemic buffer constraint would be more willing to terminate a lending relationship to a firm that is of this type during the pandemic. Here are the results of our diff and diff framework. As I mentioned, we were expecting a negative coefficient, and that is indeed the case. It's negative and significant for the different types of firms that I just alluded to. And the loan reduction is significant. It's between 5 and 9% percentage points, which is very sizable considering that on average, between this period, for example, commitment growth was about 6% annually. Here are the results for the extensive margin. And as I expect, or as I mentioned, we do find a positive and significant coefficient with the coefficient ranging between 1, 4, or 5% of a higher probability that the banks that enter the pandemic buffer constraint would terminate a lending relationship to this type of firms. All right. Let me now get to the second part of the paper in which we try to identify the costs of, or the factors that explain this unwillingness of the banks to use their buffers. So for this part, we're gonna use an event study type of analysis, high frequency data over the last 30 years. And we're gonna look at a simple 3-factor bank equity returns regression. And we're gonna see the changes in cumulative abnormal returns to 2 events in particular, rating downgrades and dividend cuts. As I mentioned, these 2 proxy for some of the factors that I alluded to when I described potential explanations for this behavior. And what we do find is that, particularly during times of financial stress, like the global financial crisis, we do see a reduction in cumulative abnormal returns of about 280 to 300 basis points in a 3-day event window. These are relatively large costs that, as I mentioned before, would explain indeed their reluctance to use their capital buffer. So just to wrap it up, this paper finds evidence that the largest banks in the US are reluctant to use their capital buffers. And as a result of that, they end up cutting significantly their credit supply to a group of firms that we deemed vulnerable, like SMEs or firms with young lending relationships and firms that entered the pandemic with a credit line that matured during the pandemic. We do find also evidence of significant costs associated to the idea of using their capital buffers, all of which would lead us to conclude that in terms of policy implication, if you want, the capital buffers are not working as the Basel III framework intended, meaning it might be the case that regulators might need to revise the framework, and in particular put emphasis on this idea of a potential market stigma. So it might be the case that regulators may want to increase the communication or make a particular emphasis that the capital buffers are intended to be used during times of, or during bad times, without necessarily implicating that the firm might be weak or any bad signal to market participants. With that, I'm going to stop here. Thank you.
Okay, I hope everybody can hear me. Okay, we're waiting for my slides. Great, thank you. So I really wanted to thank the organizers for inviting me to be here. It is beyond a pleasure. I really am very interested and inspired by the type of work that these authors are doing, because I simply look around us these days at the pandemic and the enormous toll that it is taking on society. And it's natural to ask about the quality of the regulatory framework we have, and in a sense, what can we do better going forward? Both of these papers are really in that spirit. And so just a big picture view that really guided my thinking throughout this exercise of going through these papers is that I think of a pandemic as a Main Street crisis, not a financial complex crisis like 2008, which is very difficult to try to unwind and regulate, right? My point here is that our society has seen Main Street crises over centuries. Okay, we've seen a pandemic before. We've seen world wars, okay? And so my general take is that a regulatory system, every time an event occurs, should revise itself. And if there's a type of event that you've seen a lot of, that you would think the regulatory system should be pretty profoundly good at handling these types of situations. And so while I'm impressed with a lot of regulation and what it has done, these papers are suggesting that our work is not quite done, that the possibility of losing faith in AAA rated securities is still there. Even if the crisis is not inherently in its root a financial crisis, we should be more adept at handling this kind of issue. And the second paper shows that there's a lot of underutilized capital floating around at exactly the time when our small and medium-sized enterprises that are so important for the vitality of innovation and our economy overall so sorely need this capital. Okay, so I really wanted to emphasize that I think that both papers are working on extraordinarily important issues, and they're really bringing out to us reminders that the task of regulating and quality of the economy that we've created continues to be something that we should focus a lot on. So on to the first paper. The first paper really is motivated by a theory that I find to be quite profound as a reader and an enthusiast of theoretical models, the work of Dang, Gorton, and Holstrom, and the whole notion of optimality of opaque debt. To me, and this is my opinion, but shared by many, I think this theory has been quite influential in many minds, is that that's very thought-provoking, but it's also very important to the question of financial stability, is that if it's optimal for something to be opaque and there are triggering events that are going to take that quiet period away, okay, that we really have to think about the regulatory implications of this and understand when, if you will, the opaque equilibrium gets broken. And so my whole point here is that I really wanted more empirical evidence on this very profoundly interesting theory, and that's what this paper does. And they actually show that the pandemic looks to be an example of one of these triggering events that can actually induce information production. So I have a number of comments for both papers. I know that time is quite limited, so I will try to move directly into them. My first comment is a very quick one, is I would encourage the authors to be a little bit more careful in terms of when they describe economic magnitudes and units. As a reader, I often was trying to convince myself whether I was seeing something in percentage points or basis points, and of course the difference can be quite substantial. No question that the impact on AAA securities was in fact economically large. So let me now turn to what I think is really where I can hopefully provide the most insight as a discussant, because it's one of the most challenging issues any paper in banking or corporate finance faces, which is identification. So Nathan showed you this regression model here, and we have the round trip trading costs on the left-hand side. Okay, and the main thing is that the authors are aware of there being many market microstructure influences on trading costs that are well documented in the literature, including, the banks may have balance sheet concerns. There could be inventory costs that are different when the pandemic comes. And the blue circled terms here, I think, rather moderately convincingly take those off the table. We could quibble, but I say from a first order sense, I say that's pretty good. But where I start to say the paper's limitation comes in is that the red term circled here, which is the primary focus of the authors, the approach taken is to assume that if it's not absorbed in the blue term, by default, it must be asymmetric information, right? So you're kind of saying anything that's not in the blue must be the one that I want to model, which is asymmetric information. So to say, if there's a problem or a challenge with this specification, basically we have to ask, are there forces other than asymmetric information that could influence the price term in this regression? And if so, can the authors take additional measures to nullify them? And I wanted to note that it is a strong assumption to assume that that term can only mean asymmetric information, because I want to bring out one example of a violation to exclusion here, which is that when the pandemic comes, some banks might simply pull out of the market. Okay, they could get a note from headquarters saying, we have too many things going on in our other activities. I want you to pull away from the CLO market for a while. Okay, if that occurs, you're going to see changes in the round trip trading costs because the size of the market that is providing liquidity has fundamentally changed and has become more monopolistic, right? The more dealers exit, the more monopolistic is the remaining market. And the prediction there, because that wouldn't be absorbed by the blue terms, is that it would have to then come and affect the red term here. And that would also have the same prediction as far as signs. And that would be an example of an exclusion. By the way, I do think that the authors are likely correct in first order sense. I actually buy a lot of the results we're seeing here. But I wanted to note, as a discussant, one of the more important things I can do is not just note an exclusion issue, but suggest a remedy. And I think that there is a solution here, in particular, reporting trade-weighted Herfindahl indices based on who's actually involved in the market for various subsamples over time. If you don't see any changes, then that concern is nullified. But in addition, if you do see changes, you can add a term to the regression based on the market conditions and the concentration levels. And the crucial thing to do here is to interact it with the COVID dummy as well. Okay, so let me just bring out one more point before I move to the next paper. And that is, it's always important in a paper like this to try to identify a counterfactual so that you can show, here's what happened to the COVID treated firms. And look, if you don't apply that treatment, this is what would have occurred, right? And so the author's approach to doing that is to look by industry to identify some industries that were not really impacted so much by the pandemic, or even those that were impacted positively, like maybe healthcare, right? And so you get this regression here like we see in table 6, where the first two columns are the main results. Those are the COVID impacted results. And we see a highly statistically significant cross term. This is the author's main result. It really alludes to what they're trying to tell us here. But crucially, the authors then go on to say, look, in column 3 here, we're going to run it just on the untreated, if you will, the industries that didn't have COVID. And they say, look, it's not statistically significant. Therefore, I can say that the main results are really special, and I found the counterfactual. But my point here is that if you look at the actual coefficient magnitudes, the coefficient magnitude in column 3 is actually the same as that in 1 and 2. And therefore, to me, it's not really established here that there is a counterfactual, because the economic size of the impact, even if it's not significant, appears to be the same. My recommendation is to drop this analysis likely. And the point is that there really is nobody's untreated. In the world of COVID, you know, the pandemic really reached all corners, or look harder. I don't have a lot of time, so these are quick suggestions that I'll leave for the authors. I'll send them the slides, but I do want them to focus more on policy recommendations of their results and issues of that sort. So I'm going to go now to think about the second paper. And here, again, the issues are very important because, you know, there are a lot of borrowers that really wanted access to credit. And we're seeing that, hey, these new rules that were created after the last crisis aren't really helping those individuals. And it's also the individuals that I think really matter in this context here, which are small and medium-sized enterprises. For example, we're just not getting the credit. And so the results are economically large, and it really calls into question whether the regulation that has come about here is in fact the right regulation. So on that, I just wanted to note that the paper takes a pretty negative stance on the Basel III regulations. And you see on the left here, the picture that Jose showed is that the blue area, this additional regulatory buffer, is not really being used, you know, to give it to small and medium-sized enterprises. That's the problem. But what I wanted to note is that it's a little short-sighted to be that negative on this regulation without thinking about the broader context it was put in. And that is, in the current world we live in, pre-COVID, the banks were in the red circle, right? You see the cushion area. So the idea is as they started to fade, yes, they didn't lend as much as they might have. But you want to ask, the right question to ask is, what would our economy have looked like if the buffers were never imposed in the first place? That means the whole blue buffer in the picture here, suppose that was gone. Okay, Basel III never came about. What would have happened then? Okay, and the belief is that what I want to pitch here is that the banks probably would have been in the blue circle. That is, they would have been less well capitalized prior to the COVID pandemic, and that we probably would have therefore seen even greater curtailment of lending because the concerns of going into the insolvency zone would have been more salient. So I want to suggest that I'm not as negative on the consequences of that rule, but nevertheless, I'm very sympathetic to the author's notion that maybe the rule could have been better. And because this diagram here really articulates that very clearly. This is my favorite part of the paper. When you see the red line here relative to the blue line, parallel trends, very clear that the buffer constrained banks were really pulling back more in relative terms, right? A couple suggestions. One is show this picture for all the groups. Show it for SMEs, show it for new borrowers. I really want to see the magnitudes and see this broken out. The second comment is also about identification. So you see on the bottom here, I'm showing you the main regression that's used by the authors. And so as is true in a lot of papers that use COVID, they argue that COVID itself is exogenous. Okay, so that's the post variable, and I'm going to give them that. Okay, we didn't see it coming. That's really exogenous. Okay, but what's not exogenous here is the other part of the cross term. That is, the buffer constrained bank status is probably correlated with a lot of other things going on with those banks prior to the pandemic. For example, some banks might have had very slow growth. They were struggling a little bit beforehand. And it's going to be correlated with buffer constrained status, and you're going to later see that they curtail lending more. But then the conclusion might be it wasn't necessarily the buffer constrained status that made them lend less. It would actually have been they're just banks that were growing slow anyway. So they had a tougher time in the pandemic for a different reason. So the type of exclusion that I'm talking about, again, now turning to being constructive, can be handled in a more convincing way. And all the authors really have to do is to add a number of control variables like the one I just described, but crucially, you must interact them with the post term as well. And the question then is, do the results for the buffer constrained term maintain their significance? Okay, so I'm just about out of time. And so I just note I have some other quick notes for these authors as well. I really want to think about one limitation is the sample covers these very large banks. But I think that small banks probably also played a very important role in lending to SMEs, and they're just not in this sample. Something to think about, the impact on Main Street as well. There is another paper that uses the same data that also covers the pandemic that I think the author should look at and try to think about the joint conclusions from reading both papers, because there are regulatory conclusions in the offing, right? And that is that maybe the capital requirements in the buffer region should put different weights on credit lines. Phil Strahan mentioned this earlier, that there was massive drawdowns of credit lines kind of associated with the pullback in lending, that this paper also really reinforces, and that so maybe a credit line drawdown should be looked at differently. So I will just move on and conclude. I really enjoyed thinking about these papers. I think they're really doing society an important service. I really take them seriously. I think that they have the message they're trying to conclude essentially right, but I hope that my constructive comments can help the authors to go just that much further, and hopefully that there'll be important regulatory consequences that can be ironed out in the longer haul as we internalize all of this information. And with that, thank you. Back to the organizers.
Thank you very much. We do have the virtual receptions after this. So I will defer any questions or hands in the audience to those sessions. We will put in the chat the links to those sessions. Room A will be for the morning sessions. Room B will be for the afternoon sessions. Room C will be for the poster sessions, which you can watch the videos online. But I do want to give the presenters an opportunity to respond to the discussants' comments. So if you'd each be willing to take a minute to respond. The virtual rooms on the program don't open until 4:45, but they are actually open now. So take a break, get a coffee or tea or whatever it is you need, and hopefully you can join us as soon as you're back from that in one of those virtual rooms. But before we do that, let me give an opportunity for the presenters to respond.
Thank you very much, and thanks, Jerry, so much. I mean, wow, super constructive comments, a really constructive discussion. Thank you. You had two sort of main points, one about identification, market power, and the other about the interpretation of the coefficients. We can talk about some of the minor comments, the policy related issues afterwards maybe. So on the market power, we did do a little bit of work in terms of looking across dealers to see who was in the market, who was participating in the market. I didn't do exactly what you were proposing in terms of calculating the HHI and interacting with that COVID dummy and putting that in. So I think that's incredibly useful, and I will do that. The interpretation of the coefficients, that's right. I think we could do a little bit more to help you to understand those numbers there. Part of it is the way that we are wording it. So the way that a bid-ask spread is usually used and calculated is different from an imputed round-trip cost, being that it's a percentage of the ask price of the dealer. And so we can do a little bit more again to kind of iron out some of the confusion there, and hopefully that will help. Thank you again so much for the comments. It really was incredibly constructive. Thank you.
On my side, I also want to thank Jerry for this insightful and valuable comments. You raised very important issues that we need to address in the paper. In particular, I agree with you on the identification issue, that we could sort of like add the controls that we currently have in the regression framework for banks' financial conditions when they enter the pandemic. But you're right, we may want to also use them as part of an interaction term with the dummy for the pandemic, and see whether the triple interaction, that is our main variable of interest, sort of like remains significant. And I also think that what you mentioned about the Greenwald et al. Paper, it's important. So we also need to reconcile our findings with what that paper finds. So again, thank you very much for the comments.
All right, thank you very much to the presenters. Thank you to everyone who's attending. Please join us in the virtual rooms. As I said, room A is a room for people presenting in the morning. Room B is if you'd like to talk to the people who presented in the afternoon. Room C is for the poster sessions, and I hope you all have the opportunity to watch those and interact with our PhD presenters. Please go get your coffee or tea or take whatever break you need, and I hope to see you shortly in those rooms. The link can also be found on the conference agenda. So thank you everyone for joining our first day. I think it went very well, and I hope to see you at the virtual receptions.